is joining in with how the trade setup looks like and the stocks that are likely to be in the news today. First up, Gaurav is here to get us all the market cues that we need to watch out for. Gaurav, good morning. It was a forgettable week for the bulls the last time around, but what are the important cues you are watching out for today?
Well, absolutely. As you said it was actually a forgettable run for the bulls, because when we look at the market, it has actually has been on the losing streak for the 6th consecutive session on Friday. It declined almost by 2.6% on the last week, and it ended at around 24,600 level, and that is the reason why 24,600 level becomes an important level to watch out for. Because remember, even though Nifty has lost a lot, but if we look on a month-on-month performance, it is still up if we compare it with the month of August. So definitely 24,600 is a key thing to watch out for. Other than that, Nifty IT was actually a biggest loser. If we look at the performance, it is down almost by 8% in the last week itself because of the changes in the H1B visa and other related changes. At the same time, we also saw Nifty Realty and Pharma actually reacted to at a negative level. But from here on, Nifty Pharma is another thing to watch out for, because now, although US has put 100% tariff on branded drugs, at the same time China has now slashed tariff on Indian pharma products from 30% to 0%. Remember, India does not have any major exposure to Chinese pharmaceutical market, but definitely we are watching out the basis on the sentimental impact of on Nifty Pharma. Other than that, RBI MPC meeting now that will begin from 29th of September. So definitely Nifty Bank is something that we should be watching out for. Remember, last week it is down more than 2%. On the global side, when we look at US markets, S&P actually ended its 3 days losing streak on Friday. It is up more than 0.5%. So definitely we'll watching out on how the global market is also going to be. But at the same time, for Indian markets, Indian IT, Indian Nifty financials and Nifty Pharma are 3 key indices that we will be watching out from here on.
Indeed, 3 important indices to watch out for in today's session. Gaurav, thank you for that update. But over to Upasana now, who would list out the stocks that you need to keep your eye out for in today's session. Upasana, good morning. What's on your list?
Good morning. First up, let me start with HUL. The company has come up with this Q2 update in which the company expects consolidated business growth to be near flat to low single digit for Q2. Next up is HDFC Bank. The UAE regulator has asked the bank to halt acquiring new clients. Next up is Tata Motors. Now, PB Balaji resigns as the CFO with effect from 17th of November 2025 and Dhiman Gupta to take charge instead as the new CEO. Now, the board also appoints Shailesh Chandra as the MD and CEO of the company. And mind you that according to the reports, UK government also guarantees 1.5 billion loan for JLR. Hence, even this stock will be in focus. Next up, let me start with BEML. The company signs MOU with Bharat Forge and Data Patterns to support AMCA program. Next up is PG Electroplast. The company acquires 50-acre land parcel in Sri City and plans nearly 1,000 crore investment over the next 5 years is what the company has indicated. Next up is Power Grid. The board approves 2 new projects worth nearly about 700 crores. Seagull India also in focus as the JV secures 509 crore LOA from GMADA for development of Mohali Township. Next up is Azad Engineering. The company signs a new contract with Mitsubishi Heavy Industries Japan worth nearly about 651 crore. And also lastly, VIP Industries will be in focus on the back of the block deal as promoters have offloaded nearly about 6.2% stake in the company for 343 crore. So all in all these stocks will be on our radar today.
An important day beckons for our markets. Upasana, thank you for that update. And as Upasana was highlighting about Hindustan Unilever, the country's largest FMCG company, came out with an update on Friday. They are expecting a flat to low single-digit growth in the second quarter of this fiscal, which the results will be reported in a few days from now. And it is anticipating a recovery starting only in November. Shilpa is here with more details on this. Shilpa.
India's largest FMCG company is bracing for a short-term hit this quarter, and this is because of the latest GST cuts. Now, from soaps, shampoos to toothpaste, hair oil, talcum powder, even lifestyle nutrition, nearly 40% of HUL's portfolio now attracts just 5% GST, down from 12 or 18 earlier. Now, that's great news for consumers, and HUL is already passing on that benefit to consumers through lower prices and even better value right from 22nd of September. Now, this move also the company believes in the long term will drive demand and consumption. But in the short run, this reset has disrupted the supply chain. Distributors and retailers, they're holding back from fresh orders to clear the old stock. And consumers are delaying pantry buys, waiting for cheaper prices to hit the shelves. And this is something that we will see across the industry as all players are trying to move from the older MRPs to the new MRPs as the new GST rates come into effect. So HUL says that September sales have taken a knock, and this impact could also extend into October, and it expects Q2 growth to be flat to low single digits. But the company is calling this a one-off blip, and it's betting on the recovery from November as prices stabilize, and this is something that we're expected to see across the industry as well. And next quarter onwards, growth is expected to stabilize as the new prices come in and as that drives consumption coming back for the entire FMCG industry. Back to you.
Shilpa, thank you for that update. Take a short break. On the other side, we put the spotlight on some global cues and the developments with regards to the India-US trade talks. Stay tuned. Welcome back. Now, Commerce Minister Piyush Goyal has returned to India after a 3-day visit to the US. Now, this was his first visit since the 50% tariffs were imposed. The Commerce Minister Goyal met the United States Trade Representative Jamieson Greer and US Ambassador Designate to India Sergio Gore. Abhimanyu has more details on this. Abhimanyu.
Have indicated that the date and venue of the next round of trade negotiations between India and the United States has not been finalized yet. However, things are on track and efforts are underway to meet the fall deadline for the first tranche of a mutually beneficial bilateral trade agreement between both the sides. Also, sources indicated that there is an impact of pharmaceutical tariffs which have been imposed by the United States, and the impact is being studied. Now, both the sides are currently in negotiations. Earlier, between the 22nd and the 24th of September, a trade delegation headed by India's Commerce and Industry Minister Piyush Goyal had visited the United States. He had met the US trade representative as well as the US ambassador designate to India. Meetings were held between the government officials as well as India's negotiating team, and India's minister had held meetings with several business delegations within the United States too. The statement which had been issued by the ministry earlier had indicated that both the sides had exchanged views on possible contours of the deal, and it was decided to continue the engagements with a view to achieve an early conclusion of a mutually beneficial trade agreement.
Abhimanyu, thank you for that update. Meanwhile, US Commerce Secretary Howard Lutnick, in an interview to a news channel, stated that India remains among the big ones Washington wants to settle trade disputes with. Lutnick said, and I quote, "We have a bunch of countries to fix like Switzerland, Brazil, India. These are countries that need to really react correctly to America, opening their markets, stop taking actions that harm America, and that is why we are off sides with them," end of quote. Now, in the US markets, it was a good trading session on Friday for Wall Street. All the three benchmark indices ended higher, and that was after the PCE inflation data that was reported, and that was in line with expectations. The Dow Jones gaining 300 points, the S&P 500 0.6% higher, and the Nasdaq, gains of around close to 0.5% as well. Now, Friday's gains snapped a 3-day losing streak for the indices, but they still managed to end the week with losses. Now, the US core inflation, as we just highlighted, the PCE, the core PCE inflation was little changed in August, according to the Federal Reserve's primary forecasting tool, likely keeping the central bank on pace for interest rate reductions in October as well. CNBC's Rick Santelli has a report.
Now let's get to the meat on the bone. The PCE numbers on the month-over-month, up 0.3 as expected. That is 0.1 hotter than the rear view mirror. 0.3, well, that would be the warmest since February when it was up 0.4, and Jan and Feb were the highest readings of the year, both up 0.4. Now, if we look at the year over year, it's 2.7 as expected. Once again, 0.1 hotter than the 2.6 in the rear view mirror. 2.7 equals where we were in February, which was the high of the year. To find a higher number, you're going to March of 24 when it was 2.8%. Now I think the most important numbers, we look at core PCE month over month, up 0.2. Good news. Not only is that as expected, it's 0.1 cooler than the rear view mirror, which was up 0.3. And finally, the most important number of all, in my opinion, core PCE year over year up 2.9%. Same as we were expecting, same as last month. And the high reading of the year was February when it was 2.95%.
Rick Santelli, thank you. And now let's also listen in to former Fed official Loretta Mester, who shares her reaction on these inflation numbers.
The narrative has been, if we could set aside tariffs, inflation is moving back down towards 2%, and that's just not what's in the data right now. If you look at core services and take out housing, which is coming down, you see that actually moved up. So this isn't really good news for the Fed. They have a very narrow lane to be in. They want to support the labor market, but they're going to need to keep some restrictiveness in their policy stance in order to bring inflation down. And we'll have to see how things play out the rest of the year in terms of where the economy is going. There's a lot of cross currents, as your panel was talking about right before, in terms of not only cyclical things going on, but some structural things, which complicates the picture.
Now let's get you the latest on the developments related to US President Donald Trump. Dia is here in our special segment, Trump Watch. Dia.
Good morning. We begin with developments from West Asia. US President Donald Trump on Sunday hinted at a breakthrough in the region's crisis, saying all are on board for something special. Now, his comments come just ahead of a crucial White House meeting with Israeli Prime Minister Benjamin Netanyahu on Monday. Washington has been asserting that an ambitious plan to end the war in Gaza is nearly complete. Now, back home in the US, President Trump has ordered the military to be deployed to Portland, Oregon, to quell protests over his immigration policy. Now, this marks the fourth American city where the president has sent National Guard troops to duty, escalating his campaign against demonstrators opposing his policies. Now, but the move has triggered a legal battle. The state of Oregon and the city of Portland have now sued the Trump administration in an attempt to stop the deployments. The lawsuit notes that Defense Secretary Pete Hegseth called 200 members of the Oregon National Guard into service effective immediately. Meanwhile, tensions with Iran are also in focus. Iranian President Masoud Pezeshkian revealed that the Trump administration demanded his country hand over its entire enriched uranium stockpile in exchange for temporary relief from impending UN sanctions. And finally, Washington has announced it will revoke the visa of Colombian President Gustavo Petro. The U.S. Department of State says the move comes after Petro incited violence and urged American soldiers to defy orders. Now, he was seen in New York City streets protesting against the Palestine conflict. Footage released by the Colombian presidential office showed him calling on U.S. troops to disobey Trump. That's all for today. Hormaz, now back to you.
Dia, thank you for that update. Let's take a short break. On the other side, we get your cues from the commodities market. Stay tuned. Welcome back. Now Manisha Gupta joins in with all the updates from the commodity space. Manisha, good morning. What's on your radar today?
Well, I'm looking at gold and silver both because for gold we are trading very close to its all-time highs, $5 away really. So you could be looking at all-time highs in the day today. For silver, very interesting moves coming in for this one. We are looking at $46 an ounce. Indian markets, of course, trading at an all-time high. But when you look at the prices, almost silver is trading at the best levels in last 10 years. And when it comes to gold, with the kind of 45-46% of gains that we are seeing, this is the best. The last time that you saw these kind of gains were perhaps in 1979. So very, very strong gains continuing here. The market's also getting concerned about that U.S. government shutdown. Clearly, there would be something that would be passed today, tomorrow types, but then it would only be a temporary thing. And the markets are taking very, very strong cues from this one. Also, when you look at the US dollar index, the 9% decline that we've seen in this year clearly continues to be very supportive. And then we are looking at strong inflows into gold, whether it's coming from central banks, investment buying, even the physical buying across the world seems to be picking up, supporting the markets there. A quick word on the crude oil prices, and we have the very most important OPEC meeting to deal with in this week. While there's an expectation of 137,000 barrels per day of an increase coming in from OPEC yet again, it clearly has to do with supply concerns as well from Kurdistan, whether it is about supply concerns coming in from Russia. That is what seems to be keeping the crude oil prices in good favor.
Manisha, thank you for that update. Of course, all eyes, as Manisha was mentioning, will be on the OPEC meeting over the weekend. And to round off the show, India are the Asia Cup champions after beating Pakistan by 5 wickets in a final that will be remembered for years to come. A roller coaster match going one way or the other, but in the end, a special effort from India's middle order sealed the deal, and it was led by a match-winning 69 by Tilak Verma under pressure. However, the Indian team led by Surya Kumar Yadav refused to accept the Asia Cup trophy from the Asian Cricket Council President and Interior Minister of Pakistan, Mohsin Naqvi. With that, we call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call on the other side to set you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Kicking off a fresh new week, we are coming to you live from the CNBC-TV18 Motilal Oswal studios. Yesterday was a painful week. Can we expect a bit of a bounce is the question as we start this week. I'm Prashant. With me, my colleagues Nigel and Survi. Guys, good morning.
Hi, morning.
Hi, morning. Well, the US market managed to bounce back on Friday, but not that we're entirely correlated. But yeah, given the huge drubbing that the bulls have had, maybe they'll hope for some respite, some relief today?
Well, that's right. You know, the markets will be hoping to put in some kind of a base or some kind of foundation. And talking about foundation, it's my son Neve, which means foundation. It's his birthday. So hopefully the bulls can put a little bit of a base in place. And Neve, happy birthday, Papa's promise.
Well, wish him a very happy birthday, Nigel.
Thank you so much.
Well, let's just take it from the top, right, in terms of what you need to know as we kick off a fresh new trading session. And I'll start with, of course, the backdrop, which has been losses and more losses and more losses. And the picture comes up on your screen. That's a a table. 3% Nifty, Midcap index down 5, IT down 8, real estate down 6, and the pharma index down 5%. That's just 1 week. Look at 8% knock on the IT index, right? And it started slow. We were last Monday, this time, we were talking about the H1B stuff, which had come out over that weekend. It started slow that Monday. Tuesday was nothing. But then, of course, losses picked up. And we finally ended with an 8% cut. So it's been quite painful, frankly. Now, just to say this right off the bat, I think if you look at a variety of short-term indicators, as far as the market is concerned, we are looking oversold, extremely oversold, actually. And that is the reason. 6 days, the market's fallen. But simple things like the RSI, etc., very oversold. I mean, we're due for a bounce. But are we, when I say a bounce, do we mean a big sort of rip-roaring rally or anything? No, I mean, I think the range still remains, but maybe we go in the other direction for a bit. Hopefully today, we'll see. Of course, the focus squarely is on US-India trade talks. And I was sort of looking at headlines, anything which has been said by the US side over the weekend. So Howard Lutnick, US Commerce Secretary, I mean, he made the comment about both India and Brazil, and it said that India needs to play ball with the US. This was with regards to opening up markets and markets to US companies and, of course, other stuff, etc. as well. Nothing from our side. There was that statement which was issued after the Indian delegation led by Commerce Minister came back on Friday. That was last week. We put that out as well, saying, well, talks are progressing and they'll continue. But I think this is the big one, which we will have to see. There is, I mean, a lot of stuff happening this week, right? 1st of October, you've got the RBI meeting. We've got a market holiday. 2nd is a market holiday, which is a Thursday. So, Thursday holiday, Friday, we come back for one-day session and go into the weekend. So 1st of October, which is Wednesday, is the RBI meeting. Markets are expecting a dovish pause. But I think given the state of things here, which is the rupee, which is equities, which is foreign outflows, it'll be an interesting one in terms of action and, of course, the stance and, question and answers, etc. as well from the governor. On the 1st of October, so as I said, lots happening on that day, there is a very high chance that the US government, federal government shuts down unless a last-minute deal can take place. President Trump, of course, is meeting Democrats, etc., to try and avoid it. It's not new. I mean, over the years, we've seen this over and over again with very little impact as far as markets are concerned. If it does shuts down, some data, etc., gets pushed out, including jobs data, which is due for Friday. There is also the start of the Chinese, Golden Week from the 1st of October, which means that there won't be any onshore trading from the 1st to the 8th. So a relatively quieter period as far as China and data out of China, etc. is concerned. US continues to remain pretty solid. So US markets were down for 3 days. Friday, they sort of came back up again. S&P is up 14% in 2025 so far. And about 54% of it is driven by earnings, which have come through. I mean, the rest is multiple, some, equity market multiple, etc. By the way, US 10-year real rates, YTD, have fallen from 2.25 to 1.75%. I mean, this is a big reason why equity multiples have had space to expand in that sense. But even without that data, etc., hard data out of the US continues to be extremely strong. And I think that's just the way it is. And equity markets have responded. In India, just to come back and before I get to the levels, massive amount of primary issuance. The numbers may not be, especially this week, may not be all that large in terms of number of, the size of IPOs, but 22 IPOs opening over the next 1 week and 21 listing, many which closed last week. I mean, they're going to be listing. So more than a couple every day, pretty much, I assume. And we'll sort of cover many of them as we go along. So just to sort of tie in the levels here, as I said, maybe despite all of this, perhaps just for the fact that the markets are oversold on technical basis, we'll get a bit of a bounce. The market is decisively closed below the 61.8% retracement level, which means that the next support comes in at the old support zones, which is 24,400 to 24,330, which is the prior lows. 24,400 basically was the low. So that becomes a support level. For the Nifty Bank, it's broken key daily averages and the 61.8% retracement. Support here comes in at 53,561. So I'm just leaving you with supports here. I mean, on the way up, there are enough and more markers. But I think maybe, hopefully, fingers crossed, a bit of a bounce here. GIFT Nifty will give you a quick sense of how we start. We'll pick it up from there. 100 points higher. So we've got to build on it as we open up. Nigel is standing by. He's walked across to the F&O side of things with what the positioning is looking like. Nigel, over to you.
Well, Prashant, that GIFT Nifty suggesting a 100-point gap up, that's something that's making me a little bit uncomfortable. I'll tell you why. Because it's giving the bears some kind of order to come in there and sell into the markets. I would have preferred actually a softer start. So holding on to these gains is going to be extremely important. And last week, no two ways about it. You had FI selling, you had some HNI panic, and you had leveraged positions as well that got sold out. And the structure on the market has got damage. And the biggest negative actually has been the renewed FI selling. Because in last week, if you take a look at the sell number, it's much higher than what we saw earlier in September itself. So the average FI net sell number, that's what perked up. But however, there are a couple of factors that the bulls will clutch onto. One being the technical levels, whether you're looking at the PCR, the shorts in the system, and the RSI moving towards that oversold levels. So the hope is that we're reaching those stretch levels and hopefully we see a bit of a bounce. And the next point is maybe some kind of NAV propping towards the half yearly close. That is, September 30th or so. So let's see whether or not that can provide some support, particularly to the broader market. It's going to be extremely important. What do the FIs do? Well, they added close to around 19,000 contracts. Short positioning moves up to around 86%. And in absolute terms, it moved to around 1.65 lakh contracts on the short side. So some shorts in the system, the bulls will be hoping to trap them on the wrong side, which hasn't happened till now. Now, remember, we have the monthly expiry that plays out tomorrow, and the rollover positioning comes up for you at around 48 and around 52% on the Nifty Bank as well as on the Nifty. So one factor is big shorts in the system. The second factor is the PCR has come down to around 0.63. This is a highest we have seen in more than a month or so. And normally at around 0.6, 0.65, you do see a technical factor that plays out and you do see a bit of a bounce. And that's happened because of the call writing. 24,800, 24,900 call. Extreme writing is what we're seeing on both those two strikes. While some glimmer of hope is that we saw some kind of writing at around the 24,600 odd mark, which brings us to the levels. The 50 DMA, that becomes your first reference point that you're looking at. So 24,850. That's the first level that could provide some kind of resistance. We'll keep an eye out on that. And the bulls will be hoping that this 24,500, 24,300 mark does hold out, because the last time around we bounced from this 24,300 odd mark. Pulling up the Nifty Bank, that was leading the way on the upside. That's given away some kind of, that's some of that advantage. So you have the 20 DMA, that becomes the first level of resistance. That's around 400 points away from current levels. So you'll want the Nifty Bank actually to get towards that mark. Well, on the downside, you don't want it to go to around 200 DMA. So that's the important mark that you're looking at. Moving to stocks that are in focus. Well, we told you in Friday's trading session itself, that RBL Bank, that could continue to stay into the F&O band. And that's actually outperformed the Nifty Bank. So this stock needs to be kept on your radar. The other one is Saman Capital. That's come out of the F&O band and we've given you a heads up itself. Also, towards the end of today, keep an eye out on the Nifty rebalancing. A couple of stocks will be in focus because of the flows, because that will be effective tomorrow. So today, we'll keep an eye out on Interglobe as well as Max. Both of them will be the stocks in focus because, both of them will be coming in. While the exclusions are Hero MotoCorp as well as IndusInd Bank. These are the exclusions. These are the inclusions. So we'll keep an eye out on all these names.
Okay, all right. We certainly will. Thanks for that, Nigel. Asian markets, by the way, are quite mixed. Some of the markets are seeing profit taking. Case in point would be Japan. But then you've got the Chinese markets, particularly Hong Kong, which is doing quite okay. Almost a 1% rally going on the Hang Seng. So that's the picture across Asia. That's the implied open. So it's suggesting that we will get that rebound that bulls have been desperately seeking. Let's see if they can, sustain on this and then build on this as we get to our open. Well, let's get to the equity call of the morning. Rhythm Desai of Morgan Stanley expects earnings to beat in the next couple of quarters, the RBI to remain dovish, more reforms from the government, and a likely trade deal with the US. He says the underperformance in 2025 so far makes a potential rally a significant pain trade for foreign investors. Okay, so Rhythm retains his bullish stance on India. Let's get to our first conversation then. Ed Yardeni, president at Yardeni Research, is with us. Mr. Yardeni, always a pleasure to have you in. I'll start with this whole business of the US government shutdown. Well, we've been at this point before, right? And it usually just passes over after a little bit of noise. You think it'll be more of the same, or could it be different this time?
I don't know. I don't think it's going to be different. We get this drama on a regular basis, and it passes. Sometimes the government does shut down for a couple of weeks, and sometimes that's avoided. My hunch is it'll be avoided. I don't think the Democrats want to be blamed for shutting down the government. They've got enough problems going on, so I suspect they'll fold.
On the data piece, Mr. Yardeni, what have you made of the latest prints? I mean, we saw the inflation numbers last week, end of last week, and pretty much in line with estimates, though now headline inflation is edging closer towards the 3% mark. The labor market data has been patchy. Jobless claims weren't that bad last week. Of course, we'll look out for the non-farm payrolls report on Friday. What do you make of the macros at this point?
Well, the macro data that's come out since the Federal Reserve met to vote to cut the federal funds rate by 25 basis points, all that data has shown that the economy is actually doing very well. Real GDP for the second quarter was revised up significantly from 3.3% to 3.8%. That was on Thursday of last week. And then on Friday of last week, the Atlanta Fed's tracking model is showing that real GDP is increasing at an annual rate of 3.9% in the fourth quarter. Initial claims came out on Thursday suggesting that layoffs remain extremely low. So, we've got GDP being revised up and the payroll employment numbers being revised down. That implies that productivity is absolutely stunning. And if that's the case, there really was no reason for the Fed to lower interest rates. The labor market's just got a lot of strange things going on with the supply, especially. Also, AI is having an impact. I don't think that the last rate cut was necessary, and I don't think there'll be another rate cut this year.
And, you mentioned AI. Good morning. Lots of questions around maybe some weeks it's a larger number of questions. AI is entering some bubble zone or not, and some serious people are starting to talk about it. Seriously. But what did you make of that NVIDIA OpenAI deal, Ed? One paying the other to be able to sort of buy their GPUs, and does it remind you of instances in the past?
There's a Prince song, party like it's 1999, and maybe it's going to be party like it's 2025, 2026. It certainly reminds one of the meltdown scenario we had with the tech bubble and then the tech wreck, 1999, and then a couple of years there into the 2000s. Artificial intelligence, AI, I should say, is artificial and it's not intelligent, but it's going to be very useful for certain applications, but it's not going to be the kind of game changer that people are talking about, in my humble opinion. And I think there is a certain amount of hype there. And it wouldn't be a bad thing if the AI stocks just kind of consolidate for a while everybody figures out whether they should be at these elevated evaluation levels. And meanwhile, they're not going to prosper unless they have technologies that really help other companies. The S&P 493, let's say, if we're comparing it to the Magnificent Seven, the S&P 493, I call them the impressive 493, and I think they need to show that they are using AI to increase their productivity. I think that's going to happen, but I think there's a little bit too much hype about this, and the kinds of monies that are being thrown around. I think the market is right to question whether there'll ever be any significant profits on the kind of investments that are being made.
Absolutely, and I think it's a big question of our times, right? And people on both sides, and we'll talk more about this. Ed, great speaking with you. A short conversation today. Appreciate you joining us here on CNBC-TV18. It's always a pleasure. We'll just quickly tell you what's lined up here in terms of interactions over the next 2.5 hours. So we have at 8:35 Ravi Menon of Macquarie Capital joining us to discuss the H-1B visa fee hike and key trends in the IT space. 9 o'clock. We'll have Harshit Kapadia, Vilara Securities, to talk about trends in the capital goods sector. 9:20, Pratik Gupta of Kotak will join us on markets. 9:35, Hindustan Copper Management talks to us about the, that big mine shut, right? Second largest copper mine going out of business for at least a quarter. Jairam Sampath of Keynes Technologies will be speaking with us at 9:45 on the board approving redesignation of Ramesh as MD as Executive Vice Chairman. And towards the end of the program, it's the economy. Lata talking about all issues concerning bonds and rupee with Kamakshya Trivedi of Goldman Sachs coming up.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you on the other side. We get to that in just a bit, but for the time being, I give you a sneak peek. Tata Motors, IRFC, Lupin, Paradeep Phosphates, Rosario Biotech, Azad Engineering, PGA Electroplus. But on the flip side, HUL, HDFC Bank and Hickel will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. Well, gearing up for the start of a brand new week of trade, and cues across Asia have been mixed, we've been telling you. But if we look at the implied open, that is suggesting that the bulls will have some relief, at least some reprieve after last week's serious drubbing. So 100 points to begin with. Of course, individual stocks are going to be on the radar as well. So let's straight away get to the CNBC-TV18 list of top stocks to watch. Morning to all of you guys. Hormaz, let's start with Tata Motors. Tata Motors, I think, has managed to be on our top stocks list consistently all through last week. It opens this week as well. Some relief coming in from the UK government.
As you can hope for that. You can't take Tata Motors off your radar considering the news flow surrounding it. And now reports are suggesting that the British government is likely to back their JLR unit with £1.5 billion worth of loan guarantee. And that is to secure their supply chains, which has been impacted due to the ongoing cyber attack. And there have been reports that are suggesting that these small suppliers to JLR could run out of cash reserves by as early as next week. And that is why this loan guarantee becomes very important. And this loan will be financed and guaranteed by the British credit unit, which is the UK Export Finance. Now, JLR has 3 factories in the UK. It produces close to around 1,000 cars there and every day, and it supports majority of the jobs in Birmingham, which is the second biggest city over there. But the lack of clarity here is still there because the production shutdown, which is there till the 1st of October, whether it will resume after that or not, that remains the big clarity to watch out for. There is no clarity forthcoming on that front. And of course, Tata Motors as a stock bucked the trend on Friday in a market like that. It was one of the few Nifty gainers yesterday. I expect some green in today's session as well.
Okay, all right. Thanks a lot for that, Hormuz. Let's hop across to Mangalam, who's back fresh from a holiday. Nice and relaxed, Mangalam. Spend some time with BV, that you'll do in the office also, as well as with Bacha. So, welcome back.
Thank you, Nigel. Yes, relaxed, and hopefully there will be a comeback from the Bulls as well after what took place all of last week. I was tracking it from the holiday, but be that as it may, I'm looking at HUL this morning because the company has given their second quarter update. They've said that they expect their consolidated business growth to be flat or near low single digit. And remember, this is something that all the FMCG companies told us during the GST conversations that we had with them as well, that there would be a transitory impact on trade and channel due to the GST reduction. The old stock has to be cleared, the new stock has to hit the markets, all of that. In fact, I wouldn't have gone with a red on HUL until the company actually said this as well. And this is where we may see a bit more protruded decline. That is, they expect the impact to continue in October as well. And they expect recovery only starting November. So the transitory impact that there was, because it may continue into October, which includes both Dussehra and Diwali, may have the street a little more worried than it should be. The decline, however, would be shallow. The stock has anyway corrected a wee bit from the highs. So opens in the red. Let's see whether with the mood of the market, it sees some recovery or not.
Okay, all right. Got that, Mangalam. Thanks very much. So HUL on our radar. Let's get to Gaurav. He's watching out for HDFC Bank and also, I think, IRFC. Gaurav, morning.
Well, yes, for HDFC Bank, a small speed bump is what we can call because their international transaction and the branch has been impacted. Now, Dubai Financial Service Authority that has barred HDFC Bank's Dubai branch from onboarding new customers until further notice. And the reasons they have given is that the DIFC branch, which is Dubai branch, they are carrying out financial services by arranging financial products to customers who are not onboarded by DIFC branch. And there are also some issues that they found with the onboarding process in the DIFC branch. So definitely on the back of that, bank says that the impact is not going to be material because they have only got around 1,500 customers in the branch, whereas the total branch, the customer count is around 9.8 crores. So definitely impact is minimal, but sentimentally negative. On the other hand, when we talk about IRFC, they have sanctioned 3 loans worth 20,000 crores in this over the weekend itself. They have given loan worth 12,600 crores to CSPGCL. They have given loan worth 4,000 crores to Talcare Fertilizers. And lastly, they have also extended their loan facility to around 3,300 crores to PVUNL. So definitely a positive news flow here, given that they have given 20,000 loan, sanctioned 20,000 loans. Remember, they have around 4.5 lakh crores worth of loan book as of first quarter of FY26.
All right. Thanks very much for that, Gaurav. Lupin is the next one. We're going to focus on. Vinny's here with details. Vinny, morning.
Hi, good morning. So Lupin, we're expecting a positive move here after the wholly owned subsidiary of the company in Netherlands has acquired Vizu Pharma, which is a Netherlands company. They're mainly focusing on ophthalmology. So it's a positive acquisition that has come in for the company, given that they can further expand in the European markets. Vizu Pharma they've acquired this for around 190 million euros. When you look at it, it's around 12-13 times the EBITDA, so that's a positive there. The company is also highlighting that this is expected to be accretive in terms of overall the growth as well as the margin profile for the company. They'll be funding this through their existing cash on the balance sheet as well. Vizu Pharma, as of 2025, the expected revenue is expected to be around 54 million euros for 2025. 2024, the revenue was at around 48 million euros. So expected the CAGR growth is in the last 10 years is around 8%. Now it's expected to grow at 13% going forward. So interesting one for the company, giving them a further leg up in the European region as well as in the portfolio as well.
Okay, all right. Thanks a lot for that, Vinny. Well, let's hop across to Sonal as well, who obviously was on that holiday as well with Mangalam. Sonal, welcome back. Tell us what are the stocks you're tracking.
Thank you for that, Nigel. Well, I have 3 stocks on my radar. Let me start with Hikal. There has been a negative update there. Their facility at Bengaluru was inspected by the US FDA back in February. They earlier got observations under Form 483, and now there has been a Form 483 that has been issued to the company. It was issued back in August, and they have reported to the exchanges now. They also talk about the possibility of some revenues getting impacted of this. They will get deferred, and that is why this is a negative update which is coming by for this company. Paradeep Phosphates, because there is a commissioning of a plant, 1500 metric tons per day of sulfuric acid plants at its Paradeep plant in Odisha. Rosari Biotech, they had spoken about capacity expansion in previous conversations as well, and now they are saying this has finally been commissioned, the H facility with an additional capacity of 20,000 metric tons per annum. With this commissioning, the total installed capacity comes in into 1,52,500. Their material subsidiary, Unitop, which is an acquisition earlier, has also commissioned 15,000 metric ton per annum of ethoxylation capacity out of the total plant capacity.
Okay, all right. Thanks very much, Sonal, for that. Vamakshi is coming in as well. Azad Engineering, some positive news flow. PG Electroplast as well. Vamakshi, morning.
Good morning, Prashant. Let me first start off with Azad Engineering. This stock will be in focus because they've gone ahead and signed a long-time agreement with Mitsubishi Heavy Industries, which is based in Japan. Now, keep in mind that this is phase 2 of the contract. The first one was signed back in November 2024, and this contract is for the supply of highly engineered and complex rotating and stationary airfoils. Now, the contract is valued at approximately 651 crores, and this contract, along with the phase 1 of the contract, it has a combined value of almost 1,387 crores. So significant contract for Azad Engineering, resultantly going with the green for this counter. And take a look at PG Electroplast as well, because its arm PG Technoplast has acquired a 50-acre land parcel in Andhra Pradesh. This is in Sri City. Now, this is expected to be their first manufacturing facility in South India. They're putting up a capex of around 1,000 crores over the next 5 years. And the first phase of this capex, which includes 1.2 million refrigerator capacity, will be operational by 2026 of December. Now, site will also be designed to accommodate expansion into other products like air conditioners, washing machines, as well as some other home appliances. Bodes well for the company, green for this counter as well.
Okay, all right, got it. Vamakshi, thank you very much for that. So let's quickly recap our list of stocks to watch. The ones that have positive news flow would be Tata Motors, IRFC, Lupin, Paradeep Phosphates, Rosari Biotech, Azad Engineering, and PG Electroplast. Stocks with negative news flow would be Hindustan Unilever, HDFC Bank, and Hikal. Okay, so that's a stock list for the morning. Let's also find out what's the latest in the world of commodities. We have Manisha joining in for a roundup of the action. Manisha, good morning.
Morning, and thank you for that. I'll start with the crude oil prices, where we posted the best weekly gain, by the way, in 3 months. But after that, there's a bit of a profit-taking coming in right now. That is because Iraq, Kurdistan resumes crude exports after 2.5-year halt. You also are looking at OPEC likely to approve another output hike in its October meeting, which is this weekend. And then the markets also are looking at the risks to Russian supply and focus of those continued Ukraine strikes on its energy infrastructure. But what has continued to do very well has been precious metals yet again. Silver is now surging above $46 an ounce. It's $4 away from its all-time highs. Indian markets, in the meanwhile, are trading at an all-time high. We have seen September as perhaps one of the best months in many years that it has been. And with that, we are trading at 1,42,000 rupees a kg when it comes to silver prices there. Gold, couple of dollars away from its all-time highs of 3,791. Markets are looking at support continuing on the back of concerns when it comes to tariffs, the U.S. shutdown concerns, as well as we are still looking at those numbers or that meeting that the street will look for in sense of refinancing that debt, even if it's until by mid-November, is what really seems to be supporting. Also, when you look at the gold prices, this is the best annual performance that you've seen in gold with that 45% gain since 1979. The inflows into gold in the previous month have been at record numbers. The tariff uncertainty on pharma, medical equipment also seems to be supportive. And then the central banks' buying numbers for the month of September are expected to be very, very positive, supporting both of these precious metals even today.
All right, Manisha, thank you very much for that. And, commodities, of course, always got to keep an eye out on what's happening there. Brokerage calls of the day, and Nimesh is joining in with exactly that. What's making the cut? Nimesh, good morning.
Hi, morning, Prashant. A couple of brokerage notes one should take a note on in today's market. The first one is L&T. The entire street got excited on Friday because of that Hyderabad Metro settlement. But today, BofA Securities has downgraded the stock to an underperform from buy, and they have a target price of 3,700. The underperformance is large. The downgrade is largely because they believe that the recent outperformance has limited the potential upside from here on. In fact, remember the stock is up 10% in the last 2 months. Yes, Hyderabad Metro exit is earnings and ROE accretive. BofA has upgraded the earnings for FY26 and FY28 for 3 to 4%. However, going forward, the ROE expansion will depend on the buyback. They have $2.8 billion of cash and further improvement in margins and working capital, which looks tough in the current environment. The key risk, according to the BofA note on L&T, is the slowdown in the domestic capex as well as lower crude. So a big downgrade on L&T. The second stock is IndusInd Bank. On the valuation front, given now the stock is trading below one-time book, Morgan Stanley has to upgrade the stock to an equal weight from underweight, and they have a target price of 785. They believe that now with the CEO on board, there is enough clarity on the management bandwidth as well. And Morgan has kept the ROA targets for FY27, FY28 intact at close to 1% for FY28 versus just 0.3% for FY26. So an upgrade, a small upgrade on IndusInd Bank. And the last stock is Ethos. It's a cash stock. I understand there is a bit of delivery-based buying as well of late, but MK has written a note, and they believe it's the best proxy play on the luxury demand growth. They expect further expansion going forward. All the roadblocks seems to be taken care of at these levels. They see 600 basis points RSUI improvement over the next 2 years from here on, and at valuations at 40 times on FY27, it's attractive. So 3 notes: one, upgrade on IndusInd Bank, a downgrade on L&T, and a note on Ethos from MK.
Okay, all right, got it. Thanks for that, Nimesh. So we're going to keep all of those stocks on our radar as well. Need to take a quick break. On the other side, we'll be connecting with Dharmesh Kant of Chola Securities for some fundamental stock talk. Also, Ravi Menon of Macquarie Capital will join as the US has hiked the H-1B annual fee. We discuss the implications.
Welcome back. You're tuned in to Bazaar Morning Call. You're on CNBC-TV18. Well, we have Dharmesh Kant, Head Research at Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning. Hope you had a rocking weekend. Well, back to work today. Tell us, what's your take on pharma companies? You know, that bit of a scare that came in on a Friday morning from Mr. Trump, who says that, branded sales in the United States that are imported will attract a 100% tariff. Most of the Indian exports are generics, but yet the index pulled back to such a large extent, giving you a sense about how, sentiment is. What is your approach to these pharma names? And do you believe there's an opportunity that's emerging?
Yeah, good morning, Nigel. Thanks for having me on the show. And definitely yesterday evening was quite rocking with India clinching the title and that too in a style. So when I hope the market responds to your color of the jacket, that is green. As far as pharma companies are concerned, I think, see, if you look at Mr. Trump, he is just circling in rather than circling out or getting things negotiated mutually or bilaterally. So what he's trying to do is he's trying to create pressure from whatever direction he can and put more pressure on India to and accept the demands. I think after the Bihar elections are over, we can see some deal coming through. But as far as pharma companies are concerned, I think it's a void as of now. Let the things be more clearer. We see, more trouble coming into the space, going by the way things are happening out there. And therefore, we are not trying to, nibble into this kind of a correction in the market. Though there are many quality stocks which do offer a good valuation bargain buys out there. But let's wait it out for 1.5 months. I think it will be more of sluggish, volatile. You can have a trade, spike up trades playing out, but we are not looking for spike up trades as of now. It's better to avoid that rather than to jump the gun in.
Got it, Dharmesh. Hi, morning. Let's talk about these FMCG names. It's not a very promising start. I mean, what Lever is saying, flat to low single-digit growth in this quarter. How will you read it through? I mean, will the market look through some of this? Because the real benefit of GST will perhaps kick in once all the packages have been repriced and the new MRP product packs are out. So what do you expect specifically for FMCG in this quarter? How are you playing the sector? And a call on Lever itself.
Yeah, good morning, Sobe. I mean, if you recall our conversations earlier, we were very clear on the FMCG space, particularly the consumer goods space where the likes of HUL, ITC and all. We did not expect, good traction coming immediately, which Lever has reiterated. And going forward also, I think the consumption on the base level, it will be muted. It will be a single digit, mid-single digit kind of a volume growth. With price not going up and the GST has to be passed on. Eventually, as the macroeconomics, thesis suggests that it has to play out in favor of a broader economy. But what are the, economies which are likely to, benefit from this? We think it will be more on a consumer durable space rather than, fast-moving consumer goods. And there we think automobiles still stand a better chance compared to the likes of HUL. So, I mean, be it HUL, Britannia, Nestle and all, it will be a tough Q3 as well for them. And going forward, we'll see how things are panning out. Valuations are not cheap at all, but they used to trade at such kind of valuation multiples just because of the cash flows and the ROEs which they enjoy. But I think this is a market which is now becoming very constructive for a structural buy. Because if you look at equity risk premium, it's almost at a 10-year low. 1.41 is 1 year forward equity risk premium. And compared to bond yield, as of now, it's only a 1.65 basis point kind of a differential, which is now. So, I mean, earnings are quite attractive. We should be looking for growth opportunities. And there, I think where government is a consumer, you should be buying them. And the plays are very simple. It's defense infra, railway infra, and to an extent, banks and NBFCs.
The IT, Dharmesh, I'm morning. The IT index sold off some 8% last week, right? Stocks were down anything between 8 and 12%. Large caps, mid caps. Coforge was down 14%. Anything interesting there after the fall?
Yeah, good morning, Prashant. I mean, yes, there are interesting names out there. The very fact that Coforge and Persistent System had a very good correction. And these are the companies which are not directly a product company. They are more of a software services provider to a product company essentially based in US. I think these companies are likely to benefit, but let's see, as I said earlier, that Mr. Trump is circling in rather than, giving it a space. And who knows, I mean, if you want to tax, he's still beating around the bush to my mind. If you want to tax, you can just have a single layout at anything, any revenue generating in US, where the execution is enabled offshore can be taxed in US at certain like surcharge or cess, something like that. But he's not done that as of now. We think, see, Prashant, the very problem is such kind of a scenario brings uncertainty and undecisiveness both among the service provider as well as the buyer of the products in the US. Even they are confused whether to give a deal to an Indian company or not. And this ensures a shorter deal wins. So deal wins period will be shorter and you will have not a very clear vision as to the future profitability. So
No,
absolutely. Yeah.
Absolutely. This is something we discussed with Happiest Minds, Dharmesh, last week itself, that whether it'll elongate just deal closure cycles. Because you have to now discuss who's paying for the upfront cost, how much on-site, offshore. I mean, there's too much uncertainty around, offshoring at this point in time. In fact, let's take this conversation forward. This is exactly what we're going to be discussing with Ravi Menon, IT services analyst at Macquarie Capital. So much going on with the Indian IT services landscape. There is, of course, this H-1B visa, the 1 lakh USD fee that's been levied. And Accenture sounded a little, shall I say, well, muted with respect to their guidance last week as well. Ravi, great to have you in. Before we talk about any of this, actually, I want to start with the Hire Act because that's the next thing. Now, I don't know, I mean, are you assigning any probability of that becoming a reality, that companies that offshore work, they will be taxed at 25%? I don't know if you've even started modeling the impact of this, because this could be far more significant than H-1B, won't it?
See, this affects every single corporate in the US, right? And there is no distinction between whether they do it out of their GCC or whether they do it through a service provider. So I would think that affects entire corporate America, right? And you have even small supermarket chains who actually send work, and even they have GCCs now in India. So I think it's, since it treats all firms equally, I don't think this is something that we should really worry about. Seems unlikely. I mean, on one hand, you have tax cuts, and on the other hand, have a tax increase like this. I don't think that actually makes sense. So I wouldn't really worry about this, and there is no point in, I think, assigning a number to it, because there is not going to be a revenue impact or a margin impact from that, because it affects clients even if they do it themselves. The only question is there an alternative to doing work out of India? And so I think it's pretty much no. In fact, people who try to do it out of Eastern Europe, you're now seeing those or Latin America. Those companies now, you have them scaling up here, and India is their fastest growing delivery location.
Ravi, hi, morning. Let's drill it down to your coverage universe, Ravi. Where are pockets of value now? Or is it still very, very hazy and unclear ahead?
No, I think that definitely we are very much in value territory. I think that we've had a growth slowdown that I don't think anyone expected to last as long as it did. We still have probably a couple of quarters to go before things start picking up, but I'm more hopeful about next year's budget cycle. There will still be some verticals where I think the heightened uncertainty due to tariffs makes it difficult for them to embark on significant spending, like manufacturing, retail, even healthcare to some extent, because there is a lot of regulatory uncertainty. But BFSI, high tech, these are picking up. So I think next year definitely looks like a better year. And valuations are, I think, a lot of good value we had. I mean, last time we had HCL Tech, for example, trading at 5% free cash flow. In the next 12, 18 months, we saw the stock deliver more than 100%. We are at more than 5% right now. So I think that's very attractive. TCS again, now more than 4.5% dividend yield, very attractive in my mind. We're expecting significant margin expansion and an acceleration revenue growth for TCS to drive a re-rating over the next 12 months. That's our topic for now, TCS. That's a Macquarie marquee buy. And among the mid-caps, we like Persistent Systems and LTTS.
Right. Hi, Ravi. Good to see you in. And in fact, you're sounding a little bit optimistic, actually, on the space turning around. That cash flow yield is something that actually is supporting it. But I don't know, on a weekly basis, some sort of negative news comes in. My colleague Rima joins in and tells us about that. But you're sounding a little bit optimistic. That said, I think TCS is one of the top buys, right? As you briefly said. but they're not able to get to that band, that margin band. I think 26, 28% is what they're talking about. When do you think they get to that mark? And also, AI in the near term could be a bit of a challenge. There'll be a lot of investment going in there. It could be deflationary in nature as well. So comment on that. TCS getting to that band and the impact of AI on a company like TCS.
So first of all, I'd say that AI, I'm an AI optimist, I would say. I think of that as definitely revenue accretive. I think that it'll be margin neutral. There are companies like LTTS, for example, which actually believes that it'll be margin accretive as well, because they think they have a lot of AI-based platforms. They're going to change how they bill for revenue. I think that it unlocks actually a whole new opportunity of legacy rewrite. I mean, earlier it was very expensive and risky to undertake that. Now, and very difficult to make a business case, right? You're going to replace a system, an old system, with a new system written in new technology, but works exactly just like the old one. Very difficult to actually fund that, especially when it involves, multiple years of effort and a lot of money. Now that rewrite effort's gone down, the risk of the rewrite's also gone down. TCS last year showcased a framework that I called future-proof legacy modernization. I think that was pretty powerful. They showed a lot of investments actually in AI last year, and that's when I upgraded that to be my topic. We've seen them declare a rewrite project of mainframe with one of the North American banks a couple of months back. So you see that press release. So I think that that's a big opportunity that we're just starting to see the early signs of.
Yeah. Ravi, just very quickly, since you mentioned that you are expecting some pickup in spends, by when will it show up? And say for your big large cap pick TCS, just trying to understand what is the kind of volume growth, or say top line growth, that you would work with over FY27 perhaps?
So FY27, I think we would still be only like a 6 to 8% sort of range. It won't be going to a double digit. I think at the size of TCS anyway, it's actually very difficult to get a double digit unless the market's, firing on all cylinders, right? I mean, demand on for all the sectors improves. And I think by FY27, we will still not see that. Perhaps FY28, we could see that. So going back to Nigel's question of 26%, I think towards the end of FY27, we're likely to see that them return to 26% margin. Because I think the restructuring they're undertaking now, that will fund the wage hike for this year. But beyond that, I think margin improvement still seems difficult without revenue growth. So next year, when we have the revenue growth of at least 6%, 7%, I think that's when we can see margins expand.
Okay. All right. Good conversation, Ravi. Thank you very much. Helpful perspective there. You have a good day. Well, that's a view from a Macquarie coming in on IT services. Not all gloom and doom. They're expecting some turnaround in the coming quarters. We'll take a break on that note. On the other side, we'll have Sudarshan Sukhani and Mitesh Thakkar join in for some technical perspective.
Welcome back. The Ministry of Petroleum and Natural Gas argued for higher valuations for PSU oil and gas companies. My colleague Sonal is here with more details. This was, of course, Mr. Puri, who was in Mumbai, with a bunch of investors. There was media there as well. Sonal, tell us.
Well, yes, very interesting comments coming in from the ministry. They are pitching for higher valuations to come by for oil marketing companies. Remember, PSUs, especially the oil and gas space, always have lower valuations because of a lot of government risk, so to say. They highlighted government support, profitability and focus on operational excellence as well. Did indicate that, yes, there would be some time in terms of investor confidence. That is the brokerage view as well. Diesel crack gains will lower excise duty risk going forward as well. For JP Morgan, the preference is BPCL, then IOCL and HPCL. For Morgan Stanley, they say that they highlighted focus on improving market capitalization of energy companies. They are focusing a lot on capex, value unlocking as well, and they also reaffirmed stable energy pricing policy, which is very important. In terms of windfall taxes, they are saying no future windfall taxes will come in play, irrespective of what the oil prices are and what kind of gains these companies are seeing. They are focusing on strong IRRs for the entire universe as well. They're also talking about management pay, which should be around 15% linked to shareholder returns besides profitability, so as to motivate better shareholder returns to come by as well. Broader energy imports from US are beyond LNG and crude, according to them, and India's crude sourcing is focused on efficiency and economics. This is, of course, related to Russian crude imports. They're saying there are potential new discoveries that they're looking at in Andaman Sea, as oil recently announced as well. Jeffrey says that value unlocking could be prioritized from here on. In the past, we've seen a lot of it not going through as planned by the government. Government also has a plan for asking for sticky pump prices even when there are volatile markets going forward. Jeffrey says this implies periods of supernormal marketing margins in terms of profits, or marketing losses depending on crude price volatility. But yes, some interesting comments coming in on how they're focusing on better market capitalization for all these companies.
Okay, all right. Thanks a lot for that, Sonal. Not a sector for the faint-hearted. Dharmesh, you want to comment on this? There is a push for better valuations. It's a very, very tricky space to be in. We've seen in the past, you don't know what the government's going to do next. You don't know what the global scenario, how the global scenario is going to pan out. But what's your take?
Yeah, it's definitely a very tricky scenario, and it's a plea from the government to give them a better valuation, which definitely on the replacement cost basis is there. But given the macro way the things are evolving, at one side the government itself says that by 27 every vehicle to be sold on the street should be electric vehicles. So seeing that, putting that into context, so where do you see a volume growth coming for all these oil refinery companies? So more or less, it's as of now for next few years, maybe for 1 decade, they may be consistent on their profitability, but growth is what is a suspect out there, and they are a sunset sector to my mind with all this renewable energy push coming through. So I mean, it's a cyclical trades which one can enter into, but structural growth story for next 10 years, I don't see them coming there. So it's a void for us completely.
Okay, Dharmesh, good views there. We'll take a quick break. Have to do that. We're going to come back with a pre-open session. Sudarshan and Mitesh are going to be with us on technical trading ideas. We'll also connect with Harshad Kapadia of Elara Securities to discuss trends as far as capital goods go. Stay tuned. Coming up.
Welcome back. Just about 15 minutes to go. We are approaching 9 a.m. So good time to get in some technical advice. We have Sudarshan Sukhani as well as Mitesh Thakkar joining in. Gentlemen, good morning. Great to have you in. What a drubbing the bulls got last week. They're hoping for some relief this morning, if you look at what the GIFT Nifty has been doing. Mitesh, trades on the Nifty, anything at all?
Good morning, Subhi. So I think you were right. Last week was a slightly stronger surprise on the downside, and I'm not sure it's ended. I think, the entire week, the market kind of continued to decline. We had a gap down on Friday, and there was no attempt to fill that gap. And I think the earlier lows, which were, made in mid and late August, I think 24,400, 24,315 zones come into focus. I think that should be the next target area. What can obviously happen is a kind of a pullback for a day or two. But as long as we are not getting past 24,850, 900, I think the directional bias will be slightly on the negative side.
Okay, so need to be a little cautious. Sudarshan, morning. Let's get your thoughts in as well on the Nifty. Will you play for a pullback or a rebound at all?
Yeah, good morning. Yes, I would. For the last week, for 4 days, my suggestion was stay away. Don't do anything in the Nifty. And that seemed sensible because the markets kept on falling. And it's not easy to take short positions anyway. But today is a different day. There are two things that have happened. First, the Nifty is very close to a significant support level at 24,500. Now, should be anybody's guess. That support can break. Obviously, we can't forecast that. But it's at a support level where the buying idea is justified. And secondly, we have a mild gap up. That's a good thing to happen after many days. So I would suggest keep 24,500 as your stop loss. Look to buy the Nifty not at the open, not at a gap up, but at any minor dip that goes by. Keep it a short-term play. Don't expect that a new bull market is starting. Just look for some gains. That's all.
Okay. All right. Let's also talk about individual stocks. Mitesh, what would your strategy be with stocks?
I have a mix of buys and sells. On the buying side is L&T. The stock was buzzing in a weak market, made a fresh swing high on the closing basis. So getting past 3690, 3700 was the important point for the stock. So buy here with a stop below 3685. 3820, 30 should be the target area. Also buy on HPCL. Last 3 days have been the price has given a mild pullback now, close to the 10-day average. So buy here with a stop at 416 for targets of 435. And two stocks on the selling side. The first one is a sell on Biocon, which had a gap down break on Friday. So sell here with a stop at 345 for a target of 324 and 361. That's broken the support levels of around 1020. So keep a stop above that 1020 to 23 and look for a target of around 960.
Okay, all right, gentlemen, got that. Thanks very much for giving us some perspective. We'll come back to a little closer to market opening for some final ideas. For Sudarshan, sorry, beg your pardon. We didn't get to your stocks. So index you've mentioned. What about the stock list?
Well, it's also mixed. So IBL Bank is a buy with a stop under 266. It's been a relative outperformer, and we are Indians. We are always having courage. So Infosys is a buy with a stop under 1400. I have two intraday shorts. JSW Energy is an intraday short with a stop above 531. And RVNL, Rail Vikas Nigam, is an intraday short with a stop above 346. I would focus on the buys today.
Okay, all right. So focusing on the buys, and you're saying we're always bullish. We're Indians, so we like to look out for perhaps bigger moves. Got it. Thanks very much for that. Let's now get to that conversation on capital goods. There's been some chatter in the market whether the government's focus has now shifted to consumption, whether that means that it will no longer be as focused on capex as it has been in the past. Well, let's discuss this and more with Harshit Kapadia, Vice President, Consumer, Electrical Durables and Electronics at Elara Securities. Harshit, of course, tracks consumer durables, electronics, and also defense. So it's really a theme up your alley, Harshit. Where do you stand on the debate? The government, actually, to be fair, even in the interview to us, to Network 18, the finance minister said that there'll be no sort of shortfall on the promised capex targets for this year. But there still seems to be some thought around this, that the government has made a pivot from capex to consumer. Your thoughts, and should investors be worried when it comes to capex or industrial stocks?
Morning. Absolutely, you're right. There has been a stance change of government from capex to consumption, given the GST rate cut, etc. Other steps which the government has taken. But we don't think capex is going to drill down or it's going to be reduced. Maybe the growth rate may be a little bit coming down, but we don't think the absolute capex which the government is looking to spend across the public infrastructure sector is going to come down. Especially if you look at subsectors like defense is something where the capex is going to probably see among the highest increase. Even the defense secretary in one of the media interviews has mentioned this, that they are looking at around 17-18% growth. The overall capex may be, coming at around 10 to 12% is what we expect.
Absolutely. And, this entire transmission sector is where bulk of this is going to land?
Yes, so power is one of the biggest theme which is happening in the capex segment, and we see this continuation happening till 2030. And with this, the power equipment segment and the transmission, that is transmission and distribution segment, would continue to see the most amount of growth for all the type of products, from low voltage equipments to high voltage and even HVDC equipment.
There are these headline stocks, right, which of course have done very well, and there's a lot of focus there, Harshit. But are there smaller companies, lesser, like for example, there's a company which is into repairs when stuff goes wrong. I mean, that's what they do. That's all they do. But it's a play on this on the core theme of T&D. I mean, should one broaden the gaze beyond what is, of course, Hitachi, etc., well discovered, right? And a lot in the price.
Yes, I think that's what people are looking out beyond, because most of these big names, whether it is MNC or whether it is domestic companies, have reached a very fair valuation. So there is not much upside left for these names. Hence, people are scouting out for where growth is there, given this power theme is growing. So people are looking at small and mid-cap ideas in this particular field.
You want to run us through anything you have under coverage there in that segment?
So within this, what we have, probably not under coverage, but something that we have been keeping and tracking of, one is Quality Power. There is Elecon Engineering is another name. Apar Industries is something that we like within these subsectors. Azad Engineering is something which we like because it has both the dual themes of power as well as defense. So wherever there are two sectors where all things are growing, we'll see among the highest growth.
In terms of valuations, Harshit, I'm guessing these newer names or the smaller names that you mentioned, they perhaps offer more valuation comfort. But even otherwise, the biggies, your Thermaxes, ABB, and Schneider, etc. Just run us through the risk-reward valuation versus your expected upsides, and where investors perhaps would be better placed.
So among the MNCs, we still believe that Siemens India would still our preferred pick in this particular space. Valuations have come up from its heights, now trading somewhere around 40 times. Similarly, ABB is also there, but we think ABB will have a longer time because we don't expect margins to come back to a normalized level. That's where we think probably after second half, we'll have more clarity on the margins and stability. So I'll be a little bit worried on ABB, but not so much on Siemens India, given mobility is going to be a bigger game there. We also like Thermax and Cummins India among these cap good names. Thermax more on a longer term trajectory, Cummins on a short to medium term trajectory because the genset market is still growing in a very strong double digit is what we believe.
Harshit, finally, we've discussed power, and I think in the market as well, when we talk to a lot of experts, that there's no consensus on the fact that power, and especially T&D within power, is looking like a relatively good space to be in. Apart from that, since you are not negative on the capex theme overall, apart from power and power equipment, anything else to look out for?
So we were also looking at water-based projects as well, where we saw that there has been some awarding which has happened, and there has been government stance, especially on the state government side, who has been issues were there with the payment side has been softening. So that was something that we were looking into. Beyond that, we are looking at cables and wires, which is still a continuing theme, which is among the strongest theme apart from power.
Okay, I think we'll leave it there. Harshad, good speaking with you. Appreciate you joining us and, running us through a bunch of those ideas. So, not under active coverage, but Harshad did mention, especially on the power side, a bunch of names where, which he likes, valuation-wise, perhaps a little more reasonable and longer runways in that sense. 9-10 calls. I think Sudarshan and Mitesh are with us. Sudarshan, what do you have?
I have Infi, which is a buy with a stop under 1400.
Infi. Mitesh, what about you?
I'll go with a buy on Hindustan Petroleum. Buy here with the target of around 434, 435.
Okay, HP is the call from Mitesh. Infi is the call as far as Sudarshan goes. I think we're at the end of the pre-open session, so maybe it makes sense to take a quick look at where stocks are landing with regards to news flow, right? I mean, Tata Motors will come up. It's up about 1.6%. So, some relief, some backing from the government there for JLR. HUL, second quarter business update, stocks on your screen about 0.6, 0.7% lower. Some regulatory curbs, HDFC Bank, nothing very much. There's IRFC in focus, 3 loan agreements, 1%. Lupin, Hikal, Paradeep Phosphates, etc. are some of the other names which are coming through. There's also Rosari Biotech, Azad Engineering, I think has got a bit more in terms of traction. It's up 4%, and PG Electroplus is up about 1.5% as well at this point in time. Let's just look at the Nifty, Bank Nifty as well. So a quick look and then we'll move forward. 70 points higher, 24,730. And I think with the Nifty Bank, which is up about 71 odd points or so as well. Well, let's just focus back on the pharma space where there's a fair bit of news flow. Vinny is standing by with the spotlight on it. Vinny, good morning again.
Hi, good morning. So yes, we're keeping an eye out on the Nifty Pharma and overall Pharma pack. Now, do not forget, last week we'd seen the fall coming in, 5% fall last week for the Nifty Pharma. YTD also, there is a fall of around 8 to 10%. And why? Because of the uncertainty that is going on around the tariff. Now, the key triggers that we have are the announcements that came in over the weekend. One, obviously clarification that countries existing with trade deals with the US are exempt from the pharma tariffs or that 100% which they've spoken about. So that's the clarification. So the deal of US and EU, that is a 15% tariff on pharma, right? So that is still in existence. Now that means that is a positive for Sun Pharma. They have a branded specialty portfolio that makes up to around 19% of their total sales, so some bit of that respite for them. Now other than that, most favored nations, that's an update that's coming over there, or we are waiting out for this week in terms of for these most favored nations, what is the tariff over there. China also said that it will remove 30% import duty on Indian pharma products, though we do not have much exposure in terms of export to China, but still at least sentimentally that is going to be positive as well. Now Morgan Stanley has written a note on this. They said the EU-made drug exports to US could continue to attract only 15% tariff. Obviously the most favored nations update is going to be key to watch out for. And China, which has reduced the 30% import duty for Indian pharma, is incrementally positive, though China is not highly competitive in terms for the export market for Indian companies, and they have their own generic players as well, though that will be positive for Dr. Reddy's given it has a larger EM share or China share as well.
Okay, all right. Got it, Vinny. Thanks very much for that. Getting back to Nimesh. Nimesh, which is the name that you're watching out for?
Hi, Surabhi. So the stock that I'm focusing is L&T. Well, the street got excited on Friday on that Hyderabad Metro settlement. But BofA today has downgraded the stock to an underperform from buy, and they were target price of 3,700. BofA believes that after the recent outperformance, there is a very limited potential upside from current levels. Remember, the stock is up 10% in the last 2 months. Yes, Hyderabad Metro exit is ROE and earnings accretive. They've upgraded the earnings by 3 to 4% for FY26 to FY28. However, further ROE expansion will depend on the buyback. They're sitting on $2.6 billion of cash, as well as improvement in margins and working capital, which looks tough according to the BofA analyst. Now, the key downside risk for the stock would be the domestic capex is losing steam, as well as lower crude prices. So these are the two risks. But given the recent outperformance, BofA has today downgraded the stock to underperform with a target price of 3,700.
Okay, all right, Ramesh, thanks a lot for that. So that's the stock in focus, L&T Tech, L&T. Well, keep an eye out on Vascon. They have signed a 5-year MOU with Adani Infra as an execution partner for selected projects. So because of that big name, tie up with the big name, that stock is up close to 7%. It's been a relative underperformer, but they are saying that 3 projects totaling 13.15 million square feet in Mumbai have been identified. So that explains why that stock is up. It was lower in Friday's trading session. It's been an underperformer, but this announcement came post-market hours, and that's why that's one of the big gainers today.
I think we are just hitting market open, and we'll just sort of stay with prices, look at where we land as far as 9:15 market opening goes, and we'll pick it up from there. 70 points higher is where the Nifty ended in the pre-open session, and the Nifty Bank ending with, okay, I think we're just kicking off. First rate starting to come through. What do we have? 50 points, 24,700 on the Nifty. The Sensex is coming up with a small amount of gain, about 1/3% basically. The Nifty Bank is up 0.12. Small caps and mid caps, I think a little better. 0.4, 0.5% of the mid cap and the small cap indices is what you have. So across the board, you've got Eternal, BEL, Tata Motors, Dr. Reddy's, Mahindra & Mahindra, which are the big gainers. And on the downside, you've got Lever, L&T, Sun, which are coming up with some amount of cuts. So 7 or 8 names are lower and the rest are higher at this point in time. So 24,710 is where the Nifty sits now. Surabhi.
Okay, 60 points or rather 55 points higher. Let's look at the winners. Eternal, BEL, Tata Motors, thanks to some relief coming through from the UK government for JLR. There's it's very assortment of stocks actually. Cipla, there is Shriram Finance, Geo Financial. So there are no clear sectoral trends. Just a bunch of stocks that are moving higher. The Bank Nifty is very, very flat at this point in time. On the lower side, it's the FMCG pack, consumer and FMCG. HUL's guidance, or rather their outlook for the current quarter, flat to low single digits growth. That's kind of spooked sentiment out there. So Lever itself is down 1.5%. The others would be Asian Paints, Nestle. These are some of the names on the downside. HDFC Bank as well. The Dubai action. It's not material. The bank itself has said it's not material at all for the P&L. But there's some red on HDFC Bank as well. Overall, the Nifty is now beginning to drift a little bit on the lower side. 30 points up. Nigel.
Well, a few stocks actually that deserve special mention. Suntech Realty, they've launched an ultra luxury project worth 20,000 crores of GDV under its new brand, Immense, and they are talking about, I think, 2.5 lakh rupees per square foot. So, there are 2 projects that have been identified. One is the Nepean Sea Road project that's got pushed back quite a few times, and the Dubai project as well. So, Street has taken heart from that. That one has bounced back. Another one is Religare. I'm not sure what's gone on there, but the stock has opened up, gap up on large volumes. So that, in fact, had gone to around 300 rupees, then it corrected. Actually, now it's cooled off. In pre-open, it was up. So, that one's not really reacting. Tejas Networks, I think, let's pull that one up. Yeah, that one, in fact, is still holding with gains. Another stock that's corrected from more than 1,200 rupees to 600 rupees. And initial volumes are quite large on that name. So that's why that stock is up and about in today's trading session. Saman Capital, we highlighted that. It's expected to come out of the F&O ban. That's what has happened, post Friday's close. And Saman Capital is a stock that's actually up close to 4.5%, one of the top volume movers. And the other one is Vascon, with that tie-up that we have seen with Adani Infra. We'll have to see how the execution goes out. But for the time being, gap up 10% higher on that particular name because 13.15 million square feet in Mumbai have been identified for design and execution. So that's why, in fact, that's flying away.
Lots of stuff, right? Right out of the gates, 1,200 higher and about 1,120 stocks are lower right now. Put up, if you can, the Silver Bees. Silver Bees, 4% pop on Silver Bees, the ETF. So 138, 139, I don't know if you have it, we should pull it up. But large amount of volumes coming through as well right now. Okay, Tata Investment Corp is the number 1 volume-led gainer. It's up about 3.5%. Saman, I think we mentioned, back at about 144 or so. Tejas Networks is a bombed-out name and 5% higher this morning, 617, 618. Walcott, we had the management with us late last week, 2.5% there. So Walcott sold off hard, right, on Friday, and it's seeing some amount of recovery, which is coming through. Avas Financiers, Reddington, Suntech is up about 7% as well. So it's even Stevens. I mean, it's too early to look at market breadth and make any conclusions, but for now, it's about 1:1 in terms of what is up and what is down at this stage. Lemon Tree is coming up with a 2.5% cut. Yatharth Hospitals, Intellect, I mean, some of the stuff which is selling off as well. GK Energy is down about 3% or so. And of course, the number one volume-led loser is HUL, which is coming through. Not very much left, by the way, on the Nifty. 25 points, but this is still within the first, 5 minutes of market opening that we are tracking. Well, Pratik Gupta is CEO and co-head at Kotak Institutional Equities. He's with us now to talk markets. Pratik, great to have you back on the program. Thanks very much for your time. So last week, about a 3% cut on the index, and selling continues. Rupees closer to 90 than we've ever been. What will cause a bit of a turn here, or will it just be markets overextended, which gives us occasional bounces, or anything durable is still not really visible in that sense, Pratik? I mean, in terms of a turn for the better.
Good morning, Prashant. I think overall, as we mentioned and discussed the last time as well, we believe the market is still in a sort of range-bound zone. I was using the phrase liquid oxygen the last time, but basically, we've got expensive valuations still, although the valuations have become less expensive, but they still are still quite expensive. Earnings growth this year is still quite weak. We're expecting at Kotak about 8 to 9% earnings growth for the Nifty this year. But in terms of your question as to what could change things, first and foremost, obviously, is the uncertainty about the trade deal with the US and the extra 25% tariff which is out there. If you get some clarity on that, that could definitely help. But I think the bigger fundamental reason would also be the earnings outlook, which this year has been quite weak. But in FY27, at Kotak, we're projecting about 17% earnings growth for the Nifty. And this is fairly broad-based. A lot of sectors are going through a very weak sort of earnings outlook right now, whether it's the banks, the consumer, the IT companies. So most of these sectors should start recovering and showing better growth next year, apart from other sectors as well. So that coupled with, I guess, also India has been a massive underperformer versus most other emerging markets. Just to give you some numbers, the MSCI EM index is up some 24% year to date from January till now, and India is actually down slightly. So therefore, to that extent, most global investors are also sort of uninterested in the market right now. Hopefully, as we see perhaps a little bit more time correction or a little bit of price correction, we could see the foreign flows coming back in as well. And as I said, the clarification or the removal of the uncertainty around the trade deal and better earnings outlook next year, these two should be the main drivers of the market going forward.
Hi, Pratik. Yes, we remember liquid oxygen. How can we ever forget? But when you say the drivers for the next move, then what are we talking about? What kind of market are we now entering? Say, very soon it'll be Diwali, so we talk about the next Samvat. Then is it going to be a headline level ranged market in best case? You keep looking at individual stocks, or do you think that if that trade deal gets signed, then there could be sort of a stampede to rush back in? This FPI exodus could perhaps turn into a reverse stampede inside. And then it could be that high momentum market that we've all seen in the past.
So as far as the trade deal is concerned, we think the removal of the extra 25% tariff is largely priced in. I mean, most folks we speak to are anyway expecting that to go away. And also, if you look at the market behavior from the time it was first announced, we haven't really come off that much. So that in itself may not be enough. That'll be a mild positive, but not enough to move the market meaningfully. I think the change would come only if we really have something happening on the baseline tariff of 25%. If that comes down to a more attractive level of somewhere in the 15 to 20% range, that could make things a lot more attractive. Second is India is also in the process of signing trade deals with Europe and with other countries. So if that progresses in the next few months, that could help our export engine going as well. But and I think the other point is, as of now, there's still a little bit of skepticism around the consumer side recovery, while yes, everyone's expecting festive season recovery helped by the GST rate cuts and the income tax cuts and the RBI rate cuts, etc. But let's see how the season pans out, the October to December quarter. So if that is really indeed very good, then we could break out of the range. Otherwise, I think, unfortunately, we are going to be stuck in this range for some more time until we see very clear signs of strong demand recovery locally, and the valuations have also corrected a bit more.
Hi, Pratik. Good morning and good to see you. When the problem is the markets get a little bit stable, or even an ounce of buoyancy, you see these big IPOs hitting on, and a lot of fund managers were struggling to make it for some of these IPO meetings because there are so many. And then, in fact, the focus on the secondary market goes down a little bit. Do you think this is becoming a bit of a challenge? Supply of paper, we've got a couple of $1 billion IPOs that are coming up in October itself. Some are cheering it. I'm a little fearful. That's sucking out the liquidity.
Well, firstly, yes, we are seeing a lot of interest in IPOs, but that's keep in mind they're still largely being driven by the local institutions, both mutual funds, insurance companies, retail, and HNI. The foreign investor participation in IPOs, most IPOs, is relatively limited. It's come off quite substantially compared to a few years ago. Second, I would say, while the IPOs do act as a drag on the market, and they're sort of a headwind for the market to go up, but bear in mind, the IPOs will happen only when there's strong investor interest and there's a reasonable pricing out there. So the IPOs in itself cannot prevent the market from going up. If you start getting good earnings, if the trade-related positives come through, if you start seeing very strong festive demand, then I think we'll have both IPOs happening and the market going up. The supply of paper in itself is not necessarily something which will cap the market forever. That's definitely a headwind for the time being, and that's another reason why we're saying in the short term, given that we don't have a breakout story as yet, we will sort of stay range bound for the time being.
Got that. Pratik, across, and you got the research team, when you speak to them, right, in the respective sectors, is there any feedback to how these GST cuts have been, what's the pickup across segments? Is there a sense, any sense? Some will start to report these pre-quarter numbers, monthly numbers, etc., so we'll get a sense, but anything you can tell us?
Well, firstly, the September quarter in itself is trending to be a lot weaker than I think what people would have expected back at the end of the June quarter. So you could see a modest round of earnings downgrades for the year as a whole, although obviously there's hope that FY27 will be a lot better. So that's point number one. As far as the GST cuts are concerned, it's still a bit too early, but the initial responses, the auto sector is seeing some pickup. Staples, also there's been some little bit of a pickup, but it's more the low ticket discretionary items where we'll see some uptake, but it's just been barely a week. So still too early to say. We'll find out more in the next 15-20 days, I guess.
Pratik, slightly maybe off tangent, let me ask you this. Obviously, this market is hungry for ideas on tech, right? New tech, basically. Now, whether it's EVs, whether it's semiconductors, and we only have a handful of stocks to play over here. We'll be speaking to one of the companies, Keynes, in just a bit from now. And then you have, on the EV side and the solar side, you have a couple of, solar cell manufacturers as well. Now, when it comes to new age technology, there's Mostip. I mean, and look at how some of these smaller stocks have done. I think Mostip is trading at some 200 times price to earnings, just because there is such scarcity. So what would your advice be to investors? Because these are very fanciful themes. Everyone wants to have their hand in the pie. But could it be, getting a little tricky now?
Yes, that's definitely a concern right now. In fact, just to step back for a minute, one of the reasons for the low foreign investor interest in India is there's a perception, or in fact, it's probably a reality that India has really not kept up with the AI boom that's going on globally. It's really the US and China, to some extent, TSMC in Taiwan. India doesn't really have a big AI play. A lot of these companies are very small, both for global investors as well as for our large domestic institutional investors. So which is why you're having some of these stocks trading at very, very expensive valuations. And honestly, it's still too early to see whether these will play out. This is also true of the US, by the way. This is not unique to India, but India even more so, because we're not the original large language models or the direct plays over here. So here there's a lot of hype. Our advice would indeed be careful. These are sort of concept plays, carry a lot of risk. So leave it to the institutional investors or the experts who know these stocks, who can figure out the valuation, take some risks, but they are not for the average investor in our view. Most of these stocks are trading at fairly expensive valuations.
Point taken. Anantraj, by the way, is up about 3.5% This is another one of those names which has done phenomenally well. I think it was $500 10 days back, at about 700 now. Not even 10 sessions, so that's gone up like a rocket. Walkhard is up about 4%. 361 is up about 3.5% or so. So a fair bit in focus. NetWeb, by the way, is now the biggest volume-led loser. So that's another one of those names which we've been talking about. It's done very, very well. 30%, by the way, this year. NetWeb, after a phenomenal 2024. So that's where we are at. Prateek, what else? Any other interesting themes? Any other ideas? Any other, just what you are focusing on? Any IPOs which you think are going to be interesting ones up ahead? Some 20 IPOs opening this week, smaller ones, and then there are bigger ones as well.
So I think as far as ideas are concerned, what our view is, this is a tough economic environment, a slow-growing environment. You've got the trade-related uncertainty. One still doesn't know how it'll pan out and how much longer it'll take. Valuations are not necessarily in your favor. We've become less expensive, but we're still expensive. The Nifty is trading at about slightly over 20 times 1 year forward, still at a 45% premium to the MSCI EM index. So we're still not a cheap market. So therefore, continue to tread with caution. Look for those opportunities. Fundamentally, what we are saying is, stick to large caps versus small and mid caps in general. There are obviously exceptions, but generally, and in fact, you'll see last couple of weeks, whenever we've seen very heavy FII selling, it's the small and mid caps which have come off even more. This happened last week as well. So one general trend we would say is stick to large caps versus small mid caps, at least for the time being, until we have clarity that we are past this hump of slow economic growth. And second is, look at sectors where valuations are still somewhat in your favor, or where you have very strong earnings visibility. So valuations in your favor, that would really be, frankly, just the banks, the large private banks, some of the large PSU banks, some of the NBFCs, which will benefit from falling funding costs. So that's one category, or insurance, life insurance in particular. Or go back to the smaller sectors like, hotels or airlines, or the hospital plays, the diagnostic plays. Those are the sort of industries we still like in this sort of an environment where, the underlying demand is still strong. And last theme would be, given the global uncertainty, given the likely trade-related slowdown globally, stay away from globally oriented companies, whether it's the IT services companies, we've been cautious in that segment for a while, or the export-oriented pharmaceutical companies, or the auto ancillaries which are exporting. So keep your portfolio a lot more domestic focused. We don't think it's time yet to go back into a global-oriented portfolio.
Okay. All right, Prateek, good conversation. Thank you so much for joining in, and we'll keep all of these points in mind. You have a great day, and we'll connect again soon. Well, a quick glance back at the screen. Let's figure out what the Nifty is doing. It's kind of stabilized, and now it's about a 60-point up move, so not bad. The lows are seeing some buying. No such luck for Hindustan Unilever, by the way. The stock's now down 2.5%. After the kind of guidance the company has given out for the quarter. In fact, let's bring Mangalam back in. Mangalam, everyone was hoping for, that bumper move to start in FMCG, but maybe not this quarter?
Well, maybe not this quarter, and in fact, that was something that the street was already anticipating because the second quarter was expected to be a bit of a washout. We spoke to the management of a lot of the consumer companies as well. They said a couple of reasons. One, there is the GST transition that happens, and most companies, remember, it's the last few days of the quarter where excess sales happen. So this time around, because of the transition happening from September 22nd, those sales are taken out, and there are trade-related disruptions, which will make the way for newer MRP, lower MRP stocks to hit the streets very, very soon. But there was that temporary disruption that was expected. The second part was there was also heavy rains in large parts of the country, which were flooded. So there too, demand was impacted. The reason why the stock is lower in today's trading session is because despite them, giving an expected second quarter update, what they said was that they expect a recovery only starting in November. And this weakness may continue into October as well. And from an FMCG standpoint, October is very important because it has both Dussehra as well as Diwali. So a lot of the festive season buying that takes place, if that stands to get disrupted because of this, maybe, the most important month of the year will have some sort of growth problems. Even though there is recovery from November, and there are a lot of positive triggers for HUL in terms of new leadership and the underlying improvement in consumer sentiment, beauty and wellness doing well, the fact that October would be impacted has the street a little more worried than it should be, and which explains why the stock is the top Nifty loser today.
Okay, all right, Mangalam, thanks a lot for that. Well, let's turn our attention to the metal space. And to help us out with the outlook on copper, we have Mr. Sanjeev Kumar Singh, the Chairman and Managing Director at Hindustan Copper, who joins us on the show. Hi, sir. Thanks a lot for joining in. Well, coming to you in just a bit. For the time being, just highlighting to our viewers the three big points we're going to focus on. One is the closure of the Grasberg mine in Indonesia. How will copper demand-supply dynamics play out? Point number two, the outlook on copper prices and how much is the sensitivity of the company's EBITDA to global copper prices? And finally, the scale-up of the copper capacity. They are talking about scaling up by 3 times in the coming years. To help us out with all those answers, we have with us Mr. Singh, who joins us on the show. Good morning, sir. Thanks a lot for joining in. Well, your shareholders are thumping the table. They believe that time has come. One of the biggest outperformers in this month itself. Now, let's understand a couple of facts, sir. Given the closure of the Grasberg mine in Indonesia, how do you see the copper demand-supply dynamics playing out? If you could help us out with that. Will there be a crunch, say, till 2027 odd? And also, what does this mean in terms of a pricing outlook? Please go ahead, sir.
A very good morning to you and all the investors who are watching this channel. The first question which you asked about the Grasberg mine, definitely it is one of the biggest mines across the globe. And the supplies have been affected because of that incident, that failures. And it will continue for this year as well as for the coming next year, as we have seen from the news. Thing is that since this is one of the biggest mines, so definitely the supplies will be unconstrained. And across the globe, there are other disturbances also which will make the copper supplies in a tight position. So definitely in the coming 25, 26, the copper prices will remain quite tight.
Okay, all right. You want to give us a number, sir? Last time you told us you expect copper prices to remain in this range. From there, the prices have gone up by nearly 5% or more. So give us a broad band, sir.
It's very difficult because, see, this is a very unforeseen incident which has taken place at that big mine. So these things I can't predict. But since the demand is quite high across, I told you in the last interview that the biggest user of copper has become the AI's data centers. So the demand is increasing. So this demand will push the prices. Rather, it will hold the prices, I should say.
Okay, got it. All right. Could you give us a few more details? What are the selling terms on copper? How much of your copper is sold on spot? Is it a quarterly contract, a half-yearly contract? Is it an annual contract? Could you break that sales mix for us and also give us a sensitivity, analysis? Your EBITDA, how much of it is linked to global prices? Or if you could give us what is the cost per ton that you mine of copper?
See, as far as our saleable product, that is MIC, which we call metal in concentrate, is all on spot. And this is an annual tender. We float the annual tender and it's supplied on the annual basis. So it is completely on annual basis, nothing on quarter or 6 months basis. And secondly, the EBITDA margins, which you had asked last time also. And I had assured you that we'll try to keep and maintain that EBITDA margins, keeping our operational efficiencies and expenses in control.
Okay, got that. But now, sir, what is the cost per ton? If you could tell us, for a company like yours, because now with the prices moving up, your cost in all probability will stay similar, but your EBITDA per ton actually will move up. So you could give us a ballpark number of $5,000 per ton, $4,000, $6,000 per ton, because various costs like employee costs and other costs will not really go up, right? And that's how the operating leverage will play out. So give us a brief number, sir, on that front. Cost per ton.
Yeah, number one, our cost is quite competitive if you compare across all the producers of the world. And it will remain in the range of, say, 5,000 to 6,000. It will not go up. Definitely, it will not go up because, as you have rightly said, things are in our control. So it will be in the range of $5,000 to $6,000 per ton. You can say it will be around $5,500 per ton.
Okay, got it. So in that case, sir, can your margins do even better? 40% you've managed to scale it up to. You've been in that vicinity, late 30s, early 40%. But if copper prices have moved up, do you think that there is possibly a surprise around the corner? Your investors are hoping for that. Can you scale margins by 100, 200 basis points? Point number one. And your volume guidance, you stick to that 15, 20% volume guidance, or do you want to up that as well?
No, so number one, if the prices remain as it is, as you have mentioned, definitely our revenues will go up, no doubt about it, because these are the external factors which are helping us. And as far as volumes are concerned, definitely we'll try to maintain. I told you 4 million tons plus will be the ore, and 30,000 ton plus will try to produce this MIC, that copper concentrate. The only negative factor which is with us is the monsoon, the advanced monsoon, and the monsoon which is still continuing even in the month of September, and which we have expect to continue in the month of October also. But we'll try our best to maintain the production levels in the third and fourth quarter.
Got it. All right. And there could be a positive surprise on margins, right?
Margins, because see, these are the external factors. It's not in my hands. The prices have.
The monsoon is done now, sir. Operating leverage will play out. You have better prices as well. So the street will be hoping for that. At least we have got one number out, that $5,500 per ton roughly is the cost of production. So we can work approximately with that. Also, yeah, what about, sir, the other big talking point is you're going to be increasing capacity from 4 million tons to around 12 million tons. Yes. By FY31. How much of this incremental ore production will start coming on? For this year, you're saying 4 million tons. On a year-to-year basis, how does it move up?
See, in the last 2 years, that is 29-30 and 30-31, you'll see the maximum growth because all the infrastructure will be there and all those mines which are being reopened will start giving the results. In the last time also, I had mentioned the mines which were closed for, say, 2001 July and all that. They have started, they have been reopened in the last week, and another mine will be reopened in the coming month, that is October. So they will start giving the results from the next year onwards. So from 26, 27, 27, 28, you will see a substantial jump in the production of ore and subsequently the MIC also.
Okay, all right. Just a quick question, sir. Have you heard from the divestment department? At one point of time, Hindustan Copper was a candidate. Now, with copper being the new gold, as most on the street are saying and most global commodity analysts are talking about it, do you think the government could be looking at taking some money off the table, maybe do an OFS, possibly divest the company on the whole? Is that a possibility? Valuations are not cheap, sir, from a stock market perspective. But the street is optimistic on the way ahead. So do you think you've got that phone call to say that probably there could be something on the cards?
Nigel, I don't have any information on this. Only thing I can substantiate it, there's a government of India and all the respective state governments, whether it is Jharkhand, Madhya Pradesh or Rajasthan or Chhattisgarh, they are supporting us like anything. So with this government support from the center and state, we are moving ahead. I don't have any information of the divestment.
Okay, all right. Besides that, you'll have the tailwind as well. And something that the market likes is you're communicating with part of the street as well. Otherwise, you don't get too much information on Hindustan Copper. We are happy to have you on the challenge. And in fact, the sell side as well has been interactive with you also. That's good news. Let's talk about another aspect. 2,000 crores of capex, right, is what you've laid out for the next few years. All will be from internal accruals?
Yes. We have It will be from internal accruals, and we have already, from the board also, we have got the approvals of the QIP and even the bonds also. We have already taken the approvals from the board. In fact, I mentioned in the last interview.
Yes.
So there is no issue about this. And we have maintaining a proper debt equity ratio also.
Okay. Possible then we hear about a QIP soon?
No, not QIP. We don't need for that. We already have an approvals for that, I mean to say.
It's just an enabling resolution. It's just an enabling resolution, sir. You have just taken the approvals. You may or may not tap the market.
Yeah, we may or may not.
All right. Final question, sir. Before we let you go, from a stock market perspective, ye dil mange more, right? They want to know what else besides copper. And you all have been talking about the rare earth mineral opportunity as well.
Yes.
Could you tell us what is the progress on that front? By when do we actually start? Because now there'll be some capex that will have to be spent. You'll have to get allotted a block as well. By when? How do you see this panning out? What is the progress on this front?
See, exactly, we can't mention the time frame, but you must have noticed that we have got an MOUs with all big companies. The last one was with Oil India. And in that Oil India, we are very particular about the two mines, which is one is in the Arunachal Pradesh, that graphite and vanadium, and the other one is the potash in Rajasthan. And since we have the expertise of hard rock mining, we are the one of the hard rock miners of this country. We have already joined hands. A team has been framed at Hindustan Copper, which will be visiting very soon, and we'll be taking up that mining operations on a jointly basis with Oil India. So that is one start of that. The others, we are already started participating in the auction process. You must have heard about it. And all these MOUs, whether it is with Coal India or Indian Oil, GAIL or RITES, our partners are already interacting with our nodal team, which is here, and they are doing the due diligence internally also. And we have already started. You must have seen in rare earth projects also, we had bidded, and in continuation to that, we'll be moving ahead. In fact, we have about the blocks of in Chhattisgarh also, which are we have got the approvals of the NMET, and we'll be moving ahead with the exploration. Our main focus is now with exploration in majority of our own properties as well as the other properties also.
Okay. All right. Mr. Singh, we appreciate you joining in here on CNBC-TV18. Explain to us how the demand-supply dynamics are playing out globally with regard to copper and your objectives as well for the company. We look forward to having you back on the show, sir. Post your Q2 numbers. Then we can get the outlook for the second half of this fiscal and the path ahead as well. For the time being, the street will be happy about good times for copper prices. Well, for the time being, we'll slip into a short break. But on the other side, we'll connect with the management of Kaynes as the board has approved the redesignation of Mr. Ramesh, the MD, as the executive vice chairman. That conversation coming in on the other side of the break.
Welcome back. The market's managing to hold on to the green, 24,750 thereabouts. That's where we have reached on the Nifty. But we're going to keep it with corporate conversations for the next couple of minutes as well. The next company on our radar is Kaynes Technology. Now, the company has seen a few leadership changes in the last couple of days. CEO Rajesh Sharma resigned to pursue quote-unquote opportunities outside the organization. This is effective from the 31st of October. The board has redesignated Mr. Ramesh Kunikanan as the executive vice chairman for the residual term. He's part of the promoter group, the promoter family. Well, let's discuss this and, of course, the company's business outlook. We have Jairam Sampath, Chief Financial Officer at Kaynes, joining in. Mr. Sampath, always a pleasure to have you in. Of course, we keep talking business like we did last time as well. But first, let me just understand the organizational changes. I believe Mr. Muthukumar Narayanaswamy, he has been designated as the MD. I'm not quite sure who takes over the role of CEO. Is that post yet to be filled, or will it be Mr. Narayanaswamy? Basically, who's responsible for the day-to-day operations of the company? Can we just get some clarity on that?
Oh, sure. Good morning to you all. So basically, as the company grows, we are just preparing for the next level. And we needed some more bandwidth at the senior management level and the holding company. So Mr. Muthukumar takes over as managing director. Basically, his focus will be in the areas of operational excellence and making sure that company functions, all the other processes work, and so on and so forth. Mr. Ramesh Kundikanan, who now takes over as Executive Vice Chairman, he continues to look at all the subsidiaries and all the key customer interactions and all the new projects, etc. You will, of course, once we complete the exit formalities for Mr. Rajesh, you will see some more changes being announced, and they are likely to be, at this point in time, not at liberty to tell you, but certainly we are going to have some more changes, and there'll be a replacement CEO also coming in by at an appropriate time.
So there will be a CEO announcement, you're saying, at an appropriate time.
Yeah.
Will this individual be an internal or an external candidate?
Wait and see. I think most probably we normally know the people before they take over the job. So obviously he'll be a known entity, and we'll come to you. Just give us a week's time.
Mr. Sampath, will you step up?
I'm glad Prashant asked that question. I was hesitating.
Possible.
So I just wanted to also tell you that, see, basically this is all for augmenting the capacity within the organization. And also, we have now made big plans, we are now...
Sorry, I missed that. What the response I missed. Will you step up?
I am hardly the person to comment on that. This has to go through the various processes within the company.
Okay.
There would be a board meeting, and then there would be also other deliberations and so on.
Okay.
So, yes, of course, people like me are always available. That's not the issue here, irrespective of what we are designated as, or we are all long-term employees here. I've been here for about 15 years. And so lending a shoulder to some additional tasks is not a big problem. No, just wanted to clarify this entire thing. Basically, we are trying to augment the capacity at the senior level. So that the promoter, founder, and Mr. Ramesh Kundikanan, who has been spearheading all the expansion plans, is also having time to do all of those things rather than getting weighed down with operational activities, which is also very important.
Yeah.
So that's why this kind of changes. Of course, it's not related to Mr. Rajesh's exit, because Rajesh's exit came as a surprise. He's been here for about 4 years, but due to some personal reasons, he had to, and then we obviously couldn't prevail upon him to stay back. And as a large organization, what happens is that over time, there will be exits and there will be new entrants. And probably we are having more new entrants and fewer exits. Hope that trend continues, because we are likely to gun for this $2 billion by FY30. So beyond that, also, the organization has to sustain its growth and profitability. So you will see some more appointments in the senior management cadre.
Okay.
Specifically looking at all the key aspects of our businesses. And as you know, all the subsidiaries and all the new businesses, they have their own independent CEOs, and they are autonomous and they are linked only to the corporate in terms of the value systems and any other health.
So one thing I wanted to, Mr. Sampath, one thing I wanted to ask you specifically was this business of OSAT, right? For example, you tied up with Infineon, A&O. These are all sort of global firms in that sense. And when you're entering these kind of relationships, of course, they're entering partnerships with companies, but the person front-facing in that sense matters. So will there be a transition period? Everything, all this remains on track? I mean, no change at all? Because this was all
absolutely.
announced recently in the first four days of September.
Yeah, so we do have some kind of a double or triple redundancies in our relationship management with the key partners, key customers, and key suppliers and so on. Typically, it's not one person who spearheads, but there'll be at least a group of 2 or 3 people, and that has been the case even in case of Semicon. So when we talk about Infineon, of course, Mr. Raghu Panikar is the guy who spearheads this entire activity, but then there are other people within the organization also who are familiar with the activities and commitments made and so on and so forth. And see, it's not just for the exit, but even sometimes temporarily for a few days, people are not available. So that point in time, we do lean upon the other people. So it's, let's say, concurrently operating people, about 2-3 people are generally involved in every relationship. Because the services industry, we have to be sure that customer is serviced nevertheless. So it's very important to have some redundancies within the organization. It does increase the cost a little bit, but in the growth phase like this, I think it's worthwhile having that, especially when we're expanding into newer territories and so on and so forth.
Mr. Sampath, exactly on that. I mean, growth, I think this is a good time for you to recap for all your shareholders, for the market overall, the current capital allocation policy and, how much you're planning in terms of capex or investments for each of the individual businesses, and whether that could be subject to any change as new leadership comes in. And in that, just give us some idea of the current cash in the company, because some have argued that cash flow from operations has been an issue. I'm not sure if you'll turn cash flow, in terms of cash flow from operations, whether it will be positive this year or not. You've done QIPs in the past. So just reiterate the current blueprint for investors.
Yeah. So I'll just answer it in no specific order, but fundamentally the capex allocation and the new projects, etc., have been done till about FY30. So we are not going to be coming to the market to raise any more funds as far as those projects are concerned. FY30, $2 billion, and that includes 3 different activities. Of course, one is already 2 new greenfield projects are in place already. One is the OSAT and the other one is PC board. Both of the factories have come up, and sometime during this year, we will have commercial productions too. And they have also been adequately capexed.
Can you give us the breakup, sir? I mean, over the next 5 years, up till FY30, just give us the breakup. How much will go in each of the businesses? You're saying you don't have to come to the market for raising any fresh equity.
I'll explain.
Yeah, and also the cash flow issue.
Yeah. I'm coming. Just to make sense of it, I have to give continuity. So fundamentally, no changes from our direction. Firstly, as far as the OSAT is concerned, we are doing about 3,400 crores of total capex, out of which broadly about 70% comes from government subsidies. Remaining we put up. And this year we have already spent about 200-300 odd crores. And this year we expect to perhaps add another 600-700 odd crores into the OSAT business. And that is FY26. And over the next 2 years, the remaining balance, that is 27 and 28, we will complete the balance capex so that we come to about 3,400 crores of capex. With that, our capacity in that particular business will be about 4,500 crores of sales, which we think that by the time we iron out all the capacity-related problems and everything else, so by FY30, we should probably hit that kind of a number, about 4,500 crores. That's as far as OSAT is concerned. As far as the PC board is concerned, total capex envisaged was about 1,400 crores, out of which we have spent about 200 odd crores in land and some building acquisition, etc. This year, we'll do about another similar number, about 600-700 odd crores. But next year, we'll complete the entire capex for this PC board. And PC board, when it's full-fledged, it will also give us a business about 2,500 odd crores.
Yeah. So, would this be subject to, trying to understand that some of these numbers, of course, we have from past interactions. My question really is, can these plans, would they be subject to change when the new CEO takes over?
No. Okay. So, obviously, these plans do not change. People do, of course, over time. And like I said, most of the people who probably will step into new roles would probably be very familiar. Unless familiarity is not of importance in that particular role.
Mr. Sampath, allow me to come in. Sorry, running out of time.
Yes.
Just a couple of things. So, are you hearing anything from the government on the new the PLI? The
You're
second,
talking about the new ISM 2.0.
Yeah.
Yeah. See, there was one residual approvals given for about, I think, 6 odd companies for fab, etc.
Yeah.
And some more works are on the anvil for more basic level investments. I don't know the details, but certainly they will, there maybe in a year or two, I think they will definitely launch. But they are very enthusiastic about the response they have got from the industry now. And most of us are ready to kind of ship out the chipsets now. So from that perspective, I think you can hear some more investment into this area. But this area actually...
Mr. Sampath, no, my point was for you, for example, beyond F5, does this, the fact that they've confirmed there is going to be a 2.0 to this, does this give you visibility beyond F530 as well, right? It's some sort of...
Yeah, so as far as we are concerned, whatever approvals we have got from the government, we have to make sure that goes all guns blazing by about FY30. And maybe a couple of years before that, maybe FY28, we'll consider anything else, that needs to be done in any of these areas. As you know, both PC board and in the OSAT, the demand is, of course, quite good, and whatever capacities we have put is already kind of almost covered by all the customers that are already there.
Got it.
So there's a possibility by FY28 we might...
Depending on what scheme the government...
Cash. Yeah. I also hope that we'll generate some cash within these two organizations themselves to fund our portion of the capex. And of course, we'll look for the government's help in whatever way we can to bring in new technologies and all that. I'll just briefly touch upon the cash flow question. By the end of this year, our cash flow woes in the EMS business will probably be past, and hopefully we'll get on to a positive operating cash flows by end of this year. And that also, there is a specific reason, for lack of time, I can't go into details, but it's all there in the public domain.
Yeah.
So fundamentally, those also will address it during quarter and the next.
Got it.
That you would see a very healthy cash flow profile in EMS business. EMS will continue to invest about 200 to 300 crores.
Yes. Got that. We're out of time, Mr. Sampath. Would have loved to go on. But this OSAT comes on in December, right? 6 million chips a day.
OSAT, this year we do on a, let's say, very modest target, about 100 crores or so this year.
Yeah.
And then, of course, next year onwards, it gets full-fledged with a couple of customers.
Got it.
So, yeah, you are there. Your ballpark is correct.
All right, we'll leave it there. Thank you very much, Mr. Sampath. Appreciate you joining us, and thank you for answering all those questions. We want to focus on Vascon Engineering. Stocks flying. Vivek is here to put the spotlight on it. Vivek, over to you.
Well, that's right. So the company has announced that it has signed a 5-year memorandum of understanding with Adani Infra. The company will now act as an execution partner under the early engagement model. So still details of the project, size of the opportunity as far as Vascon is still yet to be declared. What is Vascon saying? Vascon saying that they will be engaged from the design stage for the selected projects. And in fact, they say that 3 projects in Mumbai, totaling a little over 13 million square feet, have already been identified. Now, what they're saying is that the partnership is expected to contribute an additional 30% to Vascon's total turnover. So this is something that the street is actually being quite positive on. Remember, at the end of Q1 FY26, Vascon's order book stood at around 2,900 crore rupees. A positive development, no doubt, but details are still awaited.
Okay, all right, got it. Thank you very much for that. Let's quickly get to some technical trades now at 10 o'clock. Vinay Rajani is joining in. Vinay, good to have you, Win. So can you just, help us with, starting with the index, first of all, Nifty or Bank Nifty, would you have any trade?
Yeah, so Nifty has seen a correction of more than 800 points from the recent swing high of 25,448, and the recent, the Friday's low was 24,629. So the entire 800 points correction, if I were to see the moving averages, Nifty has reached below the 20 and 50 days moving average, so that's a negative sign. But yes, after 6 consecutive sessions fall, it might happen that we may see a pullback rally, and pullback can be up to 38.2% retracement of this entire 800 points fall. So 38.2% retracement comes in at 24,942. And if I were to see the 20 days EMA, that is placed at 24,970. So we can say that there is a cluster of resistances near 24,940 to 24,970 980 odd levels. So up to that, we can definitely expect some pullback rally, some relief rally after continuous fall. So yes, strong stocks can continue to do well. We may expect a pullback rally. We need to review it once that resistance line is crossed or not. 24,970 is a very strong resistance. Up to that, for the short term, at least for a couple of days, we can expect a recovery. And today's low should be the stop loss, which is around 24,668. That should be kept as a stop loss in trading long positions.
Yeah, the stocks, Vinay, what do you have?
Yeah, so HAL from the defense space looks good to me. Primary trend has been positive. It has been resilient in the downfall of the market, and it is looking good to us. So HAL, one can go long around 4829. 4770 should be the stop loss. On the upside, I'm expecting a target of 4925. Second pick I would take from the NBFC space, that is L&T Finance, LTF. That this stock has been performing very well. It has seen a running correction and now seems to be resuming its trend. So 240 is the rate around which one can go long. 236 should be the trading stop loss. On the upside, I'm expecting a target of 246.
Okay, thank you very much, Vinay, for that. Appreciate your time. By the way, Atlanta Electricals, right? That is one of the few listings that we've had today, and there are a few. But this is a transformer company. It's been around for a while. Comes to the market now. Super listing, I think 13-14% pop, and now about 9% higher. So 822 competitors are like transformers, rectifiers, or some of the other larger ones like CG, etc. as well. But that is the new listing from the power transformer block. We'll take a quick commercial break here. Manisha comes on the other side for a chat on commodities. Stay with us.
Welcome back. Well, let's straight away get to the commodity market cues now. We have Manisha joining in. Manisha, it was all metals. It was gold, silver. By the end of the week, it was copper. What about this week? What should we watch out for?
Well, gold and silver bringing that back yet again on your screens because we're looking at all-time highs yet again. Well, September, the month has been like that. It has been a string of all-time highs that the gold prices have seen. Should get it on your screen. $3,800 an ounce is now done. We started this year with $2,650. So you see where we are standing. And with those kind of gains, the percentage return clearly has been much on the higher side. For the Indian market, it has been 1,15,000 rupees, 10 grams there. So very strong gains coming in for this one as well. 45% of gains is what gold prices have done in this year until now, and this has been the best yearly gain since 1979. It was in 1979 that we saw the gold prices give you a return of 120%. Since then, it hasn't seen a 45% or a 50% return come in on a year, and that's exactly what we are looking at in sense of gold prices here. So all-time highs in international markets, all-time highs in the Indian markets for gold prices today as well. Take a look at silver prices then, and we are trading above $46 an ounce onto this one. For the Indian markets, the all-time high is right now at 143,000 rupees a kg. So 1,46,000 rupees a kg is what we are trading in the Indian markets there. When you look at the percentage gain, well, we have seen 62% of gains in this year until now for the silver prices. And this is the best yearly gain that you have seen in 10 years come in for silver as well. So making records and making multi-year records, as you can see, for gold and silver, both of these. I want to touch upon silver slightly more because when you look at the gains here, it clearly seems to be doubling every few years. Then if you look at the 10 years ago, it was at 39,000 or 40,000 thereabouts. Last year, same time was 86,000. From 86,000 to 1,43,000 is what we are trading right now. And that's exactly where that 62% of gains jump in from. So last Diwali to this Diwali has been very, very strong in sense of prices there. This is what we've done in sense of returns. And as I was telling you, the best returns really in last 10 years is what silver has given you. It's given a couple of years where it has been negative, but not too negative as well. So after 17% of gains in last year, 60% up is what we are trading at this year as well. So very, very strong strength coming in there. Well, there are expectations of lower real rates that has been supportive. It is also about tightening physical availability when it comes to silver as well. Even at these higher prices, silver is trading at premium in various international markets there. Industrial demand has been climbing as well. It's above 700 million ounces at this point in time. Last year was a record high, and this year could be making yet another record high when it comes to silver demand. So the overall global demand is expected to exceed by 100 million ounces. That is going to be the deficit. That is what Silver Institute says. But Nomura believes that the deficit could be much higher at around 117 or 142 million ounces. So there are various reports all suggesting that the deficit for silver this year is going to be higher than 100 million ounces. Clearly supportive there. And then if you look at the outlook going forward, we're already done 46.5. 50 to 52 to 58 is the view now coming in from the global markets there. So bullishness in silver just about continues.
Okay, all right. Manisha, thank you very much for that. We'll take a quick commercial break. On the other side, it's our special segment, it's the economy. Lata discusses all issues concerning bonds and rupee with Kamakshya Trivedi of Goldman Sachs. Stay tuned. Conversation coming up.
It's the economy, bond and FX markets' eyes are all fixed on the upcoming Reserve Bank of India policy meeting begins today. The market is split down the middle on whether Reserve Bank will cut on October 1st or pause. But maybe it'll pause and hint space for another cut. That's the other expectation. How will bond yields behave in each of these cases? Separately, the rupee has had a rough start last week, but steadied later in the week, despite dollar strengthening last week, apparently due to Reserve Bank support. Today, however, the dollar is a bit weaker. The rupee has been the worst performing currency in Asia, but how will it perform going forward? For all these issues on markets, I'm joined by Kamaksha Trivedi, Chief Foreign Exchange and Emerging Market Strategist at Goldman Sachs. Kamaksha, good morning, and thank you very much indeed for finding time for us. I'll start with the Reserve Bank. Street deeply divided. What are you expecting?
First of all, good morning, and thank you for having me on the show again, Lata. It's a pleasure to be back here discussing these issues with you. Look, we are expecting a dovish hold, so, right down the middle of that group. I think there is certainly scope for the RBI to cut interest rates. We think, one more cut is likely, certainly in this cycle. But we think having delivered the rate cuts so far, they might wait to see the impact of that before going on to cut later in the year. That said, would it be a huge shock if they moved earlier? I don't think so. I think inflation looks pretty benign, pretty much in line with target, and we've certainly seen some, shocks to, from the external environment on the trade front, on other policy fronts. And so I think, if they feel that they need to support the economy a bit more, there may be a scope to move faster. But I think at the end of the day, policy easing is likely, policy easing is coming. It's really a question of when rather than if.
Yes, but from the market you are trading, it hasn't been such a big advantage. The June policy delivered 50 basis rate cut and the promise of 100 basis CRR cut. But from early June, when the 10-year was about 6.2, it actually shot up to 6.6 after the June policy. Of course, it's come back to 6.5 now. So anything that bond markets are expecting, will they even breathe the word OMO purchases or something like that?
Yeah, I think you're absolutely right. But I mean, again, one has to look at this in the global context, right? Which is, it's not just India's long end bonds that have sold off and seen yields rise. There has been a global trend towards steepening curves, towards higher yields at the back end of curves. That's occurred in the UK, it's occurred in the US, it's occurred in Germany, it's occurred even in Japan, that more, place where, yields were under control for such a long time. So India is not immune to those long end pressures that have been felt across the global dynamic. But I do think you're right that I think, some indication of the policy easing to come, I think will help. But I think also we've seen, their issuance intentions. They want to issue less at the ultra long end. That's the place that we have started to fade. So at the sort of 30-year bond level, that's the point at which, a few weeks ago, we recommended going long. We felt the backup had been a bit too much. So you're beginning to see across those long-end bonds perhaps a bit too much now, price in terms of yields going up. We think it makes sense to start to come back down the other way. And I would expect to see that in India as well.
Are you expecting them to say something on the lowered inflation forecast? I did a poll and the inflation forecasts have actually fallen to 2.4%. They were standing at 2.9 after the August policy. That's obviously because GST cuts and other things have happened. So is that what market will watch? If they don't lower it enough, market takes it as hawkish. If they lower it as bad as 2.4 or as low as 2.4, then the bond markets may get a verve.
I think that certainly if they lower it all the way down there, I think that's probably part of the forward signaling message that markets may take, that at such a low level of inflation, below their target level, that they might feel more comfortable easing more and soon. So that would be kind of the kind of dovish hold that I mentioned.
Okay.
We expect lower inflation as well, not quite as low as 2.5, but sort of 2.8, that sort of level. And there's no question. I think the big picture here is inflation is benign. The GST normalization, the food price reductions, all of these have contributed to inflation not being a big constraint either to the RBI easing or to bond markets. I think what you're seeing on the bond market side is something that is more global, is something that is reflected world over. But India is different. World over, there is less demand for those ultra long end instruments. Pension funds and so on are investing less in long end instruments. Whereas India, given its demographics, given its savings profile, actually is one of these places where you can see pretty consistent inflows into long bonds. Given that inflation dynamic and given that supply dynamic, I feel if there's one place in the world you want to be, taking the other side of this bond market sell-off, I think India is one of those places.
Well, if you had taken the bet on Friday, you would be in the money now, Kamaksha. The borrowing calendar reduced the long-end bonds. And so today, there is no rally in the 10-year. 10-year yields are up, but 30-year, 15-year yields are down. But time permitting, I'll come back to it. I wanted to ask you about the rupee. Has been the worst performing currency. Would you say the bad news is all priced in, or is it still vulnerable? What's in your mind the lowest that the rupee may see in 25 and the range?
Look, I think that we have now a policy regime which is allowing greater volatility in the rupee. So it's dangerous to say that this is a kind of line in the sand, that they won't let it go beyond 88, or they won't let it go beyond 89, or they won't let it go beyond 90. I think that, at some level, I think this is a healthier way to manage the currency volatility. And I think I support the policymakers for doing that. However, when you look at our own valuation metrics, it is true that the rupee is now undervalued, quite meaningfully, even on a broad trade-weighted basis. And when you look at prior periods of similar undervaluation, 3 prior periods included COVID, it included the taper tantrum in 2013, and it included the post-GFC era, sort of 2008. Relative to those periods, I think the macro balances are in much better shape. Absolutely. So if that answers your question, is a lot of bad news priced in? Absolutely. There's a lot of bad news priced in. And sentiment around the rupee and India has also shifted very negatively. At the start of the year, India was kind of, the geopolitical sweet spot. Now it's sort of at the receiving end of a lot of external headwinds. So I think that, in a sort of versus the dollar, sure, can it go instead of 88 and change, can it go to 89? Sure. But I think from now on, we are going to underperform the forward. So I think that a lot of bad news is now reflected in the rupee.
Okay. Here, covering all the markets that you cover, Kamaksha, what might tempt foreign funds to be back? I mean, valuations at a Nifty level have also fallen compared to the long period average. Somewhat. I mean, it can still fall further, but it's more reasonable now, and the rupee is definitely undervalued, as you say. When will that sweet spot come when they think that, both are great to enter?
Right. I think that, from the foreign investor perspective, and particularly from the equity market, you're right that it has been a laggard within the EM landscape, particularly this year. The underperformance of Indian equities relative to what the overall index has done is at a kind of multi-year wide. That said, we are coming off a number of years of very strong performance. So a time correction where Indian equities essentially have been flat year to date is the best way you can correct some of that overvaluation. And I think at the same time, you're seeing some better performance in both underallocated and undervalued markets like China. So you're seeing a little bit of that rotation going on at a global emerging market level. I don't see that necessarily stopping anytime soon. I think, the best, chance here, or the best sort of, forward outlook here is a period of stability. I think that you won't see perhaps the rupee depreciate as quickly as it has done. My expectation is by the end of the year, we are between 87 and 88. So a little bit stronger than here, not a huge amount stronger. But by the end of, middle of next year, end of next year, we are back closer to 86 type levels on the INR. So I think that there is a positive story here. The positive story is India's growth is still robust, the macro balances are robust, and inflation is low and benign. That's the best possible macro circumstances you can have. Now, you need to see the credit cycle get going. You need to see the earnings cycle get going. And you need to see foreign investors gain some confidence that Indian equities are no longer as overvalued as they were. I think the GST rationalization might add a bit of momentum as well. So I think one has to be patient here. But a lot of bad news is now in the price.
I have just a minute more, Kamaksha, but I just want to ask you, since you look at Asia as a whole, the disinflation or the demand destruction, even say Indonesia, Malaysia, Thailand, is fairly serious. So do you think we will surprise on the downside in inflation in FY27 as well, or rather calendar 26?
I think inflation looks like it is going to be on the low side across Asia. I think that, we expect pretty benign inflation metrics throughout. And it's not just the demand side. I think it's also the supply side. If you look at energy prices, which is one of the big sources of inflation in Asia, they've stayed range bound this year, and we expect further downside in energy prices as we go into next year. And so I think that's going to be an additional factor that keeps disinflation going in Asia for the medium term.
Okay, that's why what dealers tell me is that they're not looking at the average FY26 that Reserve Bank will forecast, but what do they say for year-ahead inflation? They had a 4.9, and the market is apparently watching that very closely. Well, we'll continue this discussion when the Reserve Bank has spoken its mind. Thank you very much for sparing time for us, Kamaksha. Well, that's a very encouraging word coming on the rupee from Kamaksha, that the bad news is priced in, and at some point, the foreign investor will find it attractive. It's just around the corner, hopefully. Wrap up on Bazaar. Chartas is coming.
HUL, that's the top Nifty loser today, down over 2%, now recovered from the lows actually, and the company is expected flat to low single-digit growth in their second quarter on the back of disruptions following the GST rate cuts. A recovery is seen only by November.
BEL, that's the top Nifty gainer. The stock rallies close to around 3% after the Indian Army issues a tender worth 30,000 crore rupees for quick reaction surface to air missiles.
The stock of Sunteck Realty rallies up around 3%. Now the company is set to launch its ultra-luxury projects in Mumbai and Dubai. The units will be priced in excess of 2.5 lakh rupees per square foot.
Dollar Industries board approves the merger of 9 promoter group companies aimed at vertical integration to boost manufacturing control. The stock is higher by over 2%.
And Saman Cap was higher in the morning, continues to stay higher, up around 8%. The stock out of the F&O ban list.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And green is the color of the day. After a while, we are uniting. So it appears, Mangalam, the street is giving a thumbs up.
Market likes that, the street likes that. 6 days of decline is what we saw on the Nifty. There were oversold conditions. There was belief that, the market would move higher. The good part was that the GIFT Nifty, which was indicating a 120-point uptick, actually the market did not go as high as that at open, gave, entry levels or entry opportunities to the bulls, and now we're at the higher end of today's trading range so far, so that's a positive. The mid-cap's doing a lot better, so we have the mid-cap index come up for you on the screen as well. But amidst all of that, we do have a bunch of stocks that are gaining. The Nifty gainer, the top Nifty gainer today is BEL, after the Indian Army has issued a tender for air defense missiles, and BEL seems like one of the front runners for nearly 30,000 crore rupees worth orders. Ria joins in with more details on this one. Ria.
Well, yes, Mangalam, the Indian Army has issued the rupees 30,000 crore tender to BEL for buying the QRSAM air defense missile systems. Now, the Indian Army is set to procure around 5 to 6 regiments of this indigenously developed system called the Anant Shastra. And remember back in May, shortly after Operation Sindoor, the DSC had cleared the procurement proposal for this project. Now, on the back of this, Motilal has come out with a note on Bharat Electronics. They have a buy call on the stock with a target price of rupees 490. Which is an upside of around 24% from yesterday's closing price. Now, they say that BEL will be the lead integrator for this project, and they expect execution to commence primarily from FY27 onwards. They've also said that this order now enhances BEL's order book to more than rupees 1 lakh crores now. And along with this order, they also expect the company to benefit from other orders for next-gen corvettes, electronics warfare, and follow-on orders for electronics for the 97th Tejas Mark 1A aircraft as well. In addition to this, they also expect orders for some loitering munition programs as well as export opportunities, which will be in the company's favor. Now, they are expecting these orders to help the company sustain a 15 to 17% revenue growth over the next 5 to 6 years. And over the next 3 financial years, they are expecting a sales, EBITDA and net profit CAGR of 18%, 17% and 17% respectively for the EBITDA and net profit. And they're also expecting some awards for missiles for the QRSAM project to go through to Bharat Dynamics. So on the back of this, both of these stocks have been in focus today.
All right, take that point, Ria. Thanks a lot for that. Just before we slip into a short break, just keep an eye out on a couple of these stocks. While, we have 2 stocks advancing for every stock which is declining, a couple of those, gainers in the past have now come in for some bit of selling. Dixon Tech is one of them. Dixon Tech is actually currently at the low point of trade, down about 3.5%. So keep an eye out on that counter. The other one, which is, looking lower, is Latravenues Tech, which is basically Ixigo. That too continues to see a bit of a sell-off, currently at the low point of trade, with volumes piling up on that stock as well, both of them lower. But by and large, the market's doing a lot better. Let's get in the management of V2 Retail. Akash Agarwal, who's the whole-time director, joins in on the other side to discuss a whole host of things, the GST rate rationalization impact, some updates on festive demand, and what the outlook for the remainder of this year is. Akash Agarwal of V2 Retail on the other side. Welcome back. A bunch of stocks that are doing well this morning. They're the IT pack. So look at Wipro, look at TCS, look at all of them. They're doing a lot better. Remember, after all of last week's decline of 8% on the IT index, it's starting out on the positive note. So that's something that the bulls would like. It is expiry tomorrow as well. So to that extent, the IT index and the Nifty Bank will be extremely crucial. But a whole host of consumer-facing stocks are all on our radar. We have the management of V2 Retail joining in. The stock's doing well this morning. Akash Agarwal, who's the whole-time director, joins in. Three main focus points: early festive season sales trends, the impact of GST cut on incremental sales, and finally on store expansion and margin targets that the company will give us as well. Akash, thank you so much for joining in. And that really is the first question. You know, when we saw the first quarter numbers, they were obviously impacted by a high base or the Eid shifting in the previous quarter. But like for like, same-store sales growth was close to around 10%. How has the second quarter fared, especially given the problems that we saw with rains and with the GST cuts? A lot of companies are facing some transition issues. So how has the second quarter fared for you? What is your revenue and same-store sales growth likely to be?
Yeah, hi, thanks for having me. So we have seen a consistent momentum in terms of sales, same-store sales growth. And in terms of GST cut, I think it's too early to say because it's just been 6 days since the rollout. But all the indicators are pointing towards a very positive outlook. And third quarter is going to be very crucial because the next 3 months is the highest grossing quarter for us. So we will find out better in the next 3 months. But current festive trends, we are doing better than the guidance of 8 to 10% SSSG that we've given to the market.
Okay, all right. Could you tell us what is your pricing strategy, though, Akash? For say products that between 2,500 to 2,600 rupees, because now with the GST rationalization, you have an opportunity to adjust prices, such as to take advantage of that, and in turn, it would help you all in terms of growth. So, pricing strategy.
Yes, so we have already passed on the benefit to the consumers. We have already changed the MRPs for all the pending orders, as well as all the inventory at the store. But that contributes to only 6% of our total sales. Already 94% of what we sell is below the 1,000 rupee MRP. So we are not beneficiaries in terms of direct price cuts, but definitely in terms of customers having more disposable income and all the savings that they make spending on other products. So overall, the consumption should increase.
All right. You said that the second quarter same-store sales growth is similar to the first quarter. First quarter on a reported basis was 5%. Do you think the second quarter was that much, or are you looking at the 10% mark?
So that is because of the shift in Eid. Yes. So our guidance has always been 8 to 10% SSSG, and any double-digit SSSG on such a strong base is a very good number, and that is what we're targeting. And we are on track to deliver that.
And for the full year revenue, value growth would be what? Last year, obviously, you did closer to 1,900 crores on the top line. This year, what's the kind of revenue growth that you're targeting with double-digit SSSG?
So at least a 50% revenue growth is what we're targeting. And hopefully, we deliver more than that.
Good to hear. You're sounding quite confident, Akash. What about store additions? Could you tell us what's the plan for this year? I think in quarter one, you added 27 stores. So for the year, what is the plan and outlook on margins?
So the initial plan was about 100 stores, but looking at all the positive response that we've got from all the newer stores and a very strong performance in the older stores. So I think we're going to open 120 to 130 stores this year.
Okay,
all right. That's aggressive. Just a couple of things. You had that enabling resolution for a 400 crore rupee QIP. Will that be put to use for store expansion? And by when do you hit the markets for this QIP?
So that is just an enabling resolution that has been done. Right now, we are busy with the festive season. The details and the decisions will be taken on that later.
Okay, all right. By when?
Again, like nothing has been finalized. It's just a board approval.
Okay. For the time being, it's a board approval. If the need arises, you'll go ahead and you'll use it. Is that correct?
Exactly.
Got it. All right. Give us a few more details. Net working capital days, it's come down a little bit. It was as is under 40 days. It's come down to around 34. What is the rough range you'd like to maintain?
So the net working capital should hover between 35 to 45 days because the inventory days that we target is about 90 to 100 and the average credit period that we get from our vendors is about 50 days. So this is what we're targeting. But if we are more efficient in the future and the sales per square feet increases in the future, then it might reduce by 5 to 7 days.
What is the sales per square feet target? Because first quarter was slightly under the 1,000 rupee mark. You have a guidance of 1,200 rupees for the full year of FY26. And by when do you reach the 1,400 mark? Because these are important milestones that you've spoken about in the past as well.
So 1,200 is not the company average that we're targeting. That's the old store target. Because newer stores always start at about 70% of throughput of the old stores. And we're opening more than 100 stores this year. So for the company level, the target is to move to 1,200 in the next 2 to 3 years.
All right, next 2 to 3 years. And what about margins? We didn't get that number from you. 50% revenue growth, 8 to 10% SSSG, 125 stores is what you're adding. Net working capital days between 35 to 45. Margins, how much will they be?
So we always talk about pre-Ind AS EBITDA margins because that's the relevant number for us. And it should be in the range of 8.5%.
Okay, final question before we let you go. Bihar elections. The next 45 days is going to be interesting on a political front. But for you all, for business, what does it mean? In the run-up to the elections, do you see increased demand? Or, how do things normally play out? And if you could give us your rough exposure to Bihar?
So historically, it's been a mixed batch. Sometimes there are a lot of disturbances that affects sales in the negative manner. And sometimes we see an increase in consumption. But overall, there's not much significant impact. And hopefully there are no disturbances in terms of sales. And the momentum can continue.
And what is your exposure to Bihar? How much of your sales come from there?
We have about 40 odd stores in Bihar. So it should be contributing anywhere between 25% of sales.
Okay. I like the way you put it, disturbances. I'm wondering whether it's based on the outcome or the party that's ahead. That'll be interesting. Bihar, always an interesting election. Well, we appreciate you joining in, Akash, giving us all these details. For the time being, you're sounding extremely confident about business, on growth, on store addition, as well as on the profitability front. We look forward to chatting up with you post Diwali.
Yes, Nigel, and most importantly, I'll be looking forward to when the QIP happens as well, because if you look at their shareholding pattern from a domestic institutional fund, you have Motilal Oswal, which has been upping the stake in the company, and at some point they will hit that 10% ceiling level that will come by. So will there be other funds that join in and not, or something that we will be tracking very closely on V2 Retail? Has been a big gainer from a stock standpoint over the last 2 years or so. So we'll watch out for that. With that, we'll take a short break. As we do that, some good news for our viewers pops up right here. India's business news leader is just a click away. It is the all-new app, CNBC-TV18's all-new app, which gives you instant access to breaking news, in-depth articles, and financial world updates, all of them at your fingertips. All you can do is download the app right away from the Apple Store or the Google Play Store, or just scan the QR code, which is up for you on the screen.
Welcome back. Well, the start has been good. However, you'll want to hold on to these gains. That's going to be extremely important because now we are still sitting with a gain of around 90 points. You've slipped a smidge from the high point of the day. But you'll want actually us to hold on to these gains given the kind of selling that we've seen in the last few days. And the last few minutes, Adani Ports has moved to the day's low. And SBI Life, that's the other one that slipped a little bit. So I think the intraday chart of both those two come up for you on the screen. But let's get a technical check going. Shivangi Sarda from Motilal Oswal Financial Services joins us on the show. Hi, Shivangi. Good to have you on the show. What's your take? The markets have bounced. Do you think it's short-lived? And will you be looking to add short positions or buying some puts?
Very good morning, Nigel and Manglam. Thank you for having me. So we've seen that there has been some sort of a relief rally in today's trading sessions after 6 red candles that we've seen on the Nifty chart. Now, of course, some of the data points, India VIX had risen 15% last week, and the put-call ratio had sunk to 0.6 levels. Now it's again jumping back to 0.8 zones. But then again, we've seen that there has been some amount of, unwinding on the call writers position, but the expiry perspective, there will be a lot of volatility expected as it's monthly expiry tomorrow for this index. But the key levels to watch out would be, 24,600 on the downside, and the upside we're looking at 24,950 as the hurdle for Nifty index. So likely to remain in this range, but overall there will be some sort of short bounces that one can capture in the index. Talking about the bank Nifty, we've seen this banking index has been relatively outperforming in terms that it did not fall as much as compared to the broader market. And we've seen that the indices have relatively held on to 54,250 marks. So this would be an important level as a support. And for the upside, we're looking at 55,000 as the next hurdle. And focus would be on the smaller banking names which have been contributing to the strength in this index.
All right, we take that point. A lot of these cash stocks are surging in with a lot of volumes backing them as well. So pull up something like a coffee day. That stock's up around 4.5%. We've seen some traction in specialty restaurants as well, up 9%. And the volumes on that are nearly 6 times what we see on an average day for specialty restaurants. That's the one which is up for you at around 138, up 9%. And Shalimar Paints is the third one, which again is topping the volume list, has already done more than what it usually does in over the fortnight in just 1 hour of trade today, 10% higher on that one. Shivangi, individual stocks, if you could quickly name some of them for us.
So on my radar, first up is Canara Bank. That we've spoken about how a Bank Nifty has been outperforming, and Canara Bank has been one stock which has resiliently held on with higher bottom from the last 4 weeks, which clearly indicates that this is moving despite the market weakness. And we've seen a little amount of retracement, but a good support taken near 117 levels. So this one is getting ready for a good up move. Now, talking about the data points, we've seen that, the rollovers have also come in quite positive for this one. So expecting a good move here for the next targets of around 125 and a support of 117 levels. And the second pick on my radar is HAL. We've seen defense back has been in momentum from the last 3 to 4 weeks, and HAL has consolidated at the higher zones from the last 4 trading sessions and is now getting ready for a good up move. The volumes have been significantly high in the last 2 trading sessions, which indicates that buying is emerging at these levels. Also, there has been a cool-off in the IVs along with unwinding of the call writers at the higher zones. So overall, looking quite positive data-wise as well. So now we're recommending a buy here with a target of around about 5,000 levels and a support of 4,700 levels.
Okay, all right. Thanks a lot for that, Shivangi. Well, on that note, though, we'll have to wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormuz Patakia. Hey Hormuz, good morning. A fresh new week, and there is some semblance of green that we are seeing after that fall that we saw last week. 2.5% gone last week, but today we're seeing gains of around 0.4%. The Nifty up around 88 points is still off the highs of the day, around 50 points from the highs of the day. But we do have a green looking screen. Midcaps are outperforming. We do have the banking names which are up around 0.3%. So yes, there are some elements which are contributing to the greens as well. As I said, the high for the Nifty today was 24,791, and we are around 50 points off from those levels. In terms of contributors, we have the Realty Index, which is doing really well. Nifty Oil and Gas is doing really well. Of course, we'll talk about that specific space in greater detail. PSU Banking is doing well. Nifty Energy doing well. And in terms of individual names as well, we do have BEL, which is the top gainer on the Nifty right now. There is some fundamental news supporting that. Eternal is the other one. IndusInd Bank, Sun Pharma are the other stocks, to name a few, which are doing really well in trade today. From the broader market, since the mid-caps are outperforming, we have a 400-point uptick on that one. The advance decline ratio comfortably in the favor of advances as well. So let's go across to Hormuz. He's here with us as he puts the spotlight on the top movers in the broader markets. Hormuz, tell us more.
Well, there's some resemblance of green, as you mentioned, and some of the broader market names are reflective of that. You start off with Supreme Petrochem, and this 10% move is the 9th instance in the last 11 sessions that the stock has gained now. There's a similar 10% move was seen last month as well on the 18th of August. And today's move comes on the back of very strong volumes, of course. Close to 9.5 lakh shares have already been traded in the first couple of hours compared to their 20-day average of just 8,000 shares. And courtesy of this move, the stock has extended its gains in the month of September to 25%, making it the best month of the year so far for the stock. And positive returns for the stock every single year since the end of 2019, from where the stock has risen over 10x from those levels. The other one, of course, is a news flow driven name, Vascon Engineers, after the MOU that it signed with the Adani Group. 10% higher there as well, snapped a 3-day losing streak, and it was down 10% last week. But before this 10% drop that it had, the preceding 3 weeks had seen the stock surge over 33% to hit a 52-week high. And in today's session, we have had more than 2.5 crore shares that have already been traded compared to a 20-day average volume of close to 12 lakh shares. Now, we had mentioned about Vascon Engineers just a couple of weeks ago on the 16th of September, saying that the stock is a multi-bagger from COVID lows, but still continues to remain below its IPO price. Now, another news flow driven name is Wockhardt, and today's 9% or now 11% move, the stock has now recovered all the losses that it made on Friday and a little more, and today's volumes are already close to 60 to 65% of Friday's traded volumes. We had almost close to 25 lakh shares being traded on Friday. We've already had more than 14 lakh shares being traded on Wockhardt today. The 20-day average is just 1.5 lakh. And the stock has now crossed the important 200-day moving average level of 1470, which was a key level on the upside. And as a result, it has now yet again turned positive for 2025. And lastly, oil marketing companies doing well in today's session. MRPL seeing the biggest single day gain in 2 months now, was up around 7.5%, has slightly cooled off, but 54 lakh shares have changed hands, 20-day average of just around 6.5 lakh. The stock above its 50-day moving average at 129 and trading at its 200-day moving average, which is at 133, and the 100-day moving average on the upside comes to levels of 135. But despite this move, the stock has been an underperformer so far. 10% lower this year, was up 11% last year, so almost nullifying what it gained in 2024, Sonal.
Okay, all right. Some interesting names there. Thank you so much, Hormuz, for bringing us that list. So those are some broader market movers. The other one that I'm focusing on is Sunteck Realty. It is buzzing in trade. There have been a lot of updates that have come by in this particular counter as well. For now, the update is they are launching an ultra-luxury project, which is under a new brand, Imancy. The gross development value here will be around 20,000 crore rupees. In terms of the launches, it is planned over next 12 months. And it will be done Nepean Sea Road, Mumbai, which will be launched in FY26 itself. And they will look at an international foray as well, Dubai Downtown, which will be in Burj Khalifa community, which is, of course, a premium location to begin with. In terms of realizations, under this brand, they look at 2.5 lakh per square feet, which is, of course, an ultra-luxury price that the company is looking at. On the back of that, the stock is higher. Of course, it has come off from the opening highs of around 5 to 6% gains. Right now, gaining around 3%. But yes, this is is an expansion that the company is doing. Of course, not under the Suntec Realty brand, but this is another brand that they're looking at for premium projects.
Oh, Burj Khalifa, that's an interesting one. Suntec Realty almost 2.75% higher, doing very well for itself. But, you know, speaking of the broader market names beyond the list that I just mentioned, Shalimar Paints has made its move higher on the list of gainers. Now 11.5% higher on that stock is Shalimar Paints, and that has also sprung up to the highs of the day. The other stock that was in the news is Dollar Industries, and Vinny is here to take us through what is causing this up move that you are seeing on Dollar Industries today, Vinny.
Hi, good morning. So yes, Dollar Industries is surely a stock that's buzzing in trade. Now, the board has actually cleared a merger of 9 of its promoter group companies. The group companies include like some of the companies that were involved in real estate, yarn, branded arms as well, which they were focusing on. So that is all now going to be coming under Dollar Industries. This is a sort of a vertical integration. So what does it do? It boosts in terms of manufacturing. They'll see improved supply chain benefits also coming. Now, what is the amount they're paying? So right now, there's going to be a swap ratio that's going to be taking place, swap of shares. That is going to be that Dollar Industry promoters will get 29.8 lakh new shares of all this overall, and their stake will now increase to 73.6% from previous stake that was going to be 72.2%. All of this is at an arm's length price. When you look at it in terms of other synergies, obviously boost in terms of manufacturing, supply chain efficiency, reduction in related party transaction and costs. Logistic costs now will become lower as well. Faster project execution is there in terms of the pipeline. Do not forget, some of these companies, like I mentioned, they were into garment manufacturing, leggings, kurtis. That was one of the companies that was there. The other companies were in renting commercial real estate. So all of that now is going to come under Dollar Industries. And just in terms of overall better process management for the company, that is why the stock is buzzing.
Okay, all right. Yes, 2.5% higher on Dollar Industries. But the other big stock on our radar is HUL, post their Q2 FY26 update. Mangalam is here with more details.
Well, you know, for all the FMCG companies this time around, the second quarter was expected to be a washout quarter for a couple of reasons. One, large parts of the country saw, uncontrollable rains, and as a result of which there could have been a demand issue. The other part was the big announcement that came in on GST cuts. So the last few days of the quarter impacted by the transition of old price GST stocks, which will be out of the trade channels, into the new price, lower price GST stocks, which will come back in the system from the first week of October, as the companies had told us. And that exactly is what played out for HUL as well, where they said the transitory impact due to trade and channel disruption has caused the entire quarter's sales to be disrupted, and as a result of which, on a consolidated basis, this time around, their sales growth will be flat to low single digits. However, the reason why the stock is lower and hasn't recovered as much as the street expected it to, mind you, though there has been a recovery of almost 1.5% from the lows, is that the company is expecting recovery only to start in November and the disruption to continue into October. And that's not particularly good news, because in October is where you have a majority of the festive season sales coming by, with Dussehra starting this week and then Diwali 2 weeks later. So if October itself sees some disruptions, then maybe the reason for the street's optimism that there would be increased demand that will come by will wane a little bit, because recovery is likely to be seen only in November as per the company. So let's see how that pans out. But there are a lot of positive triggers for HUL and the consumption space by and large, given the GST cuts, and for HUL in particular, the leadership change too.
Significantly off the lows of the day is HUL. Mangalam, thank you for that update. To take a short break. On the other side, we put the spotlight on the crypto markets. Manisha Gupta joins in.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
On Crypto Corner today, we're going to be talking about futures and options as a segment which seems to be building when it comes to crypto markets in India as well. In the international markets, well, we've seen FNO, ETF and all that space do quite well. But for the Indian markets as well, it seems to be growing. Let's first of all take a look at the overall market scenario here. And we do understand that these numbers are via trade sources, which tell us that in 2024, the overall crypto market in India was to the tune of $2.5 billion. For 2025, that number is expected to increase up to $2.9 billion. And the estimates suggest that by the time it is 2029, we could be looking at that number almost at $5.4 billion. So it clearly seems to be growing from where we stand. And when it comes to the overall trading volumes, they have been trading at near record highs. And when you talk about the spot vis-a-vis the futures and options, it is 1:3 of a ratio where you have seen FNO as a market continue to grow. The reason for that is that the crypto futures, they resemble the standard futures and options market, which you have in various other asset classes as well. So not a difficult market to understand. The second point is that futures allow the traders to bet on the price of trajectory of the underlying asset. So the leverage playing in that sense is much on the higher side, again, as is the case with various asset classes. Now, the reason that you have seen increase in volume here is that you're looking at not just crypto enthusiasts, but investors and retail now becoming part of this as well. High leverage, of course, is one of the reasons here. And then you also have better tax rules in this case. When it comes to crypto, remember, we deal with very, very high taxes, nearly 30% flat. And then you also have 1% TDS with no set off for losses. This is the case when you have when you're trading in the spot markets there. Now, contrary to this, when you're trading in FNO market, that is the futures and options market, what you can see is that that when you're looking at it attracts 1% TDS only when you're closing it. But when you talk about the futures and options market, in this case, profits are classified as speculative business income. And this is taxed according to the income slab, which mostly or sometimes is below 30%, making into better profitable gains. Well, that's about Crypto Corner. But with that, let's go for a short break. Come back with more news and stock specifics on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. You're still tuned into Trading Hour, steady as it goes for the Nifty. So let's get a technical check on the markets. Nagraj Shetty is joining us from HDFC Securities for a quick technical check. Nagraj, good morning. Thank you so much for joining in. Well, Nifty is in the green, but it has come off from the highs of the day. An 80-point uptick is what we are looking at. Do you think we'll maintain these levels, or there could be some volatility throughout the trading session?
Yeah, I think market is at the oversold region after having declined sharply by for at least around 6 to 7 sessions. Nifty is showing some bounce back, showing some reversal at the lower levels, but still need to confirm at the lows. I think at the lower levels around 24,500, 400 is going to be a strong support for the market. I'm expecting from here or from lower levels, we could see some sizable bounce back.
What about specific stocks, Nagraj?
Yeah, I have two stocks. One is from OMC, Hindustan Petroleum. And chartically, if you see, the Hindustan Petroleum has been a constant uptrend over the last few weeks. We have seen marginal declines recently and today's sharp breakout. This all indicating the strength in the uptrend in the stock price. Currently trading around 437, one can look to buy at this point of time. And 465 is going to be the upside target in the near term. One can place a stop loss at 422. And second one is NHPC. NHPC, after the sharp downward correction, has bounced back from the lower levels around 84, showing a higher bottom formation at this point of time around the 200-day EMA. I think overall chart pattern is showing some more upside is likely in the near term. Currently trading around 85.15, one can look to buy at this point of time. 90 is going to be the upside target, and one can place a stop loss at 82.
Okay, all right, Nagraj, thank you so much for joining in. So that is a technical check on the markets. By the way, let's talk about some broader market movers. We have MRPL, which is up 5%. Of course, oil and gas space continues to be on our radar. We'll discuss that in greater detail on our big story segment as well. Tejas Networks is the other one, which is up around 2.3%. We have Vascon Engineering, of course. Hormuz also spoke about it. Supreme Petro is up 10%. We have Sammaan Capital, which is up around 10.5%. In terms of other movers, Epigral is the one which is up 4% as we speak. We have Aarti Drugs as well, which is trading higher. Some of these stocks which are in the green, but they've also come off from the highs of the day. So that is very important to track, because even the Midcap index, if you look at it, when we started the show, it was up around 0.7%. Now, as we speak, it is up around 0.5%. So there has been some selling across the board from the top for Nifty. There are mid-caps as well. Even Bank Nifty, for that matter, if you look at that one, it's 0.2% higher there. But other than that, we are seeing some of the stocks seeing fall from the highs. For instance, Hero MotoCorp is the other one, Bajaj Auto as well, Eicher Motors. Some of these auto names are the ones which are pressurizing Nifty from the highs of the day. But let's continue with the Nifty coverage. BEL is the top gainer, surging after the Indian Army issued a tender for air defense missiles. Ria joins us and tells us what the opportunity is looking like and which stocks are in focus.
Well, yes, Sonal, the Indian Army has issued the rupees 30,000 crore tender to BEL for buying the QRSAM air defense missile systems. Now, the Indian Army is going to procure around 5 to 6 regiments of this indigenously developed Anand Shastra surface-to-air missile weapon systems. And remember, back in May, shortly after Operation Sindoor, the DAC had cleared the procurement proposal for the same. Now, BEL will be the lead integrator for this project, and they are expecting execution to commence primarily from FY27 onwards. And with this order, this enhances BEL's current order book to over rupees 1 lakh crores. The order book at the end of Q1 FY26 was about rupees 75,000 crores, and the total order inflow in FY26 so far, ex of this QRSAM order, is around rupees 11,500 crores, which is already around 42% of the company's FY26 OI guidance of around 27,000 crores. Now, the company is also expecting EBITDA margins at around 27% for this fiscal, and revenue growth in the medium term is expected to be over 16%. Now, in terms of the QRSAM project, there are also some other companies that will be contributing to this. Bharat Dynamics will manufacture missiles for this project, and the expected order value for them will be around rupees 10,500 to 12,000 crores. For Apollo Microsystems, they are going to onboard the computer and complete navigation system for QRSAM. They will also be contributing to the power distribution systems for QRSAM, and also one of the critical actuation systems for this project. The expected order value for them will be around 800 to rupees 1,000 crores. The current order book of the company is around rupees 735 crores. So this is a big order for Apollo Micro as well. For Astra Micro, they will be contributing to subsystems like TR modules as well as subsystems in the missile programs. And the order value from this will be 1,800 to 2,000 crores. The current order book of the company is around 1,891 crores. Axis Cage is another company that will be contributing to this, although the nature of the exact contribution is not known yet, but the order value from QRSAM is expected to be between rupees 100 to 200 crores, and even two other companies, Data Patterns and Paris Defense, are also expected to contribute to this project.
Lots of companies, but some profit taking you're witnessing in today's session. Ria, thank you for that. You look at Data Patterns, significantly off the highs of the day. Now it's almost 110 rupees shaved off from the day's high. Same is the case with BEL as well. Among the top gainers today, yes, but that too has significantly cooled off from the highs of the day, still holding on to gains of around 2.5%. But most of the others, Apollo Micro is down 4% as well as we speak. So some defense names seeing some bit of profit booking. What has also significantly come off the highs of the day among the Nifty names is Apollo Hospitals. And starting off the day on a positive note, the stock has now gone on to hit the flat line now, and from levels of close to 7,600, that's another 100 rupees shaved off on Apollo Hospitals as well. We take a short break. We continue our conversation on the markets with George Joseph from ASK Investment Managers on the other side. 60 points off the highs of the day is the index, now below the 24,750 mark is where it stands, holding on to gains of around about 80 points, similar to where we had started the show at. But good time to get in some trends from the FNO space, especially since it is the second last day of the September FNO series. Mangalam at the FNO desk with more on this. Mangalam.
But it's very interesting, the way the markets have been moving on for a couple of reasons. One, the indices, they're bouncing back after a 6-day fall. So that was already on the cards and always on the cards because we were at oversold levels. The question is what happens from here on as we move towards important sessions ahead. The good part is that the broader markets are outperforming. So we have the mid-cap index, which is doing better than the frontline index, and the small-cap index is also in line with the frontline index itself. The stocks in focus right now because we have the Nifty IT and the Nifty Bank, both of them having the most amount of weight on the frontline index, and how they move will be important. Let's look at the heavyweights out there. HDFC Bank is fairly well bid in today's trading session. Infosys and TCS, the IT index, after having an 8% fall all of last week, is doing better at the start of this week. So those are a few hearty factors. Now the triggers to track. Tomorrow we obviously have the September series expiry. The Nifty Bank will be in focus also because the Monetary Policy Committee outcome, RBI's MPC meet outcome is a day after that on the 1st of October. And the commentary around India-US trade deal, we've been constantly getting updates on whether the bilateral talks are in the right direction or not. So those are a couple of things we'll be watching out for. The bounce back happened. Now what? The put-call ratio, which was closer to 0.63, has now moved to 0.86. We've seen some short covering in the 24,650 call on the Nifty. Those call writers were caught on the wrong side. And now we are seeing some writing at the 24,700 put and the 24,750 put, telling you that around 24,650 to around 24,700, there will be important support for the market, even though it's off the highs. The reason why it is off the highs is because 24,800 call writers are still fairly active. 24,850 thereabouts is likely to see some sort of supply coming in on the markets after, a big fall that we've seen and some bounce. The reason why I say that is because from a technical level as well, the 50-day moving average of the Nifty comes in at 24,864. So that's an important level to watch out for. Those call writers still holding their position. But amidst all of this, a lot of sectors and stocks in focus. The oil marketing companies, they are fairly well bid today. So a lot of long positions added one day ahead of expiry on IOC, HPCL and BPCL, all of them showing big gains. And the other stock which has been buzzing right from the word go, straight through the grades is Sanman Capital as it's exited FNO ban. But right now, as we speak, with the activity that is underway on that stock, it is likely that it goes back into FNO ban after just a few hours of staying out of FNO ban.
Take that point, Mangalam. Thank you so much for joining us. So that's the FNO setup and markets, of course, off the highs of the day. If we look at the mid-cap index as well, that is substantially off the highs, 236 points higher, yes, but it is almost 0.3% off from the highs. And if we look at the advanced decline ratio as well, it has moved towards the decline, not in favor, but yes, there are more declining stocks now versus what we saw at the start of the show versus the advances. So yes, these lines could converge at any moment. We'll have to see which way things go now. Bank Nifty is the one which is, pulling the Nifty down. If we look at Bank Nifty currently, it is off substantially from the highs of the day as well. So that is one index which is very, very important to track, very close to the red mark. And that is one index that we'll be closely watching out for.
Mangalam mentioned HDFC Bank is very well bid for in today's session. What's not very well bid for is its unit, HDB Financial. And at the intraday lows, the stock has slipped below its IPO price of 740 rupees and currently trading just around those levels, so 2% lower on HDB Financial. But taking the conversation on the markets forward with George Joseph from ASK Investment Managers, who's joining in now. George, good morning. Thank you for joining in. Well, we are on the cusp of yet another earnings season, but the news flow ahead of the earnings season has been anything but positive. Barring autos, there have been significant headwinds from IT, from pharma. We heard from HUL on Friday, might expect a similar reaction from its peers as well. What are you anticipating from this quarter? Do you expect it to be as subdued as the first one, and then you see a recovery in the second half?
I see there is quite a lot of news flows in the immediate past what we have seen, and what we believe is that H2 should be good. This quarter should juggle on, may not be very good at this point in time because a lot of GST related news flows and some disruption in the supply chain has been there. So we will see some rebound happening in the next quarter onwards. So H2 should be reasonably a good rebounding quarter is what we believe.
We've been talking about how markets are oversold last week, but that trend seems to continue. There's still some fall from the highs of today. George, what do you make of other fundamentals apart from earnings? Is there anything which could be a trigger for the markets from here on?
Yeah, a lot of triggers. If you see the rate cuts have happened, if you see from 6.5% repo rate has moved to 5.5%, 400 basis point overall rate cuts have happened. CRR cut of 100 basis points. And then, you saw the GST cut and, the benefits coming through for various sectors. And also we are seeing the tariff noise is at the peak. That also will mellow down over a period of time. So maybe a couple of months from now, the tariff, the news flows will be significantly different compared to what it is today. So 50% tariff hike on India, and it is one of the highest in the entire emerging markets, and so on and so forth. Those news flows also will be behind. So what we are believing is that the worst of negative news flows in the near term is already there. And you will see the earnings rebound and the GDP rebound. Already the GDP is in a decent shape in terms of growth rates. We'll see the earnings also start rebounding from next quarter onwards. Net, what we think is that from valuation point of view, the large caps look very interesting, and it is probably trading marginally below the 10-year average. And when you look at mid and small cap space, that's where a little bit of pessimism from my side is there. When we look at many stocks and sectors are trading at maybe 2-decade high valuation. So that's where probably the earnings expectations have gone north of much what was needed. Whereas large cap, many companies, we see there is a big opportunity to make money in the next 3 years.
George, the one pocket that was holding up the market so far before this fall began was the auto space. And this was after the GST rationalization was announced. Stocks moved up 15%, 20%. We heard from the companies as well that the first day of Navratri was very encouraging. But the bottom line being that the first half has been a complete washout for these companies. And so would this 8-9 day sale be enough to justify the kind of moves that you've seen in these auto names? Because most of the larger names, be it Maruti, Eicher, all continue to trade at or near record high levels.
So these are all structurally good businesses which you can own from the next many years perspective. And we are still, if you look at from the auto volumes perspective, there are changes happening in the technology from the ICE engines to EV and so on and so forth. But nevertheless, Indian demographics clearly suggest that there is a significant room for these sectors to do well. So auto, pharma, FMCG, IT, and banking historically has been a good space to hunt for ideas from a structural growth point of view. But at the same time, right now, from the context of US market situation, US economic situation, we believe that this particular sector, more domestic-oriented sectors like auto, banking, looks extremely attractive from the next 3-year perspective to hunt for ideas and make money. The valuations probably has caught up in many cases, and that has been the case for across the board in the market. But in the case of the GST benefits coming in this sector very clearly, I believe next 12 months the eye will be on the GST beneficiaries. So auto is one among them. Therefore, there's a good opportunity to look to make decent returns in these names in the next 12 months.
All right, so Bank Nifty is in the red right now. There's a sharp fall at the day's low. We've been talking about enough triggers for the market to see those higher levels. But for now, it is a sharp fall from the highs. Even the Nifty just at the flat line with some positive bias. But yes, a majority of those losses are coming in from Bank Nifty. We do have some of these names which are at the day's low. Kotak Mahindra Bank, there is Axis Bank. You do have Reliance Industries, which is at the day's low as well. Tech Mahindra, some of these IT names not contributing too much. So Tech Mahindra is at the day's low as well. Hero MotoCorp, Maruti Suzuki, Bajaj Auto. We were discussing how autos could be a big beneficiary of the entire GST cut phenomenon that is taking place. But yes, after that stellar up move that we've seen in some of these names, some profit booking is something which is par for the course.
Just not any strength at higher levels for the index or for the Nifty Bank for that matter, because the Nifty Bank had closed below that 54,500 mark last week. We saw some rebound from those levels, but yet again the Nifty Bank failing to sustain above that 54,500 mark as well. George, pleasure having you. Thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. George Joseph there of ASK. The market, though, given up almost all the gains in the Nifty Bank already in the red. Take a short break. The big story on the other side. Stay tuned. Welcome back. On to the big story of the day, and that has to be comments from the Ministry of Petroleum and Natural Gas. Sonal is here with that big story. Some interesting comments there from the Petroleum Minister. Higher valuations for these companies.
Yes, that's the biggest takeaway. And you know, PSUs usually don't trade at premium valuations, and that's exactly what the Petroleum Minister spoke about as well. In his meeting with the analysts, he spoke about how they're pitching for higher valuation for PSU companies, and they are also talking about less interventions coming in terms of policy, and that is something which would focus more on profitability. It'll be more about EBITDA, capex quality and value unlocking as well. They also reaffirmed their stable energy pricing policy. This is something they've spoken about a lot of times, and they reaffirm that yes, prices will be stable going forward as well. On windfall taxes, they say their future policy does not have any windfall taxes on crude oil prices or crude oil producers and even refineries. This is not something which will be there even if prices are very volatile. They have also spoken about performance-linked incentive for the managements of these companies. They say managements will also get 15% remuneration, which is linked to profitability, which is related to shareholder returns versus profitability as well. So this will be in addition to that to ensure that shareholders also get higher returns. India's crude sourcing, of course, is focused on efficiency and economics. This is, of course, in relation to Russian crude sourcing, which has been a discount, but now that discount has also come off.
Yeah, discount has also come off. But, Sonal, the focal point of these OMCs has always been A, the dividend yield for them, and then the valuation. So what are the valuations currently projecting for these oil marketing companies?
Oh, yes, dividend yield definitely one of the reasons why shareholders look at these stocks, because in the past it has been around 7 to 8% for most of these names. But specifically about valuations, because that's what the minister spoke about, let's take a look. I have taken 5 stocks from this list, majorly OMCs, because that is where there has been a lot of fear as well. For ONGC, FY27 6.8, which is in line with its 5-year average. We have Indian Oil, which is higher than the 5-year average at 9.6 times. BPCL is lower than the 5-year average. You know, the 5-year average was also higher because there were these talks of divestment of BPCL, and that is what drove the prices higher as well for this particular stock. For GAIL as well, it is higher. The tariff, upcoming tariff for the pipelines is something that the street is watching out for very closely. HPL as well, a lot happened there. Demerger of their lubricants business. They spoke about higher capacity additions as well, and that's why the FY27 earnings, or in terms of valuations, it is higher than the last 5-year average for this particular name. But if we talk about the Nifty oil and gas index as a whole, the market capitalization here is 30.23 lakh crore rupees, and it is trading at a PE of 11.8 times, which is still, as a whole, 15 companies still on the lower side. It, of course, has some private companies as well. We have Castrol here, we have Gulf Oil here. So these stocks also considered under that, and they have seen a return of 15% over the last 10 years.
Interesting. Most of these names, barring BPCL, trading around or above their 5-year average. But the other buzzword in this is value unlocking. What kind of potential lies there?
Value unlocking has been on their agenda from the word goes. If we talk about previous announcements that the company or the ministry has made as well, first was on their pipeline InvITs. So both GAIL and IOCL both have pipelines. So they had spoken about some InvITs to come by. For GAIL, of course, it's the natural gas pipeline they are looking to monetize via InvITs, and IOCL to monetize crude oil and petroleum pipeline, because these are the major products there. For HPCL, of course, it was the demerger of their lubricants business, which could have listed later, but there's no idea on that one. Recently, GAIL spoke about demerger and listing of GAIL Gas as well, which is their city gas distribution arm. But generally also, none of these unlocking measures have materialized so far. And Jeffrey says that such spin-offs and demergers would definitely unlock value for shareholders. So this is something that the government should keep focusing on. This is something which will drive value.
Plenty of such proposals, but yet to see the light of the day. But Jeffrey's mentioning that could be positive as well. Sonal, thank you for putting that in the spotlight. And that was our big story of the day, the spotlight on the oil marketing companies doing very well for themselves in today's session, be it HPCL, BPCL, Indian Oil, MRPL is doing well for itself as well. So good going for a lot of these oil marketing companies. By the way, look at the fall on the Midcap index now from the highs of the day, 550 points lower. The index too has now slipped below the 24,650 mark, 150 points off the highs of the day on the Nifty. The Midcap index has turned negative. The Nifty has turned negative as well. absolutely no conviction or strength at higher levels. That intraday recovery that we had seen has been sold into very, very swiftly, and the principal contributor to that has been the Nifty Bank, and that was the contributor towards that 1,000-point rally as well that the Nifty had seen, and now instrumental in pulling the index lower as well. Take a short break. On the other side, it's our special segment Under the Lens, and the stock in focus in that is going to be IRM Energy. More on that on the other side. Welcome back onto our special segment Under the Lens, and Sonal has hopped across to the wall to put the spotlight on IRM Energy. Sonal.
Thank you so much for that. Well, yes, let's talk about IRM Energy. The stock has been on quite a run, up almost 33% just this month when the markets last week did not do so well. But here's the catch. It's still below its October 2023 listing price of 477. So what's the business for this company? IRM is into city gas distribution with networks in Punjab, Daman and Diu and Tamil Nadu as well. It supplies natural gas to factories, shops, households and even autos. The numbers tell you the story. In Q1 of FY26, revenues were 262 crore rupees. Last year, which is in FY25, they made 975 crore rupees, pretty much flat compared to FY24. The bigger issue is margins, which have slid sharply from a high of 37% in FY22 to 17% in FY24, and now around the 10% mark in FY25 and Q1 as well. That shows in profits too. PAT is down from 128 crores in FY22 to just 45 crore rupees last year and 14 crores in the latest quarter. The company though is guiding for better times. They expect EBITDA per unit to rise to 5.25 to 5.5 this year, which compares with around 4.6 which they saw in FY25. Plus, they plan to roll out 50 new CNG stations in FY26, which should help volumes as well. There's also regulatory tailwind. Number of zones for pipeline tariffs is being cut from 3 to 2. That's a big plus for IRM because they say 70% of their volumes move to a cheaper zone, which means meaningful cost savings. But investors aren't ignoring the concerns, particularly a 2% royalty payment to IRM Trust, which brokerages like HDFC Securities believe will continue as per the license. That's an extra cost hanging over earnings. Now on to the valuations. IRM trades at around 17 times FY26 earnings. That is in line with IGL also, which trades around 16 times. But it is cheaper than Gujarat Gas, but it is more expensive than MGL, which trades at 9 times. The real gap is in returns. IRM's ROE is only 5.2%, while peers are comfortably in the mid-teens. So yes, the stock has got momentum, but the real test will be whether IRM can lift margins back up and improve returns versus the peers, because it's a subjective market, right? That's what the market will be watching before it gives the company a higher multiple going forward.
Another name in the list of recent outperformers but trading below their IPO price, IRM Energy, our special segment Under the Lens. Sonal, thank you for that deep dive on the stock. The Nifty off the highs of the day at the flat line. The broader markets too have seen a sharper fall from the highs of the day, and that is courtesy the Nifty Bank. We take your leave on this edition of Trading Hour from Sonal and me. Thank you for watching. Halftime report on the other side.
Markets off morning highs, mid-caps fall in line, PSU banks, realty and metals gain, while FMCG and consumer durables trade weak.
The Indian Army floats a 30,000 crore rupees tender for the Anant Shastra surface-to-air missile. BEL, being the integrator of the missile system, could see unexpected win, pushing its order book to over 100,000 crore rupees.
The United Kingdom has backed Tata Motors Jaguar Land Rover with a £1.5 billion loan guarantee to support its supply chain that's running thin on cash. The government backing will project jobs of thousands and protect those jobs and align with Britain's focus on industry to boost growth and exports.
Ministry of Petroleum and Natural Gas flags low valuation of enterprises under its wing. It promises performance-linked pay for top execs, rules out levies like windfall tax, promises price stability and value unlocking via divestment. Basically, all things that the market likes. And these stocks are higher today. Good afternoon. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu, with me Vinny Motiwala. If you look at the markets, absolutely flat for the frontline index, but the first half, so much happened, right? After 6 days of consistent decline for
they missed
our
you,
markets.
Mangalam.
Well,
at least the bulls did.
The bulls missed me, but now that I'm back, the market's flat again. So I don't know whether the bulls missed me or the bears missed me. But be that as it may, the interesting part is that we opened higher today, and that's what was on the cards, given the sort of drubbing that we had seen for 6 days. And now the highs have actually been sold into once again. As we move into this fairly eventful week, we have the monthly expiry tomorrow. We have the RBI monetary policy outcome as well. We also have a holiday this week, and the streets celebrating the Shera. We'll also find out for, what will be the outcome of any sort of trade agreements that will happen between the US and India as well. So event-heavy week. Market's been seeing a lot of selling already, and now highs are being sold into. So a lot to happen.
Absolutely, a lot to happen. And Mangalam, since you were mentioning about tariffs as well, those most favored nations, there's going to be some discussion in terms of tariff on that point as well. So that will be key to watch out for, especially in terms of pharma companies as well. What finally comes out for these nations is a key to watch out for. But other than that, in terms of sector performances today, look at the PSU bank. That's managing to hold on to gains of almost 1%. So that'll be something we'll be keeping an eye out on. The real estate pack also managing to hold on to gains, while the flip side, obviously, of media, that's down and out. Auto is not managing to hold on to gains as well. So that's what we're looking at in terms of the markets, and clearly at least some bit of a better performance is coming from the broader end of the market, though that has also fallen off and come off the day's highest point, but it is still holding on to gains of almost 1/10 to 2/10%. Again, it's come off. So that is something that we'll be keeping an eye out on. But that's how the market is looking like, very flat right now, muted as of now this afternoon.
All right. You're talking about a lot of these pharmaceutical names. You're looking at Lupin and Wockhardt. What exactly is special here?
Absolutely. So, Mangalam, what we're watching out for today, especially for Lupin and Wockhardt, let me start with Lupin first. Now, Lupin, obviously, there was an announcement that came in where the company is wholly owned subsidiary in Netherlands. They entered into a definitive agreement with Visu Pharma. That is an ophthalmology company in the European region. Now, they have a lot of these countries which they cover or sell their products in Europe. UK is also one of them which is included in terms of the sales that come in. So, for what does it mean for Lupin? One is just a 190 million euro purchase or acquisition that they are looking at. This is around 12 to 13 times the EBITDA. Analysts are saying this is a very positive one coming in for them because they can further expand their reach in the European regions. And other than that, in terms of overall the revenue, which you look at for Visu Pharma, for 2025, the expected revenue is at around 54 million. 2024 was 48.1 million. So they're expected to grow in that 10% CAGR range as well. And that's what they've been growing around in the last 10 years. So good acquisition, expected to improve their growth as well as the margin profile. Now, in terms of Wockhardt, obviously the reason is mainly because we had those clarifications that came in from US that saying that countries with existing trade deals with United States are exempt from that 100% pharma tariff, which they were talking about on branded products and branded drugs last week. Now, obviously, this will mean that EU has a tariff of 15%. So for products that are being sold from EU will be at 15%, or exported from EU to the US is going to be at 15%. Now, what the management last week when they spoke to us, they said that Zynic, which is an important drug for the company, is unlikely to get impacted because they were in the EU region. So that important drug for them will not see an impact coming in. And that is why this is, sentimentally positive for the company in terms of the impact impact that we could see also would be much lower, and that is why the stock is holding on to gains of almost 7-8% today, Mangalam.
All right, so those are a couple of these pharmaceutical names which are on our radar, but Vivek joins in. He has a lot to speak about on Vascon Engineering. Vivek, so we're talking about movers and shakers, Walkard up around 8%, 1% higher for Lupin as well. But Vascon, that is top of the pops, up 9%. What's causing this move?
Well, a very interesting update, that the company has put up over the weekend. Now, what exactly is the company saying? The company is saying they've signed a 5-year memorandum of understanding with the Adani Group, and this is Adani Infra. So, what will Vascon's role be in this particular MOU on this partnership? They will act as the execution partner under an early engagement model. So, Vascon says they will be involved in the projects, engaged in the projects from the design stage itself, and they say that 3 projects in Mumbai amounting to totaling close to 13.15 million square feet has already been identified. Now, the partnership, Vascon says, is expected to contribute an additional 30% to the company's turnover. What the details in terms of actual timelines, when the projects will start, what will be the margins that Vascon enjoys, at this point of time, it's not yet available. But clearly, given the fact that it improves revenue visibility significantly, remember, the end of Q1, Vascon's order book stood at just around 2,900 crores.
Okay, Vivek, thank you so much for that. But Mangalam, you're keeping an eye out on HUL as well, and this is post that Q2 update. What is it highlighting, and today why is the stock a bit muted then?
Well, a couple of things, that stand out. We've been speaking to a lot of the consumer companies post the GST announcement that came here on HDR, and they said that there could be some near-term disruption on account of the GST cuts that have been announced. And remember, the GST cuts came into effect from September 22nd. So that implies that, the last 4 or 5 days of a working month where you do see a lot of inventory being pushed to the dealer channel, those sales were taken out. And that's exactly what HUL is saying as well. The second quarter will see nearly flat to low single-digit growth on a consolidated basis. And it was supposed to be a washout quarter. Everyone on the street was expecting that for a couple of reasons. One, that, a large part of the transition from GST would impact the trade channel, so there would be disruption on account of that. And in the earlier part of the quarter as well, there were a lot of unprecedented rains in a lot of the important markets. There was flooding, etc. So that could have impacted sales as well. So all those factors meant that the second quarter would be a washout, and that's exactly what the street was pricing in as well. That's why the stock opened lower, and thereafter we saw a bit of a recovery. But why is it still holding lower? Because the company has said that they anticipate recovery starting November. Now, most on the street thought that this transitory impact would come undone in the first week of October itself, and that will be a positive. But because signs of this disruption will percolate into October as well, it's a bit jarring. Why is that? Because October is where you have both Dussehra and Diwali. So a lot of the festive season sales that everyone is building their anticipation on will still be disrupted. So for someone like an HUL, if your most important month in the year is still disrupted and recovery is only seen in November, that's not particularly good news. That explains why the stock hasn't recovered as ferociously from the lows as the street was earlier anticipating, and sitting with a cut of about 0.5%, despite having seen a cut of almost 5% over the last 7-8 trading sessions itself. So that's about why HUL is lower. But for all the other FMCG companies, I do believe that, the recovery would be a lot faster than early November, as HUL has been pointing out, and festive season sales would be good for the entire sector by and large.
Absolutely, Mangalam. I think HUL, maybe Sal Mubarak will be a good year for them.
Let's see that. But for them, the bigger trigger always is the leadership change coming in, beauty and wellness doing a lot better, and them generally getting their act together. So this is just a niggle in the long-term prospects of the company.
Absolutely. Thanks so much for that, Mangalam, explaining us about HUL as well as other FMCG companies. But let's go across to Vivek again, who is here to tell us which are these other stocks that are moving around in trade. What are we keeping an eye out on, Vivek?
Well, that's right. So especially in the last half hour or so, what we've actually seen is that the advanced decline ratio has actually deteriorated a little bit. But despite that, a few stocks have actually managed to make a bit of a comeback, especially the pharma names. A lot of the pharma stocks, remember, they took a sharp knock on Friday. Most of them today have managed to bounce back a little bit. Vocard up almost 8%, Cites up 1.5%. Cipla Lupin were higher, but have cooled off in the last half hour or so. The other stock in focus is Sammaan Capital. That particular stock is out of the F&O ban. No particular trigger, but that stock high by almost 10% in the session today. The entire PSU oil and gas basket is doing quite well in the session today, and this across both upstream as well as downstream. MRPL high by almost 4.5%. Remember, all of the oil marketing companies actually met the minister over the weekend, and those stocks, also high by almost 2.5-3% today. Have a look at Bharat Electronics as well, one other stock from the PSU space.
a very large order bill, the quick range surface to air missile, almost 30,000 crore worth of order. Now there is a lot more visibility on that. That stock high by almost 1.8%. On the other hand, quite a few laggards as well. Have a look at the entire EMS space. Most of these stocks, some worries in terms of tariffs is something that has come about. And the back of that, have a look at Dixon, Umber, Keynes. All of these stocks significantly lower in the session today, among the top F&O laggards as well. The entire shipbuilding basket today, most of these names have cooled off. Mazagon, Cochin, Garden Reach, all of these stocks anywhere in the range of 2.5% to 5% lower. M&M Fin, one of the top F&O laggards in the session today, almost 3% lower. Jindal Stainless, very high volumes of this particular name are typically much lower, down by almost 4.5%. And Axis Bank, private banks have cooled off a little bit from the day's highest point. Axis Bank down almost 2% today.
Okay, thank you so much for that, Vivek. But on that note, we're going to slip into a very short break. Don't go anywhere. We'll be back with more updates on the other side. Welcome back to Halftime Report on CNBC TV18. As of now, Nifty 24,640 is what it's managing to hold on to. Flat with a negative bias is what the Nifty is trading at. In terms of the last 10-15 minutes, what we're looking at in terms of a fall, SCI pulled that up. That's down almost 1% in just the last 10-15 minutes. So that'll be interesting to watch out for. Other than that, we have Minda Corp. That's also seen a bit further more of a fall, around 1% of decline in the last 15 minutes. So that is something that we'll be keeping an eye on. Other than that, obviously we're seeing that pharma, we're seeing Wockhardt Hospital that continues to manage to hold on to gains. Other than that, we have JB Chemical Pharma that is also managing to hold on to gains, as well as Zydus Life. And Sun Pharma. Sun Pharma is a big one, Mangalam, there, because Sun Pharma also, everyone was worried about the exposure that they may have to US and the concerns that come in there. But today that's managing to hold on to gains after the clarification that's come in.
Those are the big boys. I'm just looking at a couple of these cash stocks which are surging right now, and big volumes on that one. Shalimar Paints up 7%. Specialty Restaurants has crossed its 10-day average volume. Now the average volume on that stock was a certain number, and Specialty Restaurants is seen 10 times their traded average volume on that stock already. It's not Shanti Gears, it's Specialty Restaurants. That's the one that should come up for you on the screen right now, up around 11%. And the other one is V2 Retail, up 7%. We had the management join us on the channel today. They target 50% revenue growth. They expect, the Ind AS margins, pre-Ind AS margins to come in at around 8.5% with 8 to 10% same-store sales growth. So V2 Retail is the other stock that comes up for you, seeing a bit of a spike, up around 7%. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us.
Welcome back to Halftime Report on CNBC-TV18. As of now, let's look at what the Nifty is doing, and Nifty is managing to just hold on to 24,600. Yeah, it's just around that mark. So not much of a worry that we're keeping an eye out on in terms of an up move or anything that we're seeing in terms of a move there for the Nifty 50. Let's look at the broader end of the market. If there's any sort of a recovery there, not much there, but still it's in the positive side right now. The Nifty Midcap 0.05%, so around that flat line. Let's see if that furthermore sees a recovery. That'll be interesting to watch out for. And like we started the show by saying, those important triggers that Mangalam had highlighted, that will be the key for the rest of the week as well. In terms of the top gainers today in the broader end of the market, we have Indiabulls Housing Finance. That's the one that managing to hold on to very strong gains. 8-9% of gains right now is Indiabulls Housing Finance. We have, those BPCL, MRPL, OMCs names. Keep an eye out on all of that as well. OMCs are the ones that we are keeping an eye out on today as well. OMCs buzzing in trade. But let's go across to Mangalam, who's at the FNO desk now to tell us what's happening this afternoon in the world of FNO. What should we be keeping an eye out on?
Well, a couple of things. If you look at the frontline indices, you have the Nifty, the mid-cap index, the smaller cap index. All of them have come considerably off the highs. The Nifty is actually now, down about 150 points from the highs. The mid-cap index is still holding mildly in the green. The small cap index is the one which is fairly lower as well. And if you look at the day's high on the Nifty, very close to that 24,800 mark, 24,791 is what we've seen as the day's high on the Nifty. You do have, the other sectoral indices as well, which are on our radar. We have the Nifty Bank as well as the Nifty IT index. Both of them are underperforming. The Nifty IT index, however, is managing to hold on after an 8% drubbing is what we saw earlier. And the auto index too, ahead of the festive season, is flattened out a little bit. Remember, the auto index has actually outperformed a bit. And here's where the Nifty high is. So that's an extremely crucial mark. Why do I say that? Because, the earlier part of the market, we saw a fair amount of oversold levels getting undone. So you had, the Nifty put-call ratio, which moved from 0.63 to around 0.87. We've seen the volatility increase as well. So the India VIX comes up for you. That's the other one which is higher too. And at the same time, we have important triggers to track. We have the September series expiry tomorrow. We have the RBI monetary policy outcome that will come by. And then we have a bunch of other important events to track as well, which include the likes of any developments in the US, India, and global trade talks that will happen. But ahead of expiry, what are the options which are fairly active on the Nifty? Just look at, the 24,800 call and the 24,700 put. The banking index, the auto stocks, all of them are seeing some sell-off. So we'll watch out for those stocks. So the 24,800 call has a premium of 27 rupees, telling you today's high will be an important level to watch out for. 24,700 put, however, is seen a fair amount of writing and a premium is 70 rupees. So 24,600 to 24,650, where the Nifty is right now, is an important support zone to track for the frontline index. On the way up beyond 24,800, we obviously have the 50-day moving average, which will come up as an important resistance. So the easy pickings have been done. Now the market's flattened out once again, very close to support zones. Let's see whether it makes an excursion towards that 24,800 mark once again or not. All of that will depend on the stocks that I just spoke about. There's Maruti, there's Axis Bank, all of them which are under pressure. The one stock I'm watching out for today is Sammaan Capital. Has been buzzing around right from the word go as it exited FNO ban. But with all the open interest jump, it looks like it will re-enter FNO ban in today's trading session one day ahead of expiry.
Okay, Mangalam, thank you so much for that. We'll keep an eye out on that name, specifically Sammaan Capital. But let's move on and shift focus now to the primary market action. Tata Capital's rupees 15,000 crore IPO opens on 6th of October. My colleague Reema caught up with the MD and CEO of the company, Rajiv Sabharwal, and began by asking his view on the growth outlook for the company going forward. Listen in to a slice of that conversation.
If you look at our past, we've been growing over the last 3 years at 28% on our books, and our profits have grown at a faster pace. There was an impact which happened because of the merger, but if you look at our growth rate in the future, we do believe that there is a potential for us to follow the similar path. Our book is pretty diversified. We are present in all segments of the business, and that helps us provide multiple engines for growth. And keeps the book fairly diversified and good on the risk side too.
Let me ask you on your yield and advances. At 12.6%, it's lower than peers. Bajaj Finance is at 16.7, Shriram 17.8. Why is your yield on advances the lowest in the sector or amongst the lowest?
I think you have to look at it from the context of mix of assets and the credit costs. Both of these things are extremely important. We have chosen a path of having a lower unsecured book, which we believe keeps the book more resilient in difficult times. And it also allows us, the mix of products allows us to have multiple engines of growth. We do believe that our credit cost, which is the lowest in the industry, allows us to still have healthy ROAs despite the yields being.
So what's the target NIM in mind? You're currently at 5.2%.
I think when we look at the past, we have seen a steady growth in NIM happening. We do expect for us the future to be similar to what's been there in the past, the trajectory to look similar.
But do you think you can get to where, say, a Bajaj Finance is or a Shriram is, which is at above 9%?
I think it is not about NIMs alone. It's a combination, as I mentioned to you, NIMs, the cost of doing business, the operating costs, as well as credit margins. So I would say when you look at all three, they finally lead you to return on assets and then return on equity. And we clearly will be competitive and at an attractive ROA and ROE in the future.
Okay. There's one criticism, if I may call it that, is the absence of a hero product. For instance, Bajaj Finance is great in consumer loans. Shriram Chola in the CV market used, where Muthoot Finance and gold. This helped the companies grow very fast, get good yields, and still keep their NIMs in check. The asset quality in check. I mean, what is Tata Capital's strategy going to be?
So we follow a strategy of not having a single hero, but having multiple heroes. If you look at our housing finance business, it is large and has, the housing finance company has a book size of about 71,000 crores and also has the highest ROA and ROE in the industry. If you look at the past, the ROA has been over 2.5% and ROEs in the
housing finance market.
In the housing finance company, ROEs of about 18 to 19%. If you look at our clean energy business, that business has one of the best quality books in the whole industry. We have very low NPAs and the returns are very good, besides contributing towards a green energy environment. Similarly,
actually, if you could just break up the book for us, 2.33 lakh crore is the book. Break it up for us in the various segments.
So if you, on a broad basis, if you look at the overall book, 63% of our book is retail, and that would be almost equally split between the housing business and the rest of the retail business.
Which is?
Which includes products like loan against property, personal loans, business loan, two-wheeler loans, education loans, used car loans, new car loans, commercial vehicle loans. So we are present in the whole spectrum of the retail business. Besides housing and consumer business, which I mentioned to be about 63%, about 26% of our business is SME. So about 89% of our total business is retail and SME. Within SME also we have multiple products, whether it is channel finance, term loans, leasing, equipment finance. We are present across the spectrum. And the balance, about 11 to 12%, is the corporate business.
Let's talk about this merger with Tata Motors Finance Limited. It just got concluded in May this year. So when you took it on, what did it bring in terms of the size of the loan book and even in terms of the asset quality? Because what we understand is that the asset quality of TMFL was actually quite poor.
For us, before the merger, we were not present in the commercial vehicle space. And that's a pretty large market.
Yeah.
It's a market with a size of 10 lakh crores plus, with a yearly disbursements of about 1.5 lakh crores plus. We do believe that this new segment will give us another engine for growth in the future.
What was the size of Tata Motors loan book?
This book, when we took over, was about 28 to 29,000 crores and formed about 11% of Tata Capital's total book.
Okay. And in terms of NPAs, what were the NPAs?
So their NPAs were slightly higher in the region of about 5% or so. In terms of our approach, as I mentioned to you, we've always been very conservative and have had the NPAs as well as credit costs amongst the lowest in the industry. And that is what we will look to replicate even in the commercial vehicle business.
Do you think it's possible to bring the consolidated credit cost to sub 1%? And how long will this turnaround effort take for you?
So, as again, we've always been below 1. Our endeavor is clearly to remain in that region itself.
And how long will it take for you to get there, to your mind?
The shorter the better.
Of course.
And I think we should be looking at that happening over the next 12 to 24 months.
Just talking about the near term, in Q1, your loan growth was, I think, only about 17%. I mean, is there some sort of a slowdown? And what's been the extent of transmission of interest rates?
So if you look at Q1 and you break it up into two parts, the motor vehicle business and the erstwhile Tata Capital business. Tata Capital's business grew at about 23%.
What is your own loan growth guidance for FY26?
So as far as growth is concerned, we do believe that it's a function of what happens in the economy, but it should be within the 20 to 25% range.
All right, with that, what we'll do is, take note of this IPO, and obviously between 6 to 8 October is when it opens for subscription. We'll talk a lot more about the company and the prospects going forward. That's about Tata Capital. Let's get in some market technicals now. Aditya Agarwala joins in. Aditya, the early part of the day, we were expecting a bounce to happen, especially given the oversold conditions in which the Nifty was. Right now, we are seeing some sell-off from those levels, from higher levels. Do you think this is tradable right now, or we're still in that no-trade zone where there is no direction right now, given the sort of, drubbing that we've already seen earlier and the fact that there is selling at the top? What do you do?
Good afternoon, Manglam. Thanks for coming to the show. Clearly, it's a no-trade zone at the moment because we are directionless, to be honest. We are stuck in a range between 24 on the downside, 24,400, 24,500 on the upside, 25,000 is where we are facing stiff resistances, and above that 25,400. So we are stuck in a narrow band on an intermediate term and a slightly broader band on a larger time frame charts. But having said that, my sense is you will see a base getting formed somewhere around these levels of 24,600, 24,550 on the downside, and you could see a short covering rally from these levels. You just have to be a brave heart to take a trade here because you never know, the stop loss might get triggered and then market can show a short covering rally as well. So if you are a brave heart and you can take a trade in the market, then yes, these are times to go long on the market because risk to reward is clearly in favor. Markets are very close to a strong support zone of this 24,600, 24,550 on the downside. Keep that as a stop loss and look for a long trade here. And you can actually see levels of 24,800 to about 25,000 again on the Nifty. Talking of Bank Nifty, my sense is that too is approaching a key support area of 54,200 on the downside. And we have seen a decent bit of a rally from the PSU lot. My sense is now maybe a large cap names, and especially the larger names, need to chip in. We have seen some bit of a bounce back from Axis Bank previous week. Today it's down. But my sense is over a period of time, you should see large cap private sector banks also chip in from these levels. So overall, from clearly a risk to reward perspective, because markets are sitting so close to support, I would be looking to go long on both Nifty and Bank Nifty.
You would be looking to go long on the Nifty as well as the Bank Nifty. So you're that brave heart, Aditya. But which are those other stocks that you're keeping an eye out on in terms of trading strategies?
So I've got a couple of buy winis because I think banking stocks are at a support level. And RBL Bank actually has been a surprise on the upside. Stock has constantly been making higher highs, higher lows, and in trade today we've seen a breakout from a consolidation phase. So I'll go long on an RBL Bank for its strength in the stock for a target of 300 on the upside with a stop loss on the downside at 265. And all the OMCs are showing strong performance. IOC is something which is looking very strong on the chart. So I will go long on IOC as well for a target of 160 on the upside and a stop loss at 142 on the downside.
All right, Aditya, thank you so much for that. So those are a couple of stock ideas that he has. He spoke about the commodity space. So let's, take a short break. On the other side, Peter Maguire of Trading.com joins in with Manisha Gupta, and they talk commodities. Peter hopefully will also speak in about the cricket match and we'll get all that going after this very, very short break.
Welcome back, and Peter McQuarrie, CEO Trading.com, now joins us to talk about the kind of run-up that we've seen in gold and silver both. Peter, go to gold first. Yet another day, another all-time high, 3,800 is taken, done now. And what are the next targets? Or is it now in an uncharted territory? It has been there for some time. But what are you making of these price moves?
Well, good afternoon, Manisha. I tell you what, it's breathtaking. And when you're seeing that, I'm just looking at the screen, December 2025 futures on COMEX running at 3848. I mean, that's incredibly blasting moves. You know, it's up the best part of $40 today or more. And the overall momentum is incredibly strong. You know, 4,000's got to be penciled in. And the way it's going, it could be there within the next week or two, if not sooner, because it's just got huge... it's absolutely parabolic. And it's the bullish trade, Manisha. It's just incredible.
It is. I get the point, Peter. You know, a lot of people also now seem to be saying that, yes, on charts, it is overbought because we started this year with 26.50. We are trading at 38.15 in spot right now, but it still is under-owned is what the feeling is, especially when it comes to retail from most part of the world, even institutions for that matter. Funds have started to buy into this. ETFs buying is quite strong as well. Is the market now FOMOing out, or do you think there is a strong, concrete moves that we could be looking at in sense of price supports?
I think, Manisha, I think there's still a large degree of the population that haven't engaged in gold. That's globally. So whilst we're here at these sort of points, the overall momentum is really starting to gain traction. Young people, I know that India's got, you know, it's part of your culture, but very much across the West, they're still starting to wake up. I think they're saying, well, it's up 40 and 50% moves. It's you know, a ballistic move. And it's really gaining so much. It's gaining airwaves on radio, on TV, in the press. Main Street is really starting to take large gulps of oxygen that, you know, all about gold, and that and the overall storyline isn't changing.
Oh, it isn't. And all that glitters is definitely gold, but it's silver as well with nearly 63% of gains, $47 an ounce onto that one. Where do you see that going?
Manisha, that's the one that's the standout. I really think that, you know, the little brother is caught up and it's catching up and it's overtaken from a price perspective as far as performance. It's been extraordinary. You know, and as you just said, nearly up 63% since the April lows. Just quite mind-blowing in that 6-month window. So, you know, it's 47 on COMEX now, 47.35 for December 2025 contract. $50 is very much, as soon as it breaks 50, I think we change our philosophy because it's running away and it's just so aggressive to the upside, Manisha. So I'm expecting that to be taken out probably in the next couple of weeks, certainly during the October period, because its overall momentum is just extraordinary. It's dynamic. It's explosive.
Oh, it is. So while silver is giving you best returns in 10 years, gold is the best that it has given since 1979. So those are the kind of history that we are making when it comes to gold and silver. Platinum not too far behind, Peter.
No, platinum's great. I mean, you know, it's been a wonderful metal to trade, Manisha, but the shine, you know, whilst it's got industrial demand and we're all conscious of it, and a lot of people certainly like it from an investment standpoint, and across, you know, platinum shares and physical as well. You know, you can't dispute that it's been extraordinary, but I think the focus is very much on those other, it's close cousins, gold and silver. So, yeah, keep an eye certainly on platinum, but yeah, the whole complex is just on fire.
Peter, when you see a run-up of that kind, shape, scope, would you say that some correction, even a healthy one, is not too far behind? So if you had to talk ranges from here, a certain support in some sense, a pullback that we might be looking at in gold and silver, where do you see that happening until?
Maybe a few dollars. I mean, for silver, Manisha, you could see it's not unusual. As you just said, it's since 1979. These are once-in-a-lifetime storylines. And what we saw as far as 1979, that was a big run-up from considering 72 when it was $35 an ounce. So, you know, the overall momentum has been extraordinary, and this doesn't happen often. And you can see wipeouts. You can see $100 stripped out of it very, very quickly. It might, you know, I'm not saying it won't happen. No doubt it will happen at some inflection point. And there will be a point in time that's what markets do. They get overbought and the hot air, you know, evaporates. And silver could, you know, certainly take a few dollars stripped out of that as well. But at the moment, I think it's very much bullish. But when we do see that pullback, that's probably a better time to start buying even more.
So when we're looking at those way more bullishness that you talk about in silver, would you say copper would go the same way? Because we have seen very, very strong strength come in for copper in the previous week. There are supply disruptions that we have been talking about. But with China saying that they would now start importing copper, That's given another leg to this commodity space. Are you looking at much more bullishness there too?
I think so. I mean, it's through that $10,000 a metric ton on the LME. It's got the potential to probably run hard to say 10.5. From a percentage standpoint, I wouldn't be surprised maybe 3 or 4% up over the next couple of weeks. And the support is going to be from, the industrial metal side, Manisha. But it's nothing like we're seeing in the precious space. But, I think it'll drag the other ones up as well. Keep an eye on aluminium and certainly zinc.
We don't know what you guys, did talk about to the street right now when it came to gold, largely because he was talking about smashing and exciting and all of that and stuff. Seems like people have suddenly taken their money out of equities and pouring into gold right now, because just as this conversation was happening, just take a look at the intraday chart of the Nifty. Manisha, we started the segment at 24,650 on the Nifty, and now we're 24,600. Why? Because perhaps gold is where people are deploying their money in. But at the low point of trade, we have the Nifty Bank, which is down 150 points. I don't know what you did there, Peter, but, good on those who are investing in gold right now. But taking away from the equity market, seems like we have the Midcap index, which is marginally in the green, that has moved into the red as well. And the India VIX has seen a spike of almost 10% from the lows. So there has been a decline from the highs, and we're currently at the low point of trade for the frontline indices. Thanks a lot, Manisha and Peter, for joining in. But amidst all of this volatility, one of the stocks which is doing well today is Dollar Industries. The management has gone ahead, or rather the promoters have gone ahead and told the exchanges about their intent to merge some of their group companies to become a vertically integrated entity. What does that mean for the listed company, and what do shareholders look at? Vinny, tell us more.
Hi, yes, so absolutely, we're keeping an eye out on Dollar Industries today because of these reasons. 9 promoter group companies, now they'll come under Dollar Industries itself. This will include some of the companies, right, this real estate side, commercial real estate leasing, some of the companies were doing, the yarn side of the business, the branded arms where they were even manufacturing garments like leggings and kurtis. All of that now will come under Dollar Industries. Now, for this, there's going to be a share swap, and issue of shares of around 29.8 lakh shares will be issued to the promoters of Dollar Industries for this deal that is going to be taking place. This is all going to be through this share swap because related party transactions. Promoter stake will increase to 73.6% now, and this is all done at an arm's length price. That's a clarification, or the company has highlighted in the press release. What are the synergies? One, vertical integration that will boost the manufacturing process, right? Supply chains, everything that used to come in terms of from products from here, all the subsidiaries to Dollar Industries will now all be within one company as well. So not much of a worry there. Supply chain efficiency comes in, reduction in terms of related party transactions, you'll see lower logistical costs, as well as faster project execution that comes in for the company in terms of pipeline. That is also something that improves for the company. Now, Arihant Capital has highlighted that, this level of merger could actually generate an annual saving for the company of 2 to 2.5 crores. So that is interesting to watch out for, but surely a positive way that we are looking at in terms of ease of doing business. The Dollar Industries has come off the day's highest point as of now, but holding on to gains of almost 1% in today's trading session.
All right, so that's about Dollar Industries. Meanwhile, we have a couple of these real estate players which are doing well. Sunteck Realty obviously entering the luxury market, so that holds well. But right now, Oberoi Realty too has moved higher, so that's another stock that's doing well. And we have a bunch of pharmaceutical stocks as well, which are spiking right now. But we have Strides Pharma, which has moved higher from the lows. Fortis Healthcare is at the high point. And we're seeing some traction in names like Petronet, LNG as well. All the oil marketing companies have been doing well all through today's trading session. Now, what else is moving? We do have, more of the same. Specialty restaurants, we spoke about that. Yes.
For some reason, Godfrey Phillips, Divyani International, despite the market seeing a downtick, those two have come up in the last 40 minutes.
So, yes, we saw that some traction. Maybe QSRs would probably be only because of the festive season and the holidays, because specialty restaurants, like I pointed out, was up 11%, now is up 13%, so extending its gains. And then we did see some traction in a lot of these quick service restaurants in the previous week as well. The market was a little wobbly. So let's see how that goes. We'll probably take a short break right now, come back, focus on a lot of other stock-specific action. And a lot of the sectors that are moving around as well. FedFina, for instance, that stock too has moved higher as we speak. Take that break, come back, focus more on all things equities. Welcome back. We were talking about, the markets seeing a bit of a wibbly-wobbly move. From 24,600 level, there has been a wee bit of a recovery. So the losses have been curtailed from about 50 points to about 30 points. Nothing really to write home about. Titans doing well, so ahead of festive season maybe. And obviously, Manisha and Peter talking about gold doing a lot better. Gold is now the main street news. So that stock's moved higher. And we've also seen some traction in the last few minutes on a couple of these, financial names. So FedFina, for instance, before going into that short break, we saw that stock move higher to the high point of today's trading session. But let's talk about the pharmaceutical space. A couple of these stocks were buzzing around in focus. Winnie, what's the latest?
Hi, yes, so we're keeping an eye out on overall the pharma pack. One, in terms of the clarification, obviously, that came in over the weekend, right? Do not forget where we had the White House say that the countries with existing trade deals with the US are exempt from pharma tariffs. We spoke when we were talking about Wockhardt as well, right? So Wockhardt, Sun Pharma, they're seeing a bit of an up move because of this clarification that's come in. Because now Wockhardt, when they spoke to us last time, like I mentioned, they had said that 15% tariff is between EU and US, right? So then most of the Xenic product, which is the drug, that is sold from EU. So that concern goes away. Even if there's a 100% tariff that comes in on branded and patented products and drugs, that's not much of a worry for the company. Sun Pharma specialty branded portfolio makes up around 19% of the total sales. So yes, if the deals with other countries still stays as it is, then it's not a worry for Sun Pharma as well. Other than that, obviously, we had a note that came in from Morgan Stanley on this as well. They said that, EU-made drugs which are exported to the US will continue to attract that 15% tariff, and obviously positive for Sun Pharma because of this EU tariff clarification. Most favored nations, they're going to be meeting the status in terms of update on tariffs will be coming in this week. So that is important to watch out for. And China has also given a commentary over the weekend that they said that they would reduce 30% of the import duty on Indian farmers, and an incremental positive that comes in on a sentiment front, given that actually China has most of its generic drugs, or the domestic market is very strong, so they can suffice themselves. But a little bit of that positive sentiment does come in for the Indian companies, and positive for Dr. Reddy's is what Morgan Stanley is highlighting, given that its EM and China foothold is much more than other companies that you would compare to in India. So that is why we'll keep an eye out on these pharma packs as well. As of now, Nifty Pharma has also come off the day's highest point. A very, very flat line is what we're watching out for right now for the Nifty Pharma. Other than that, obviously, just keep an eye out on Biocon. I just want to highlight that because they proposed for an early redemption of NCDs worth around 1,070 crores in a board meeting that will be happening on 1st of October. So it will be important to watch out for Biocon going forward as well. As of now, 0.6% of gain for Biocon as well.
All right. Meanwhile, just watch out for Nazara Tech. That's another stock which is on our radar. Has seen a bit of a knockdown, down about 5%. Obviously, this morning they did speak about, the bonus allotment of the shares post the issue. So maybe some bit of supply coming in, or just incremental selling is what we're seeing on Nazara Tech. But another stock which is on our radar is BEL, a near 100,000 crore worth order book opportunity on account of a 30,000 crore QRSAM tender. Apart from the full form of QRSAM, there'll be a lot more what it means for the business of the company, for which Ria will join us and explain the whole details. Ria, let's start with the full form of QRSAM.
Well, yes, Mangalam, it is a quick reaction surface to air missile, and as you said, the Indian Army has issued this tender worth about rupees 30,000 crores to BEL for this QRSAM order. Now, the Indian Army is going to procure around 5 to 6 regiments of this indigenously developed Anant Shastra surface to air missile weapon systems, as they're calling them now. And remember, back in May, shortly post Operation Sindoor, the DAC had cleared the procurement proposals for this project. Now, BEL will be the lead integrator for the project, and they are expecting execution to commence primarily from FY27 onwards. This order now enhances BEL's order book to more than rupees 1 lakh crores, and the current order book position at the end of Q1 of FY26 was about rupees 75,000 crores. The total order inflow in FY26 so far, X of this order that we're talking about, is around rupees 11,500 crores, and this meets around 42% of the company's FY26 OI guidance of around 27,000 crores. Now, the company has also maintained its EBITDA margin guidance at 27% for this fiscal, and the revenue growth in the medium term is expected to be over 16%. Now, let's also look at some other companies that will contribute to this QRSAM project. Bharat Dynamics will manufacture the missiles for this project. The expected order value is between 10,500 to 12,000 crores for them. Apollo Micro is expected expected to onboard the computer and complete navigation system for QRSAM as well as contribute to the power distribution units for the project. And they are also going to be contributing to one of the critical actuation systems for this project. The expected order value for Apollo Micro will be between 800 to 1,000 crores. And this is important because the current order book of the company is just about rupees 735 crores. So this will be a big order for them. For Astra Micro as well, they will be contributing to subsystems like TR modules as well as subsystems for missile programs. The order value for them will be between 1,800 to 2,000 crores, and the current order book for Astra Micro is rupees 1,891 crores. For Axis Cades as well, this is also expected to contribute to the project, although the exact nature of contribution is not known, but the order value is estimated to be between 100 to 200 crores, and even two companies like Data Patterns and Paris Defense are also expected to contribute to this project.
Okay, Ria, thank you so much for that. We'll keep an eye out on all these defense names. And Mangalam, one thing that is not doing well today is also the shipping stocks and the shipbuilding stocks. You know, Cochin Shipyard, Garden Shipbuilders, all of them are under pressure in today's trading session. So that is what we'll be keeping an eye out on. But with that, we're going to wind down this edition of Halftime Report, leaving the Nifty at 24,638, 640 levels. So keep an eye out on that. It's a goodbye from Mangalam, me, as well as the team who put this show together. Thank you so much for tuning in.
Markets are off the morning highs. The midcaps fall in line with the benchmarks. PSU banks, realty and metals are some gainers, while FMCG and consumer durables are the big laggards along with banks.
The Indian Army floats a 30,000 crore rupee tender for the Anant Shastra surface-to-air missile. BEL, being the integrator of the missile system, could see the expected win, pushing its order book to over 1 lakh crore rupees.
The United Kingdom has backed Tata Motors' Jaguar Land Rover with a £1.5 billion loan guarantee to support its supply chain that is running thin on cash. The government backing will protect jobs of thousands and align with Britain's focus on industry to boost growth and exports.
The Ministry of Petroleum and Natural Gas flags low valuation of enterprises under its wings. It promises performance-linked pay for top executives, rules out levies like windfall taxes, promises price stability and value unlocking via divestment.
Good afternoon, you're watching Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormus Patakia. With me is Vamakshi Dhoria. Vamakshi, good afternoon. It's an extremely choppy day of trade. There has been some recovery from the lows, but the bulls would not be pleased with the turn of events over the last few hours.
Well, absolutely, Hormaz. In fact, in the last couple of minutes itself, we've seen a very good recovery play out as far as the Nifty is concerned. We're off the lows by almost 62 points, so that does bode well. Guess where the lucky charms, Hormaz. But the mid-cap end of the market is still managing to hold on in the green. For now, the mid-cap index is up almost 187 points, despite the kind of fall that we saw earlier in the day. There's some bit of recovery that is coming in out here as well. Other than that, the support is also coming in from Nifty Bank, because that too has moved into the green. It's flip-flopping between the green and the red, and the broader end of the market too, the advanced decline ratio largely in favor of the declines. It's a mixed looking screen for now, and apart from that, when you look at specific sectors as well, a lot of them in the green. PSU banks are doing well. Take a look at Bank of India. That stock is up almost 2.6%. Canada Bank is also doing extremely well, up 2.5%. Media, on the other hand, is not doing too well given the fall that we've seen in Nazara. That stock is down almost 5%. So of course, it's been a very choppy day, but we're seeing some big moves both on the upside as well as the downside, Hormaz.
Someone needs to tell the market participants that the expiry is tomorrow, not today. Almost giving expiry day feels considering the choppiness that you're seeing. But the one not so good thing about the fact is that despite being opening gap up, we have not managed to break the lower highs and lower lows streak. We've already made a lower low, considering the fact that we broke below Friday's intraday low, which was 24,629. So today's intraday low is 24,619 or 615, round about those levels. And of course, the intraday high now is still fairly distant at 24,790 odd levels for the Nifty. So that is something that the bulls would not like, continuing to maintain that lower highs and lower lows on the charts, and that is something that the market will be watching out for going into the monthly expiry session, which is tomorrow. And of course, the banking stocks, ICICI, Axis, Kotak are the big laggards, and support coming in from HDFC Bank and SBI. So choppy trading day. Head into the final 2.5 hours of the trading session. It remains to be seen how the day turns out. But of course, defense names have continued to remain in the spotlight. BEL among the top gainers on the index, while most of the other defense names are seeing some profit booking, including BEL. Now even that has cooled off from the highs of the day, and that is after the Indian Army had issued a tender for air defense missiles. Ria is now joining in to tell us more on not just BEL, but the other stocks that could contribute to this as well. Ria.
Well, yes, Hormuz, as you said, the Indian Army has issued a tender worth rupees 30,000 crores to BEL for the QRSAM project. Now, the Indian Army is going to procure around 5 to 6 regiments of this Anant Shastra surface-to-air missile weapon systems, as they're calling it now. And remember, back in May, shortly post Operation Sindoor, the DSC had cleared the procurement proposal for this project as well. Now, BEL will be the lead integrator for the project, and the execution is expected to commence from FY27 orders onwards. Now, Now, this order enhances BEL's current order book to more than rupees 1 lakh crores. The order book at the end of Q1 of FY26 stood at around rupees 75,000 crores, and the total order inflow in FY26 so far, X of the order that we're talking about, is roughly 11,500 crores, which is 42% of the FY26 guidance for the year, which is around 27,000 crores. Now, going forward, the company has also said that they are expecting EBITDA margins to remain at 27% in FY26, and revenue growth in the medium term is expected to be upwards of 16%. Now, let's also look at some other companies that will be contributing to this QRSAM project. The first one is Bharat Dynamics. They are going to manufacture the missiles for this project, and the expected order value is between 10,500 to 12,000 crores. For Apollo Micro, they are expected to onboard the computer and complete navigation system for this project. They are also going to contribute to the power distribution units as well as one of the critical actuation systems for this QRSAM project. Now, the expected order value for Apollo Micro will be between 800 to 1,000 crores, and this is important because the current order book of the company is roughly just about 735 crores, so this will be a big order for them. Now, for Astra Micro as well, they are expected to contribute to subsystems like TR modules as well as subsystems in missile programs for this project, and the expected order value for them will be between 1,800 to 2,000 crores, and the current order book for Astra Micro is rupees 1,891 crores. Even a company like Axis Cades is expected to contribute to the project. The exact nature of the contribution is not known, but the order value will be between 100 to 200 crores for this. And even two companies like Data Patterns and Paris Defense are also expected to contribute to this project.
Absolutely. Thank you so much for that, Ria, for putting all of those things into perspective. But moving on then, the Nifty rejig will come into effect tomorrow. Interglobe Aviation and Max Healthcare will be included in the index, while Hero MotoCorp as well as IndusInd Bank will be dropped out. Vivek tells us more. Vivek?
Well, that's right. Like you mentioned, so the Nifty come tomorrow will have a new look. So come October series, the Nifty will have two fresh constituents at the expense of two constitutions that will be making their way out. Remember, changes or the flows will happen in today's trading session, and that is what we are looking to get an estimate of. So Max Healthcare, like you mentioned, will enter. It's expected to see inflows of close to $360 million in today's trading session. Interglobe Aviation, or Indigo, is the other stock that will make its entry into the Nifty at close to $381 million of inflows is what the stock is expected to see. On the other hand, Hero Motor expect outflows of almost $300 million, and IndusInd Bank expect outflows of close to $220 million. These are analyst estimates as to the exact quantum of outflows. Another thing that our viewers should keep in mind is the fact that a whole host of these changes have been advanced or have been notified well in advance. So a lot of positioning has already been taken as far as these names are concerned.
Indeed, a new look for the Nifty 50 starting tomorrow with Interglobe Aviation and Max Healthcare entering the index, and Hero MotoCorp and IndusInd Bank being excluded from the benchmark. Now, the other major trigger this week is the monetary policy, and the three-day meeting of the MPC has begun today, and the governor will announce the rate decision on Wednesday at 10 o'clock. And what is the market going with? Lata is here with what she is picking up. Lata, good afternoon.
Well, before I tell you what the market is expecting, let me tell you the way the growth inflation dynamics has changed from the August policy to the one coming up on October 1. I did a poll of economists for what is their GDP forecast for FY26. In August, their forecast was 6.4%, and now it has become 6.7%, because intervening we got the first quarter GDP, which came in at 7.8. So clearly, and then there's the GST cut. So growth has gone up. And look at the CPI number. 2 months ago, the average on the street was 2.9. Now it's got a 2.4. So that's why the street is divided. Actually, if growth is higher, why do you need a rate cut? But if inflation is falling so much, there is space for rate cut, which is why the street is completely divided. Our own citizens, MPC, voted 3:2 in favor of a cut, but it was, very thin, but that kind of a vote. Likewise, we also asked them how many are you expecting any future rate cuts at all? That is after the August policy. And 4 out of 5 said that yes, there will be at least one. One said she's expecting 2 cuts. Only one person said that there will be no cut at all. So the market is poised for a cut, mostly in October, but definitely, if not October, in December. Now, what the market wants really is not just a rate cut now, but a dovish-sounding RBI. And, the signal that they will be looking for to find out whether the RBI is dovish is RBI's inflation forecast. Currently stands at 3.1. Like I told you, even in August, everyone was standing at 2.9. Now, do they come close to 2.5? Will be one point they will watch. If they go towards 2.5 or 2.4, then the market will believe that RBI thinks there is place to reduce. As well, they will look at the year ahead RBI forecast. In August, RBI had given Q2 FY27 forecast as 4.9. That was the most hawkish statement in the August policy. The governor need not say anything. That number was enough to tell the market that you can't expect a rate cut. If year down, it is 4.9, way above the mandated 4% mark. Now, that 4.9 will definitely go down because the starting point of inflation index itself is going down. Secondly, there have been GST cuts. Some of them are in the CPI index. And thirdly, the CPI itself is going to be recast as of February 2026. So they will definitely bring it down. How much do they bring it down? If it comes really close to 4, then the market will believe that if not in October, there is another cut. In fact, if they cut it drastically, the market will go with even 2 cuts. So this is what the market will watch out for. Their inflation forecast and maybe what they say about the bond market. But this is the big number.
Well, thank you so much, Lata, for getting us all of those details and insights. We'll be closely watching out for the outcome of the meeting. But let's take a short break then. More news and updates follow on the other side, so don't go anywhere. Thanks for staying tuned into Business Lunch, but let's get you some updates on the trade negotiations between the United States and India. Sources are telling CNBC-TV18 that both sides are trying to meet the fall deadline for the first tranche of the trade deal. However, the date, venue of the next round of the talks are yet to be finalized. Now, the Commerce Ministry has also said that the two sides held constructive talks on the possible contours of a trade deal and that meetings with US businesses and investors had evoked a positive response.
Meanwhile, US Commerce Secretary Howard Lutnick, in an interview to a news channel, stated that India remains among the big ones Washington wants to settle trade disputes with. Lutnick said, and I quote, "We have a bunch of countries to fix, like Switzerland, Brazil, India. These are countries that need to really react correctly to America, open their markets, stop taking actions that harm America, and that's why we are off sides with them."
All right, shifting focus then to the metal space. Silver and gold have hit yet another high. Manisha is here with all of the details. Manisha, over to you.
Well, September has seen a string of all-time highs when it comes to precious metals, gold and silver both, and multi-year highs, of course, coming in for platinum as well. So for gold, it's an all-time high. We've seen prices above $3,800 an ounce now. And for the Indian markets, it means 1,15,000 rupees per 10 grams. With these kind of gains, we are trading nearly 46% higher for this year. This is the best yearly gain that gold has seen since 1979. With the expectation that the central bank buying, geopolitical tensions, tariff concerns, the US government shutdown issues, and of course the rate cuts going forward, all of that are very, very supportive. We seem to have done targets for most of the banks and brokerages, but gold is something that markets do believe is, while it is overbought on the charts, but still under-owned by retail institutions and funds, and is the reason all that buying continues to come into the space. For silver as well, we're trading above $46, even $47 an ounce right now, and this is up by nearly 63% for this year when it comes to silver. For the Indian markets, we've crossed $1,43 rupees a kg as well. In the month of September itself, silver prices have gained up by 20,000 rupees a kg for the Indian consumer here. This is the best yearly gain that silver also seems to be putting in last 10 years right now. Expectations here as well are that you could be looking at $48, $50, $52 an ounce going higher, and by Diwali itself, 1,50,000 rupees would easily be crossed there. Markets are looking at deficit, especially when it comes to silver. The industrial demand is at near record highs. It's 100 million ounces of a deficit for silver in this year as well, which is, by the way, a fifth straight year of consecutive deficits. So those factors clearly supportive. Platinum not too far behind. We are looking at prices up by 75% in platinum also for the year 2025 till time, and more further gains not ruled out.
Boy, record highs for silver, record highs for gold. I'm actually dreaming of buying any of them.
Can't even dream at such prices.
Manisha, thank you for that update. We take a short break. More news and updates on the other side. Stay tuned. Welcome back. The big news from last night. India are the Asia Cup champions for the record 9th time now after beating Pakistan by 5 wickets in a closely contested final. The match between the arch rivals swung both ways, but in the end, a special effort from India's middle order, led by Tilak Verma with an unbeaten 69, made the difference for the men in blue. However, the Indian team, led by Surya Kumar Yadav, refused to accept the Asia Cup trophy from the Asian Cricket Council President and Interior Minister of Pakistan, Mohsin Naqvi.
Well, absolutely. That was quite a close game with Pakistan after a very long time, quite closely watched. But with that, that's all the action we have on this edition of Business Lunch. We're leaving you with the green-looking screen for now, at least up 29 points higher for the Nifty. Don't go anywhere. Midcap Radar comes up next.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Well, we are back above the 24,700 mark. Yes, but Nifty did slip into the red. It's been quite choppy actually. We saw that 100-point fall from the highs. Now we are seeing a 50-point gain. Midcaps too have fallen. They were outperforming at a point in time. But yes, there is a swift recovery which is on the cards as well.
Good afternoon, Sonal. Absolutely right. Given the fact that this expiry day, a certain amount of volatility was expected, but still, market's been very, very choppy in today's trading session. Well, we have a lot lined up on the show. Let's start off with the top headlines. Markets off morning highs recover from the day's low. PSU banks, oil and gas, along with realty gains, while private banks and consumer durables trade weak.
Midcap index is in focus. It is up around 300 points, but it's down around 300 points from the day's high. Atlanta Electricals, Acme Solar and Bandhan Bank among gainers, while Astra Micro is the top loser. Advanced decline ratio currently at 1:1 on the NSE.
Woke-hard gains after White House says that countries with existing trade deals with USA will be exempt from pharma tariffs. EU-made drug exports to US would continue to attract only a 15% tariff.
The Ministry of Petroleum and Natural Gas flags low valuation of enterprises under its wing, promises performance-linked pay for top execs, rules out levies like windfall taxes, promises price stability and value unlocking via divestment.
Well, Midcap Radar and quite a few of the midcap stocks in trade today are doing quite well. Have a look at Sammaan Capital. This particular stock, came out of the F&O ban for today's trading session. That stock is near the day's highest point, high by almost 11% and doing very well. On the other hand, a name like PG Electroplast, that particular stock has cooled off significantly near the day's lowest point, almost 3.5% lower. The entire PSU basket, especially the oil and gas pack, is doing quite well. GAIL has moved up to the high point of the day, almost higher by 2.3%. Even the OMC pack is doing quite well in the session. So those stocks too, especially HP, BP and IOC, all three of these names are doing quite well. But this is our special segment, Midcap Movers. Sonal, let's hop across to the wall to take us to the midcaps that are moving around in the session.
Okay, interesting days for midcaps. We did see that fall, and look at the chart. There is a swift recovery from the lows as well. So a couple of stocks which are on my radar as we speak. The NSE advanced decline ratio absolutely flat right now, but we do have gainers in form of Stalin India Fluorochemicals up 10%. Sammaan Capital out of F&O ban is seeing gains of around 11%. Atlanta Electricals is up 9%. We have Supreme Petro as well seeing gains of around 9%. Some of these new listings are doing well today. So GK Energy is the other one, of course, up around 7%. We have Paradeep Phosphates on commissioning of that capacity, which is seeing gains of 6.5%. Dr. Agrawal's Health is the other one. It has come off from the highs, but still seeing gains of around 2%. On the losing side, we have Europratik Sales. This stock is a recent listing, is down 6.5%. Jaiswal Neco, One MobiKwik continues to come on the radar. It did see that spike, now back again at the lows of the day. Sigachi actually was in the red for a bit when I spotted the stock, but now back again in the green. Absolutely flat. But yes, these are some stocks on our radar today.
Thank you so much, Sonal, for taking us through the list of stocks in the broad end of the markets that are making all the moves. Well, it's a good time to welcome Ruchit Jain from Motilal Oswal Financial Services for a quick technical check on the market. Ruchit, request you to keep it a little short today. We want your views both on the markets as well as your individual trading calls.
Yeah, hi, very good afternoon. Well, we have seen a good corrective phase during last week, but the momentum readings, if you look on the Midcap 100 index on the lower time frame chart, then they are quite oversold. So we expect a relief rally to come in the markets, which we are witnessing now. On the higher side, this could extend towards 24,870 to 24,900. So pullback move, too early to say whether it would be reversal, but at least a pullback move could be seen over next couple of trading sessions. Now, two stocks that we are recommending on the buy side. One is from the OMC segment, which has been doing well. The entire pack has been doing well and showing outperformance today. BPCL within the segment is looking positive, where the risk-reward ratio is still favorable. Keeping a stop loss below 322, short-term traders can go long on BPCL for potential targets around 360. And Poonawalla Philcorp is another name where we have seen a good relative outperformance in last 4-5 days. When the broader markets or the mid-cap space have seen a correction, the stocks rather they are stayed sideways post the recent good volume-based breakout. So a bullish flag pattern has been formed over there. So we expect this outperformance to continue. So Poonawalla Philcorp can be bought with stop loss below 480 for potential targets around 535.
Right, Ruchit, thank you so much for joining us. With that, we'll slip into a short break now. When we come back, we'll get you more on the markets and stock-specific action as well on the other side. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar. Let's talk about some primary market action now. Co-working space company WeWork is looking to debut on the D Street. 3,000 crore rupee IPO opens on 3rd October, ends on 7th October. My colleague Reema Tendulkar caught up with WeWork India's MD and CEO Karan Virwani. Listen in to what he had to say.
Over the last 8 years, Reema, we've been through a huge journey of growing this industry, investing into it, and today gone to become the largest operator from, definitely a financial standpoint, from a revenue and now profitability standpoint. So in the last 3 years, especially since COVID, the business has become self-sustaining. We're actually generating positive free cash and a high EBITDA that is much more than we need for our capex expansion.
So what are your operational cash flows?
So as of last year, we ended at close to about a 22% EBITDA margin. This is a fully adjusted EBITDA. At a reported level, we're almost at about 63% EBITDA margins. And roughly about 420 crores of EBITDA on a revenue of close to about 2,000 crores is what we generated, which is, I think, the highest in the industry by far, and also enough for us to sustain a very consistent growth where we're able to deliver both bottom line growth as well as capacity growth.
Okay. So what are your expansion plans right now? You're present, you've got 68 centers, 1.14 lakh desks, 8 cities. What are the growth plans?
So if you look at the commercial real estate market in India itself, has been growing at roughly a clip of almost like 8%. Last year was the peak expansion for commercial real estate, almost 77 million square foot of commercial expansion. In the last 8 years, the flexible industry itself has become from zero, close to about 10%. And for incremental expansion, it's nearly 25%, which is now matching ITES. So the industry itself is growing at roughly about 18-20%. We are market leaders in the industry, so our endeavor is always going to be to grow slightly over and above that from a capacity and growth standpoint. We will continue to grow faster than the industry itself, at this scale, we think that that's roughly in the range of like 20,000 desks year over year. And if demand increases, like last year, we actually added almost 27,000 desks. So if demand continues to show that there is, the requirement, we'll even accelerate that growth.
Got that. So over the last 2-3 years, you've grown at an average of 20%.
Yeah.
Will that sustain? And is there scope to expand margins above 22%?
Yeah, we are operating at already 22% EBITDA as of FY25. FY24 was closer to 20.4%. So you already see a margin expansion, even in a year of extremely high growth. And we see that there is enough potential from the existing ramp-up centers maturing, which will lead to more margin expansion. We've also unlocked few revenue streams that are extremely high margin. Our digital products business, which is growing faster than our workspace business, and that is driving a big part of why we have higher margins. Over and above that, our services business, which is higher. No, this is services that we sell over and above the workspace business. So it could be anything from F&B to parking to dedicated internet to customizing your workspace even further. This is at about 11 to 12% of our business, where the industry is roughly about 8%. So all this incremental revenue plus the mature buildings continuing to ramp up and the existing ramp-up centers, we think that there's at least 4 to 5 points of margin expansion still available in the business while growing.
Got that. So we'll come to the services business and how you can scale that up further from the current 11-12%. But you're also a premium offering. So on a like-to-like basis, how much higher would your rents be, say, in a grade A office space in Mumbai or Bangalore versus peers?
Our pricing is really a factor of where we take space more than anything else. You see that we have a huge building in the center of BKC. We're in the middle of Cyber City. We're in CBD Bangalore, in some of the best business parks like Embassy Golf Links, etc., which are always in high demand. So today our pricing averages close to about 20,000 odd rupees per desk. It's almost 2 or slightly higher than 2 times that of the competition.
The India growth stories in Bharat,
Yeah.
the tier 2, tier 3 cities, and you're present only in 8. And you were just telling us the strategy is to go deeper in the micro markets.
Yeah.
So is that it? 8 cities, or are you planning to expand? And what would be the, say, 2 years, 3 years down the line?
Yeah.
How many cities would you be present in?
So we are evaluating all cities. I don't think we look at anything as tier 1, tier 2, tier 3 in that sense. We actually are looking at where is there sustained demand that allows us to grow fast and have multiple centers, and where is there quality real estate.
As of now, in your plans, there is no expansion beyond 8 cities.
No city has given us that indication yet. If you just look at, Chennai, I'll take Chennai as an example. We only entered last year after 7 years, even though it is a top tier city. And that's really because Chennai's absorption went from 2-3 million square foot a year now to almost 9 million square foot. And in the last year itself, we've opened 3 locations. We've done an extremely large deal for, global tech business also over there. So we're seeing that the market is now ready for us. So yeah, I mean, I hope that WeWork is in all cities in India soon, and that's just how much runway we have left from now.
So tell us about WeWork Global.
Yeah.
I mean, they're not classified as a promoter. What is their stake and how much will it come down post offer for sale?
So WeWork India started off as a first ever franchise location for WeWork in the world. At the start, Embassy owned about 100% of the business, and we invested all of our own capital in actually growing the business, for the first 5-6 years. It was only in 2020 that WeWork Global came in and actually, at a time where the company really required money, took that leap of faith and actually gave us about $100 million at that point in time, which allowed us to get through COVID and, get through all of those tough times. They are not a promoter. Embassy continues to be the clear promoter, and it will be for the sustainable future. So they own currently about 22%. Post the IPO, they'll be somewhere in the mid-teens, so roughly a 30% dilution on both sides of the business. And, for the brand, for the IP, we pay about a 2.5% management fee. That gives us exclusive rights to the brand in perpetuity in India.
Well, that was Karan Virwani of WeWork India. IPO, remember, is coming soon. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, the recovery that we saw since 130 has sustained. In fact, quite a few stocks, especially a few names from the metal pack, have actually gone ahead and hit the day's highest point. Have a look at a name like Hindustan Zinc, that particular stock doing quite well. Hindustan Copper, remember we had the management on our channel earlier today. That particular stock too continues to do quite well in the session. A couple of names from the EMS pack. Remember, most of these names are under significant pressure today. Names like Keynes as well as Dixon seeing significant selling pressure today. But one of their peers, Amber Enterprises, has recovered very sharply from the day's lowest point. In fact, Amber Enterprises now trading near the day's highest point. The NBFC pack, select names, we did mention Samman Capital. That stock continues to surge higher in the session. And you're also seeing a name like AB Capital doing quite well. AB Capital, in fact, high by over 3%. On the other hand, a few consumer discretionary names. Remember, quarterly updates are from both HUL as well as few other, as well as commentary coming in from some of the retailers has been slightly muted. And on the back of that, have a look at Page Industries, that particular stock down over 1% in the session today. Looking at the auto pack, look at TVS Motor, that particular stock, once again, doing quite well in the session today. But with that, it's all the time we have on this edition of Midcap Radar. Finding Alpha when we return.
Welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. Well, India's growth story has many engines, but none more powerful or more enduring than consumption. With a young demography, rising incomes, rapid urbanization, and formalization of the economy, India is steadily becoming one of the world's largest consumption markets. But the story is not linear, right? From policy shifts like GST 2.0 and the budget-led income tax cuts to cyclical factors like the RBI rate actions and the rural recovery, multiple forces are at play that will shape how and where Indians spend. Well, staples could be reaching maturity, but discretionary categories could be showing signs of strong momentum. Against this backdrop, we're in conversation with the one and only Gautam Dugat, Head of Research Institutional Equities at Motilal Oswal Financial Services, to understand how they view India's consumption story, the opportunities investors should focus on, and the risk to watch out for. Well, Gautam, thanks a lot for coming down to the studio, and we're looking forward to the next 30 minutes or so. But before we get to you, and we've got plenty of queries, first up, let's listen in to some of the key measures that have been announced in this year, 2025.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. In the new tax regime, I propose to revise tax rate structures as follows: 0 to 4 lakh rupees nil, 4.8 lakh rupees to 4 to 8 lakh rupees 5%, 8 to 12 lakh rupees 10%, 12 to 16 lakh rupees 15%, 16 to 20 lakh rupees 20%, 20 to 24 lakh rupees 25%, and above 24 lakh rupees 30%.
The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%.
रिफॉर्म एक अनवरत चलने वाली प्रक्रिया होती है। जब समय बदलता है, देश की जरूरत बदलती है, तो नेक्स्ट जनरेशन रिफॉर्म भी उतने ही आवश्यक होते हैं। इसलिए देश की वर्तमान जरूरतों और भविष्य के सपनों को देखते हुए जीएसटी के ये नए रिफॉर्म्स लागू हो रहे हैं। नए स्वरूप में मुख्य रूप से अब सिर्फ 5% और 18% के ही टैक्स स्लैब रहेंगे। इसका मतलब है रोजमर्रा के इस्तेमाल की ज्यादातर चीजें और सस्ती हो जाएगी।
Well, we got a bit of a booster shot in budget 2025. Then you have the rate cuts and now GST 2.0, Gautam. So how do you see GST 2.0 shaping the consumer behavior here in India? And what could the implications be for the listed universe? Give us your initial take.
Sure. Thanks for having me here. See, consumption is a very large part of the economy. I think 58 to 60% of India's GDP is PFC, which is private final consumption expenditure.
Right.
It's very heartening to see that the government has shifted focus towards consumption after a very long time. You know, in the regime of this government, in the first 2 terms, their entire focus was on building capacity, infrastructure, manufacturing. You heard a whole host of things, you know, PLI schemes.
Yes.
The government's capacity expenditure budget, capex budget as we call it, went up from close to 2 lakh crores in FY19 to almost 11 lakh crores now.
Yes.
So almost 5.5 times jump in 6 years. Consumption got a short shrift.
Yes.
And you would all, have seen in the last 10 years, the growth of low-ticket consumer staple companies has been in single digit on a compounded basis. In fact, not a single consumer staple company in India, in the listed universe, has managed to post a 10% top line compounding for last 10 years, 2015 to 25. Therefore, starting with this budget, with the announcement of income tax very well, while the attention of the media is disproportionately focused on GST cuts right now, and rightly so, because after 7 years of GST, this is a very big seminal change that the government has done. I think in the short term, obviously, you will see a pent-up demand getting unleashed. We all are reading in the newspapers over the last few days how auto demand has perked up, how e-payments have gone up. And now today also, I've heard somewhere that the rest of the festive season sales are also picking up across categories, be it durables or anything. I think there are 2 or 3 ways to look at it. One is the short-term push that it provides to the consumption demand, especially at the lower end of this consumption pyramid. Correct. Because staples is something which perhaps may not seem much of a big boost. If you're, say, consuming one soap, just because the price is down 10%, you're not going to buy 2 bars of soap. But what it does is, it increases the disposable income of a consumer.
Indeed.
Which he or she can then spend on other items.
Correct.
Perhaps more on discretionary goods.
Correct.
Something which a consumer has been deferring. Correct. Because the income wallets have not grown. Let's be very clear. If you look at the data of BSE 500 company on wage growth for last 5-6 years, the wage growth has compounded, or the employee cost as we call it, has compounded at hardly mid-single digits.
Right.
So the income growth of a consumer wallet has not been very healthy, I would say. Second, last few years, the inflation has also eaten into those savings. Leverage has gone up. We all know the household, leverage has gone up. Savings has come down. So therefore, from a multiple perspective, this tape augurs very well. Now, whether the benefits are visible just this quarter, next quarter, it's a matter of details. But there is no doubt in my mind that it has a potential to unleash at least a mini wave of consumption recovery.
Got it.
Be it urban, be it rural.
Okay, all right. So a couple of points you're making out here, that in fact, we will see higher amount of spends on the discretionary space. Staples could continue to struggle. And the other point I'm making, so far, urban consumption has been pretty strong. Rural has been lagging. Do you see that trend to continue, or do you think a bit of a catch-up now?
On the contrary, urban has been lagging for last 2 years. Because the income growth was not strong. Inflation was higher. Especially items of urban consumption. Your education cost, transportation cost, communication cost, all of those expenses which traditionally do not get captured in your release CPI, WPI data, they were eating into the consumer incomes. Right? Now, urban should also join the party. Rural has been doing well. If you go by the commentaries of consumer companies for last 3-4 quarters, rural has been outperforming urban. And now with a very good, bountiful monsoon, plus, the harvest season should also be good. And I'm hopeful that even the Rabi should not disappoint. So, you have a very rare situation in last 7-8 years where both urban and rural are looking good. Because when urban was not doing well, that time rural was carrying the mantle. And prior to that, when urban was doing well, rural was suffering right after the COVID.
But now you have both the engines.
Now you have, after a very long time, touchwood, that both urban and rural are coalescing together.
Got it. Let's focus a little on the discretionary spend that you were talking about. Which sub-segments do you see the most under-penetrated as of now, and offering the strongest growth from here on, since you're more bullish on the discretionary thing?
Absolutely. Let me elaborate on that a bit. See, discretionary consumption has expanded like anything in the last 10-15 years. So many new categories have emerged, subcategories have emerged and have become very relevant of late. 10-15 years back, when you talked about discretionary consumption from a listed universe point of view, it hardly meant 4 or 5 stocks. You had an Asian Paint here or a Titan there or an United Spirits there. Today, you have 10 hotel stocks, 10 jewelry stocks, so many apparel stocks, so many footwear stocks. The definition of discretionary consumption itself has expanded. In a lighter vein, we used to have one consumer analyst in our team a decade back. Today, we have 3 consumption analysts, and we are looking to add 4th. So, because the listings also that are going to happen between today and next 12-18 months, plus new age consumer tech companies are also coming to the secondary market. So the point I am making is, when we went from $1,000 to $2,000 per capita, in fact, we had our founder had released a wealth creation report called as Next Trillion Dollar Opportunity. The argument we had made that point of time was very simple, that when income goes from $1,000 to $2,000, out of the incremental $1,000 that accrues to a consumer wallet, only $100 will be spent on necessities, while the rest $900 will go towards discretionary consumption. Today we are at $2,800. And in next 5-6 years, I think we should move towards $4,000. Now, those incremental $1,200, where are they going to be spent? Because today aspirations have been unleashed post-COVID. There are so many new categories which have emerged. In 2010, you didn't have quick commerce, food delivery. You didn't have so many hotels. Plus, even if hotels were there, the desire to spend, the propensity to spend was not there, which has come back post-COVID. So if you look at our model portfolio, the Motilal Oswal model portfolio that we release every quarter, today we have zero weight on consumer staples. We were running underweight for 5 years. In July, we made it zero. So all the stocks in our model portfolio are discretionary consumption stocks. So we have a huge weight on jewelry. Titan has been our long-standing favorite stock. We also like some of the other stocks in that segment which got listed recently, something like a PN Gadgil there or a Kalyan. We like hotels. We have been holding Indian hotels since 100 rupees.
Right. So
we like liquor. So we replace Hindustan Lever with Radico Khaitan.
Okay, all right. So the few stocks you like, you're talking about the jewelry theme, right? Titan, PN Gadgil and Kalyan Jewellers. So those are the top stocks that will play from that particular theme. Just a quick query. With regard to these gold prices have spurted up so much, will it hit demand?
I think it has already hit the demand. But the good thing is, Indians already hold 25,000 tons of gold, as per a study. Now, that amounts to almost 250 lakh crores of gold holdings, which amounts to 2/3 of India's GDP at current exchange rates. Because the rupee has fallen, otherwise it would have been much higher. Now, what is happening on the ground is because the gold prices have seen a huge spurt in the last 2 years, prices have doubled from roughly 55,000-60,000 to I think we are right now at 1.2 lakh per 10 grams. So what is happening is the exchange of old gold jewelry, the gold which is kept in lockers, the bars, the coins, they are coming out of the lockers. And people are using that to purchase new jewelry. So contribution of old gold jewelry exchange to the total jewelry sales has gone up in the last 6 to 9 months. Second, the lower weight jewelry is also making its presence felt. So which is 18 carat, 14 carat, new carats are getting invented. But the point is 650 tons is the annual gold demand in India. And it is very stable because of the demographics. We have a young demography and we have roughly 70 lakhs to 80 lakhs wedding, if my estimate is correct, which happens every year in India. Now, in every wedding, the gold demand, the gold is always there. Now, depending on, the estimate that you make, 55 to 60% of the annual gold consumption demand is owing to weddings.
Got it.
So that demand is pretty stable. So someone who was looking to buy, say, a 50 gram may buy 40 gram or 30 gram. But because the value has gone up, the realization has gone up, the top line has not gotten impacted much. Right? So, and even from a medium to long-term perspective, I think the demography is going to remain very favorable. And at the margin for the last 15 years, we have seen a shift from unbranded to branded. Despite 15 years of shift, today also 60% of the market is unbranded. So we have a very long runway of growth for some of these listed branded jewelers.
So there's an industry tailwind, there's a demographics as well that's working in favor. And I think when you have gold that goes up in this manner, for an Indian particularly, you have that feel-good factor.
Of course, the wealth effect comes into play.
Wealth effect comes into play. Let's focus on another theme, that quick commerce theme that you were talking about. Could you tell us what's the investment case out here? And if you had to choose between the two, we have two listed entities over there. We have Eternal, that's done very, very well. And then you have a peer that's trading at a relatively lower valuation.
Absolutely.
So between the two, what is the preference over there? And tell us the investment theme out there. I don't know whether you call for your lunch this afternoon from there, but we'll talk about that later. But tell us.
No, so investment theme is very simple, Nigel, without complicating things. So there is a preference for convenience. Today, everyone wants convenience. People don't want to spend time in traffic, right? People are hard-pressed for time. And quick commerce, food delivery, all of them come there to satisfy that need of consumption. Second, the penetration opportunity is huge. Despite very strong growth of last 4 to 5 years, quick commerce, food delivery is still primarily a metro and a tier 1 phenomenon. So we have a long way to go on that front. Third, the cost convenience, right? This industry for last 3-4 years was burning a lot of cash. Now, incrementally, we are seeing player after player raising platform fee, becoming very rational in terms of competition. The number of dark store expansion, they're moderating. We had a very prominent company in our conference, which just concluded less than a month back, where he spoke about how they're going to look at unit economics, profitability. So there's no doubt in my mind that this industry is going to become very big in the next 5 to 10 years. Now, will all of them be a winner? We don't know. Right? But one of those players, today there are 3 that we are talking about, which has got size, scale, and also profitability. right? Now, one of them will become very big in our view. So today, we are of the view that you have to bet on many players in that industry and then hope that one of those will become very big and you will compound your capital multiple times while you will lose very little in the one which doesn't become bigger. Today, incidentally, we have a buy rating on both Zomato and Swiggy. And we also like unlisted players in this segment. So this is a huge opportunity in terms of consumption, both from a consumer tech as well as from a discretionary consumption viewpoint.
All right, very quickly, tech has been under the weather. Do you think that these platform companies could get a larger chunk because anyway those guys are not going to, so maybe flows could get a little bit diverted?
I think so. It is already happening. Nigel, if you look at the data, 4 years back, December 21, the weight of IT in index was 20%. Today it is 10%. And the large cap tech companies, the 5-6 big ones, they are growing, they're finding it difficult to grow even at 5-6%. Midcaps is still growing at 15-20%, but they're trading at 40-50 times. Incrementally, the sense that I'm getting from both domestic and global investors is that the new age large platform companies are what are going to see more allocation away from the traditional old school legacy tech companies.
Absolutely.
Unless we see a very different macro situation evolving after a few months. That's a very different ball game altogether, which we cannot conceive today. But as of now, 5-6% growth is getting 23-25 P multiples, which I think at some point of time market will question.
Correct. All right, Gautam, you've given us a few ideas from the jewelry, from the quick commerce theme, as well as that interesting one, replacing HUL with Radico in your model portfolio. We'll talk more about a lot more stocks. For the time, we will take that snappy break, come back, write to us. We'll push some of those queries to Gautam. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha. You're on CNBC-TV18. And as promised, we're going to take some of your queries. The first query that we have is coming in from Ramesh Jain, who writes to us from New Delhi. He says that the last 1 year has been very good for gold while equities have slumped. He's asking what should be the fresh allocation between gold, equities and fixed assets. Gautam, your answer to him.
So, Nigel, this allocation of assets toward different asset classes is a function of two things. Your risk appetite and your age, of course. That ultimately decides the risk appetite. I mean, I'm a believer that one should have allocation across asset classes. I'm not a 100% equities guy. I was a few years back. But now you have 70-80% to equities, around 10-15% to gold, and remaining to debt, which includes your EPF, NPS, bond, and sundry other debt products. Though I'm not the wealth manager, but this is broadly what I feel it should be.
70-80% to equities, 15% approximately 10-15% to gold, and remain to fixed assets.
Again, they need to consult their wealth manager based on their risk appetite.
Absolutely, absolutely. We take that on board. Let's focus on a couple of other sectors then. Cables and wires. You know, the demand has been quite strong. Momentum is expected to continue. Increasing competition was a bit of a concern with the Birlas as well as Adani's coming in there. What do you believe out here? Risk-reward is in favor, keeping in mind that there could be large players that are coming in there, and multiples still, I think, at more than 30 times, you know, even if you're assuming good growth. You believe risk-reward is favorable, and what do you like from the cables and wire space?
So risk-reward was more favorable 6 months back when they made those big announcements. Stocks had corrected 20-25%.
Right.
So look, this is a big industry. This is almost a 96,000 crores industry as of FY25. And growing at 13-14% for next 4 to 5 years.
Right.
So the opportunity is big. And there are credible players there who have gained market share in the last 7-8 years from unorganized guys. But there is still a lot of room for them to gain market share. Right? Because this is an industry which is basically a derivative play on many other sectors.
Yes.
So we like this industry. In fact, recently we just upgraded KEI, which is again a player which has been very consistently growing at 18-20% for more than a decade now. Save 1 year of COVID. Polycab is a name which we've been liking for some time. So Polycab and KEI are these two names which are our preferred bets in cables and wires. But industry is looking good.
Okay.
Just that the risk reward was more attractive 6 months back than it is today.
Okay, all right. And, you know, Polycab, what a story, right? It listed at $1 billion of market cap, 8,000 crores approximately. Today, it's 1.1 lakh crore. And the promoter sold close to around 5% and recovered, I think, close to around 4,000 crores. The entire market cap was just 8,000 crores 6-7 years ago. Phenomenal numbers out there. Promoter taking some part of the pie that he's baked. Let's get another query where Himanshu is writing to us from Pune. He wants to invest in United Breweries and ask at what level should he enter. I think, Gautam, you're a teetotaler, but you're tracking these companies closely. So tell us, what is the view on the alcohol space?
So we are very positive on Radico Khaitan. In fact, that's one of our model portfolio stocks. The stock has done really well. In fact, earnings have compounded at more than 30% for last 2 years.
Okay.
Our in-house view is that, and in fact, that's our estimate, that in our next 2-year basis, the earnings should compound at more than 35%.
Okay.
So we are very positive there, and that's our sole allocation in the liquor sector.
Okay, Radico Khaitan is a stock that you like. Well, the next query is interesting. Rahul Singh is writing to us from Patna. He is holding 20 shares of Trent at a price when Gautam was doing some very, very serious research. I think he was the lone voice on the street who was quite positive. He's got 20 shares at 1,200 rupees. He asked if you can buy more. Now, this is a stock that was 8,500 rupees. It's come down to 4,700, but he's still well in the money. What would your advice be to him?
No, so clearly the price is corrected. The reason for the price correction is twofold. One, you've seen a drop in growth from 40-odd% to 30% and then 30 to 20.
Yeah.
On an absolute basis, even 20% looks very strong because the rest of the players in that category or in that industry are struggling to grow at 10-15%, right? But at 40%, when the P was 115, growth was 40%. The moment 40% dropped down to 20% in 2 quarters, the P is also corrected.
Correct.
Now, this is a stock which is tailor-made for long-term investors.
Yeah.
You know, in the short term, it's very difficult to predict what can happen to a company which is trading at 80-90p. There can always be some quarterly disappointments in a very long journey.
Yeah.
I mean, this is a stock we've been tracking since 100 rupees in 2012 when market cap was 2,000 crores.
Right.
To now it being a part of Nifty. I still feel that they will outgrow their competitors by a margin of minimum 2 to 3x. Now, whether the market likes it or not is a very different ballgame because valuations are totally different.
Yeah.
But From a 3 to 5 year perspective, I think this company should still create wealth from where we are right now.
Okay.
There can be some more downside left, which we can't forecast because it's a very short-term thing. What if third quarter is bad or second quarter is bad? Those are things which we cannot predict.
Yeah.
But from a slightly longer-term framework, 3 year to 5 year, this is a stock where I will allocate money.
Okay, all right, Gautam. Thanks a lot for joining in. You have helped us out with some good ideas that you all, at Motilal Oswal are positive on. Interesting conversation as always, and we appreciate you coming down on Finding Alpha.
Thank you.
Well, that's a wrap on this edition of Finding Alpha. Thanks a lot for watching. Gautam gave us all the insights with regard to the consumption boom that's expected from the Indian economy itself. Thanks a lot for watching.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
It is a mixed picture. Currently, the Hang Seng, as you can see, is down over 1% or close to 1%.
If you look at a lot of variety of short-term indicators, as far as the market is concerned, we are looking oversold. We have 50 points, 24,700 on the Nifty.
But in FY27, at Kotak, we're projecting about 17% earnings growth for the Nifty.
They expect a recovery only starting in November.
The Indian Army is set to procure around 5 to 6 regiments of this indigenously developed system.
2.5% gone last week, but today we're seeing gains of around 0.4%. They also reaffirmed their stable energy pricing policy.
We follow a strategy of not having a single hero, but having multiple heroes.
Market is poised for a cut, mostly in October, but definitely, if not October, in December.
For gold, it's an all-time high. We've seen prices above $3,800 an ounce now.
Well, we are back above the 24,700 mark.
Okay, well, that is the day so far. So we have still, I guess we can call it a bit of a bounce, right? 60-odd points in the Nifty, but it's not been one way. Market's been in the red, then it's come back, then it's sold off, then it's come back. So 24,700 roundabout is what we have, 0.25%. A fragile kind of state of things is how you'd put it. But better than, of course, what we saw on Friday, Thursday. Last week, of course, was quite painful. Let's see. This is a holiday-shortened week. This is just the start. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleague Surabhi and Reema. Guys, hi, afternoon.
Hi. So we've come back up or we've gone back down now?
I think the last move is up, right?
We're ambling around in a 200-point band.
Yeah.
Markets also, I think, taking it easy because of the festivities, perhaps. But IPO Street is buzzing, and Reema's got a full tab on that. A lot of interesting conversations today.
So 15,000 crore for Tata Capital, that issue will open up. And then there's WeWork, which is looking to raise about 3,000 crore. And these are big issues, right? For WeWork, the market cap will be close to 9,000 crore rupees. For Tata Cap, it's the third largest NBFC with a market cap of 1.3, 1.4 lakh crores. So yeah, big ones, ready to suck out money.
Let's ask Nigel. Nigel, bulls or bears?
I think Nigel is...
Oh, okay. we'll get to him.
Finding
alpha.
On Tata Capital, Reema, there is a lot of pre-IPO investors are down 30-40%, quite a bit actually, right?
Yeah.
Because the IPO size is...
So they've priced it at 310 to 326. The rights issue took place at 343. But in the unlisted market, the price was quoting at 700 as well. But deals have happened at 550, and they're going to be stuck. But what
something similar to what happened with NSDL.
Or even HDB, for instance. HDB has done nothing since its IPO, right? That was also the very large upper layer NBFC, which had to list because of RBI, because of the RBI mandate, and that hasn't returned anything.
What are valuations there, Tata Capital?
About 3.2. Okay. Price to book. Yeah.
Okay, more coming up, and we'll play out sound bites as well as we go along. But let me just quickly run you through what's lined up here over the next 60 minutes or so. Markets, of course, depending on when you look at it, an hour back you would have said, well, market sold off. Now it's up a little bit, 70 points, 24,730 or so. And that's the state of affairs. Nifty Bank is doing much better. Oil marketing companies are up 3-4%. And the government essentially batting for higher valuations for these OMCs at an analyst meet. The oil minister making a strong, forceful argument. There's some brokerage calls as well. Precious metals, silver especially, and a lot of silver ETFs are listed. They're all up between 3, 4, 5%. And Hindustan Zinc, of course, is a silver play, which is also up about 4%. And that's the only sort of pure listed kind of player in that particular segment. So there is a fair bit which is coming up. Let's just quickly ask Mitesh, how would he position himself in the last hour or so? What's the state of play? Mitesh, how would you approach things? More up than down?
On the index, Prashant, as I said, there could be a couple of days of pullback. But if we don't cross 24,900 decisively, then I think, we might be looking at possibility of retest of, these levels of 24,700, 24,400 to about 24,350. So I think on the upside, I think I would believe that the structure is weakened and there will be supply. But yeah, because we are oversold, the PCI is also, below 0.7. I think there's a good chance that a couple of days of pullback or stability might come in. But the bias on the index per se remains negative. What is good in this entire pack is the oil refining and the oil companies. So I have a buy on ONGC with a stop at 238 for targets of 250. And IOC, similarly, we had a buy on HPCL earlier. IOC is the fresh recommendation. Keep a stop at about 147.90 and look for a target of around 150.
Okay, in fact, oil and gas is the big story, and the Nifty Oil and Gas Index continues to be the best performing index today, up 1.5%. This is on the back of comments from the Ministry of Petroleum and Natural Gas. Sonal is now joining in with some interesting comments that we heard from the ministers. And when he spoke to the analysts, Sonal, what was the biggest takeaway?
The biggest takeaway is that the ministry is pitching for higher valuations for PSU oil and gas space because they have been trading at discounted valuations. I would say some valuations which are lower than the market levels. They say it will be led by less policy interventions. They'll focus more on capex and more on profitability going forward. And this will be via stable energy pricing policy as well, which should be good for the companies, consumers and investors, all the stakeholders. In terms of windfall taxes, they said there are no future windfall taxes which are on the cards, even if oil prices are volatile, and this is something which will not impact the company's profits as well. In terms of some incentives for the management as well to improve shareholders' return, they have suggested that management pay should be 15% of the shareholders' return, besides profitability, of course. And India's crude sourcing is focused on efficiency and economics, so they will continue to look at cheaper imports from any country which provides it at those levels. Valuation was, of course, the talking point. So let's look at the valuations. FY27 PE versus the 5-year valuations. For ONGC, it's largely the same. For Indian Oil, it has improved. For BPCL, it has come in lower because remember, because of BPCL privatization last 5 years, before that, we did see prices going higher for that particular stock. For GAIL, it is higher as well because possibility of a tariff hike is seen as a positive. And HPCL has been higher as well. Nifty oil and gas market cap is 30 lakh crore rupees. The PE is at 11.8 times and CAGR of 10 years has come in as 15.3%. However, JP Morgan says that investor confidence will take some time. There are diesel cracks which are gaining, which will lower the excise duty risk. They prefer BPCL over IOCL and HPCL. Jeffrey says government wants sticky pump prices, but that could mean higher marketing gains or higher marketing losses. So it could swift in both these ways. And MK says that the ministry is cognizant of the cross holdings and whole company discounts, which it intends to address. So they will look at value unlocking, but of course, complete divestment is off the cards. But these are some of the ways they will look at improving valuations for these companies.
Sonal, was there anything about the way the GRMs are reported, to sort of align it with how some of the private refiners reported? Because I think there was some back and forth I picked up about why GRMs are low as compared to private refiners, and the minister essentially said, addressed that issue as well. Anything you picked up?
So basically, they are not quite, I would say, out there about GRMs when it comes to PSU companies. And that is something you will see in their reporting as well, right? Because they don't give us the core versus reported GRMs and the inventory losses in the press releases. But yes, they did speak about their, how they could improve it and how there'll be improvement in terms of GRMs going forward. But nothing very specific is what I picked up as well. And they are looking at different kind of statistics and ways they will look at these numbers going forward as well.
Okay, all right. Got it. Sonal, thank you very much for that. Well, let's discuss this and more with Gurmeet Chadha of Complete Circle. Gurmeet, great to have you on the show as always. Thanks for joining in. Very nice looking pop on these OMCs, but they'll always be subject to changes in policy. It can happen any day. But, what is your view? Would you take a favorable call? Because there's plenty of oil in the market. So oil price rise is not a concern at this point in time. Your thoughts?
So, Surbi, you can be tactical here. You're right. You can't take a fundamental view. And we like refiners more over OMCs. So we have a tactical call called Chennai Petro, which is an IOC subsidiary in our portfolio. They had a maintenance shutdown last quarter because of inventory losses and GRMs being low. Numbers weren't too good. The stock corrected. But today, if you see, it's available at about, let's say, about 10,000 crore market cap. And if you add debt, that's about 12,000 crores. And to set up a similar refinery of that capacity, you need about 30,000 crores. It's almost like 1/3 of the replacement cost. And then GRMs have picked up and they refine diesel more. So that with diesel cracks being there, probably GRM should do better. Prices have been stable, so hopefully there will be no inventory losses. And they have worked on fuel efficiency. So of 100, let's say, liters crude you refine, there is 10% wastage. So if you improve the yield by 1% or reduce wastage by 1%, that's almost 100 crore to the PAT. So tactically speaking, this is something which offers a lot of value. So that we have added, but as I said, on more on a tactical basis.
But you're staying, so Chennai Petro is a pick, but you're staying away from the retail facing, the marketing companies, IOC, BPCL, HPCL. So you're not fully convinced that it'll be a less interventional or interventionist policy?
So there's already so much uncertainty. Why induce one more in the portfolio, right? So it's better where you have, so not that in refining there is not uncertainty, but you have one variable, which is GRM, right? And inventory losses to look at. Here, there are more variables. So it's about picking. You only can have 20, 30 stocks in the portfolio.
Okay, fair enough. I mean, today actually the entire pack is up and about. MRPL 5%, even a stock like Petronet, LNG, 4.5% higher. Apart from Chennai Petro, anything else in oil and gas or the related space? Gurmeet, anything else?
No, so we are adding a little more on the EPC side, on power and equipment more. So we like Kalpatru. If you see the order book now is almost 66,000 crores. That's almost 3 times of their FY25 sales. Margins improving, especially on power as well as building and factories now contributing a larger share versus oil and gas. And there is good visibility. Working capital days are coming down. So great execution, good group. So that's something we've added, not really related to this, but overall, as I said, in the EPC pack, that's the new name we have added, other than Chennai Petro.
Okay, Hindustan Zinc has been buzzing. Gurmeet, hi, afternoon, coming to you. But silver, a lot of the silver listed ETFs are all up between 4 and 5%. And Manisha is here with a quick kind of run through. We talk about gold all the time, and Manisha's been talking about platinum as well. But silver, Manisha, afternoon.
Afternoon. Thank you for that. Well, yes, when you look at the silver prices, it's nearly a percentage point of gains that we are looking at, and $47 an ounce is now done on COMEX here in the spot markets. And if you look at the Indian prices, well, we've seen an all-time high, a string of that, by the way, and the all-time high now is 1,44,000 rupees per kg here. You know, this in the month of September itself, we've seen silver prices gain up by nearly 22,000 rupees per kg there. If you look at the price gain in the current year, it has been up by 63%, and this is the best yearly gain that silver is giving you in last 10 years itself. So it has been a string of gains continuing for silver. Remember, the investment demand, the ETF demand has been on the stronger side. This is the 5th straight year of deficit. The industrial demand has been quite strong as well, recorded at around a record 700 million ounces. So when you look at this year itself, whether there is a report from Silver Institute or Nomura, they believe that we're looking at 100 to 120 million ounces of a deficit in this year. And the global deficit in silver just about could continue until 2027 or 28 as well. So that is the reason you're looking at that very strong support coming in from silver. Now, remember, the all-time high is $50 an ounce. We've done 47 already. And the markets believe that once we cross that 50, and whether or not that hits as a resistance or we cross over, that is when the markets will really open up, and you could be looking at higher highs continuing from silver. Gold is trading at all-time highs, but the markets believe silver is the place to be, and this is an area which could give you much higher returns going forward as well.
Well, Manisha, thanks very much. Friday we were talking, and it's like galloping higher, right? And just amazing, 22,000 rupees, in September itself. Gains beget gains, and some of it, of course, is industrial use, etc. But I guess investment demand, perhaps, as Manisha pointed out, is also strong. Thanks, Manisha, for that. Gurmeet, any thoughts on silver or silver stocks or silver ETFs or as an asset class? I mean, what's your view?
So Prashant, typically, I think investors chase last 1 year return. So I'm not surprised, but we got a little lucky. We've been advocating multi-asset funds, which was a new category about a couple of years back, which had like 15-20% exposure to gold and silver. So that's been a saving grace in last 1 year. But to enter now when prices have gone up 50% in a year could be tricky because silver, as you rightly said, has industrial usage. And if you see, there is demand considering that silver is a great conductor of electricity. The usage in EVs, semiconductors, solar panels. So even the new age businesses require silver more, but gold being very expensive to use silver more. But as I said, if there is one risk off, which is let's say a trade deal and suddenly tariffs going off over the next few months, I think you can get a better entry opportunity. So I think adding now, I mean, I'm not a commodity expert, but typically wherever there is a consensus view, I get a little more scared.
What about, it's point taken, these are phenomenal gains we've seen very quickly. Do you track Walkhard, Gurmeet?
We do, and I think it did very well after the.
It was down on Friday. It was down 10. It's up 14 today. I mean, so it's like a complete. But that's very near term. It was on the back of those tariff fears, etc. Today it's up. But the bigger story, and by the way, we had the Walkhard management with us last Friday, and we chatted with Mr. Khorakewala a month before that. And at that point, he gave us specific timelines of when the US filing for some of they got these 3 molecules that they're working on. And I think one of them, the buzz is perhaps something is going to come this week. I don't know. But go on, Gurmeet.
Yes, so the surge was led by the antibiotic, and I think the volatility is more to do with tariffs. I think what we have decided is to focus more on domestic names like Mankind Pharma. If you see now, the acute therapy contributes to almost 40% of the sales. In 2014-15, it was just 14%. I think the Bharat Serum and vaccine acquisition now, you will see a lot more synergy because they had to take some debt. The stock is nicely consolidated from peak of 3,000 now, almost down 20%. Their consumer healthcare continues to grow at around 12%. And now it's already the 3rd largest pharma company. So 90% plus is more domestic sales. So I think in an environment like this, if you get revenue visibility, reasonable valuation, and something less immune to external tariffs and tantrums, I think that's a better play. And in other, we have more CDMO plays, Prashant, in the portfolio. We have Laurus Labs in the portfolio, which has done very well. We have Newland Labs. I think pharma outsourcing, you will see a big pickup, irrespective of what is happening right now. I think that's one area you will see significant opportunities. A lot of capacity is being created. Just see the capex numbers for DBs, Laurus, some of the largest CDMO names, and you will figure out that where this is industry. But as I said, very lumpy business. You can have 1 or 2 short quarters, and stock can be very volatile. But very, very good outlook on this space.
Thank you, Gurmeet, for joining in. We will slip into a break. On the other side, we'll invite Ajay Tyagi on the show. Stay tuned. Welcome back. Let's talk stocks, and who better than Hormus to put the spotlight on the top movers in the market right now. Hormus.
Hey, every day, no matter where the market moves, it always throws you one or two names that will always catch your eye. And today, the first name on the list is Cybertech Systems, and this stock has surged 12% in today's session. It is the biggest single-day gain that the stock has seen since September of last year. So it's the biggest single-day gain in 12 months. The volumes today are the highest in 13 months since August of last year, and you take a look at the volumes as well. We had 17.5 lakh shares that have already been traded today, and the 20-day average here is just 63,000 shares, and as a result of which the stock trades above all of its key moving averages today. The best month of the year, that September, has turned out to be in this calendar year so far, but despite that, the stock is still down 12% on a year-to-date basis. Now, specialty restaurants is another name that has sprung up today on the list of gainers. A 10% up move today. It snapped a 4-day losing streak in today's session. This is the biggest single-day gain that the stock has seen since February. The volumes, though, are the highest in the last 13 months since August of last year, and we've had more than 7 lakh shares that have changed hands in today's session for specialty restaurants. The 20-day average here is only 30,000 shares. Now, as a result of which the stock has broken above its 200-day moving average of 134 on very strong volumes. It has also turned positive for 2025, but falls into the list of same stocks that are doing well but are below their IPO price of 150 rupees. Now, Vascon Engineers, of course, a news flow driven name. It snapped a 3-day losing streak today. Now, this has turned out to be the biggest single day gain since January of 22, and today's volumes are the highest on record for the stock. Over 6 crore shares have changed hands for Vascon Engineers today. The 20-day average is 48 lakh shares. We spoke about this stock a couple of weeks ago as being a multi-bagger from the COVID lows, but continues to remain below its IPO price, does Vascon Engineers. And lastly, V2 Retail snapped a 4-day losing streak today, and on very strong volumes. You heard from the management as well earlier in the day. A 10% up move today, and we have had more than 3 lakh shares that have changed hands compared to the 20-day average of around 85,000 shares. The stock is trading above all of its key moving averages, and it's up 20% so far in 2025, and this is courtesy the recent up move that the stock has seen. But the stock went up 5 times in 2024, so good healthy up move in 2024, and it's continuing that in 2025 as well.
Okay, all right, Hormus, thanks very much for that. That's the big movers and what's happening with regards to price action. Ajay Tyagi is now with us, head of equity of UTI Mutual Fund, is with us. Hormus, by the way, we'll come back a little later. We'll talk about IPOs, right, which are really, you know, they're not one or two. They're in the tens, and this week especially, it's a flood. So we'll address some of that. Ajay, good to have you back. You know, generally and broadly, I know it's each IPO is different, etc. But how would you assess the quality of some of what you're seeing, some of the paper that you're seeing? You know, at times like this, I know generalizations don't help, but when you get when it becomes you know, so the pipe really opens up and becomes a kind of a flood, quality usually drops, doesn't it? Ajay, I don't know if you're noticing that, and any insights you can share with us?
Yeah, hi, Prashant. Glad to be chatting with you. You know, we did a study, by the way, of all the IPOs that have come all the way back from 2000 till date. And like you mentioned, you know, whenever there is a deluge of IPOs, the quality certainly drops. But the interesting result of that study was that even during times which are much more rational compared to what they are today, you know, the result was that pretty much 20% of the IPOs are the ones which end up creating double-digit returns for investors. 80% of IPOs make single-digit returns, and a whole lot of them actually end up destroying wealth even over the fullness of time. So, you know, but it's that same thing playing out over and over again. Right now, there is too much excitement about new paper. Of course, companies are finding this to be an opportune time to, you know, create liquidity for themselves. But, you know, if you look at data, it's not supportive of being too excited about IPOs, especially during times when, you know, things are just going through the roof. Yeah.
Ajay, hi. Afternoon. Rima here. In your FlexiCap fund, you've got a fair amount of mid-cap IT, LTI Mindtree, Coforge, Persistent, and then you've got large-cap companies as well, Infosys. Did you make these investments after the stock correction of 25-30% from peak levels, or have you been holding on through this weakness? And what is the strategy now? Will you continue to hold on, or will you look to add, or have you been paring it down?
Hi, Rima. So we can't be very stock specific, but if I let you know about the sector per se, our views are that, yes, there seems to be anxiety around H-1B visa right now. There seems to be anxiety around demand. There also seems to be anxiety around whether AI would lead to deflation and so on. Our hypothesis is that all of these things will play out over the next few quarters, but the resilience of the IT model will still hold these companies in good stead. And while there may be near-term deflation because of AI, but if you look at how technology has evolved over the last 3 or 4 decades, you would realize that each new wave of technology does lead to disruption in the near term, does lead to deflation in the near term, but on a net basis, it actually goes on to benefit Indian IT players, provided these players are retraining and reskilling their employees in the new technology that we are talking about. So, our view is that AI over time should be net positive for the industry. In the very short to medium term, it may be disruptive, but we are holding some of these names with a 3 to 5 year time horizon, and that's why we continue being comfortable about them.
Looking through the FlexiCap portfolio, Ajay, there's Eternal there, but you got lots of newer businesses, right? And many, you don't have to new businesses or new business models actually. For example, there's I was talking to somebody about Black Buck, which is Zinca Logistics, right? Now it's a new segment. They're trying to organize trucking. Or, for example, there's Interrug Builders, right? I mean, this is prefab buildings. So I'm not talking about newer businesses in the sense of these digital first companies or digital platforms in that sense, but these are kind of newer segments in their respective areas. Anything of interest there? Not these two names that I mentioned, I just use them as an example, but anything you like?
Prashant, the one thing I'll be again, once again, I'll have to be a little more generic here. I can't be very specific, but I would just want to leave your viewers with the thought that we are constantly scanning for business models which are using technology to provide services back to consumers much more effectively, efficiently, and economically. So yes, technology is enabling a lot of businesses to actually be better at their game and certainly try to create moats vis-a-vis competitors in the same industry. So, if there are businesses which are, using technology, getting more efficient, then we are always looking at them. But our null hypothesis always is to satisfy ourselves in terms of monetization. There are, a whole host of business models which look extremely attractive in terms of the problem that they are solving. But if they are not able to monetize their service, then we remain skeptical about them. So paths to monetization is something we have to be extremely sanguine about. And the other thing that we always look at is that are these businesses going to be dependent on external sources of funding every now and then because of their constant cash burn? And if the answer is yes, once again, we would be skeptical about them. So we need strength of the balance sheet to back up, innovative business models. Yeah.
In the NBFC pack, I think you've only got one stock, in your portfolio, Bajaj Finance. I mean, are you looking to expand the number of NBFCs, maybe a play on affordable housing, or why are these companies exempt from your portfolio?
Actually, there are a couple of them. There is an affordable housing play as well in the portfolio. But we are constantly looking out. In certain cases, there are a few names which we like, but perhaps they are expensive. That's why we are not firing the bullet on them right now. But we are agnostic. I think all that we are looking out for are great financiers which have the ability to actually show growth without spikes in credit costs and provisioning through the cycle. That's the one thing that we love about financiers, whether they are NBFCs or banks. So from that perspective, there are a few names on the radar. Possibly we're just holding ourselves back because of the valuations.
You know, shorter chat today, Ajay. I had a bunch of other questions, but really appreciate you coming on. Thanks very much for joining us. It's past 3 o'clock. We're going to take a quick commercial break. We'll come back with some, trading ideas for you on the other side. Mitesh is going to be back with us to help us with that. Stay tuned. Coming up.
best.
Welcome back. So it's been a range-bound day of trade, and that's continuing. Now we are testing the The downside, once again, 24,622 thereabouts. So again, we are at the lowest point of that range. Good time to bring in Manglam. Figure out what's happening in the F&O market. What are the cues looking like, Manglam?
Well, it's been very wobbly, as you can see the intraday chart on the screen as well. The Nifty has opened slightly higher, then went higher. That there was some selling that we saw there. Lower levels, we saw some purchase, then went higher once again, and now as we're speaking at the lower end of the range. So I reckon that it's the Nifty and the Midcap index is something that you have to keep an eye out on to get a sense of where the next leg of move is coming for the frontline index. But the other thing that you got to do is also watch out for the high and the low of the Nifty today, and that tells you a broad range for the index. At around 24,600 is the low today, and around 24,800 is the high today. So after a near 800-point decline from the highs, the Nifty seems to have found itself this 200-point range ahead of expiry tomorrow. The second thing we're looking at is the way the sectors which are leading this up move or the down move. On the way up, we saw some, recovery coming in from the domestic-facing sectors. So the FMCG stocks, which opened lower today, saw some recovery. So the index is now marginally in the green. The auto index, which did well and now has seen some selling once again. And the Nifty Bank is the other one, which we are looking at as one that goes up and down as well. So it's the domestic-facing sectors which are leading recovery. The India VIX, which was at 1 point higher, has now moved to the lower point of trade, and thereafter has seen a bit of a spike ahead of expiry as well. So it's all, over the place, and it's all been fairly range-bound and volatile as well. The other thing you have to look at, 24,700 put, that's fairly active in trade. We have the 24,800 call as well, that's equally active in trade. The 24,700 put has a premium that suggests that maybe closer to 24,600, we will see some sort of support coming by for the market, 24,620, 24,630. And on the way up, the 24,800 call tells you that around the 24,850 mark is where you are likely to see some sort of resistance. And what could break this range for the market? Two things. One, there is the expiry tomorrow. Secondly, we have the RBI Monetary Policy Committee meet that happens, the outcome of which comes by day after tomorrow. And around all of this, if there is any commentary that comes around the India-US trade deal, we'll watch out for that as being having the potential to break this range on either the way up or the way down. Finally, I'm watching out for one stock, which is Samman Capital, buzzing in today's trading session on account of being out of F&O ban, but with the kind of open interest activity that we've seen on this one, it may very well go into F&O ban this evening once again.
Thank you very much for that. Mitesh is back with us to tell us what to buy today or sell tomorrow for a reverse trade. Mitesh.
Sorry. So, the index was volatile, but the upper end is not sustaining. So, barring all refineries, the rest of the pack looks slightly negative to me. So, we'll take one STBT and one BTST call. Dabur is a STBT with a stop at 494 for targets to 485. While on the buying side, I have had buys on ONGC and HPCL. I think Oil India can be taken on the long side with a stop at 413 for targets of 421.
Okay. One oil name on the long side and Dabur, which is the short side, but STBD, BDST, both. Well, markets, I think, are not doing very much. We're down 16 points once again. So not holding 24,635. That's been the story since the morning. Insurance is what we want to focus on next. And this is sources telling CNBC-TV18 that the Ministry of Road Transport has moved to increase motor third-party premium for all categories of vehicles. I mean, this has, of course, been in the works. We've reported the story earlier as well. But I think there are more newer details. Let's go across to Yash, who's joining in with what exactly the details are. Yash, over to you.
Well, Prashant, of course, we've accessed the documents which specify the details as far as the changes in the Motor Vehicle Act, which are expected to come from Ministry of Road Transport. What we've been given to understand from our sources is that Ministry of Road Transport is seeking government's approval as far as increasing motor third-party premium is concerned for all categories of vehicles. We've been reporting on this particular fact, but there are two important details which have come out. As far as the increase in motor third-party premium is concerned, the Ministry of Road Transport has, sought the government's approval to say that people over the age of 55 years will have to pay a higher motor third-party premium. That is one point which the ministry specified. The second one is that people having a previous challan history will also have to pay a higher motor third-party premium. Both these points being put very clearly, simply, to calculate for the risk that comes with both these categories. A, people over and above the age of 55 years may have a higher tendency of having road accidents and hence need to pay a higher motor third-party premium. And B, if you have a history of having higher road accidents, then of course you have to pay a higher motor third-party premium. Along with this, motor third-party premium for all light commercial vehicles is expected to be increased. This now will take into consideration the laden value, which means the goods which you've loaded on the light commercial vehicle will also be accounted for, and the motor third-party premium will have to be increased. And this is over and above the overall motor third-party premium, as you spoke about, which is expected by the industry.
Okay, thank you very much for that. And now let's get to all the IPO action. Hormus has put the numbers and how many IPOs we're likely to see, how many are filed, how many in the pipeline. Hormus.
Yes, it almost comes across as if somebody has opened the floodgates, right? As Prashant was highlighting, in the number of IPOs that are open currently, that have been open in the last week as well. We've had 73 IPOs that have hit the market so far in 2025, and a third of that, which is 24 of them, have just come in the month of September. We have one more IPO opening tomorrow, which is the final day of the month, and that will take the overall September tally to 25, which means 1/3 of 2025 IPOs have come in the month of September itself. Now, it's not as if the markets are doing really well, and that is as a result of which there is a sudden rush of paper. You take a look at the first quarter of calendar year 25, where the Nifty struggled a bit, made a bottom in the month of March, and then we had 9 IPOs. In fact, in the month of March, we had no IPOs, and the second quarter, where the market did see some recovery from the tariff lows, we saw some increase in primary market activity, 15 IPOs, but suddenly, starting July onwards, from July until September, we have already had 49 IPOs that have opened, and tomorrow's IPO opening up will take that count to a full half century. That will be 50 IPOs. Now, you take a look at the size as well. Now, here's the interesting bit. The more than half of the 75 IPOs or 73 IPOs that have opened so far in 2025 are less than 500 crore in size. So 35 of them are less than 500 crore in size. Only 2 of them, of course, are more than 10,000 crore, one of which will open soon in the month of October, which is Tata Capital. And we have 5,000, between 1,000 to 5,000 crores, we have had 18 of them. And between 500 to 1,000 crore, we have had 20 such names. But the bigger the size does not necessarily guarantee you returns, and that is evident from the fact that 4 out of the 5 biggest IPOs that we have had this year, 4 of them are trading below their IPO price. That includes HDB Financial, that slipped below its IPO price in intraday trading today. Hexaware is, of course, below its IPO price. NSDL is the only one that stands out, still 50% above its IPO price, but again, well below its post-listing high that the stock had made. And JSW Cement and Sloss Bangalore too are trading below their respective IPO levels. Now, of course, there is still a flurry of IPOs still lined up going forward. We just spoke about Tata Capital, with the WeWork India's IPO opening as well later this week. We spoke to the management of Prestige Estates. They mentioned the Prestige Hospitality IPO is on the anvil. The LG Electronics IPO is on the anvil as well. The PhysicsWallah IPO, the Prestige, the IPO of Hero FinCorp, looking to raise anywhere between 4.5 to 5,000 crores. So it's not as if the rush is over. There are still plenty of big ones still lined up in the near future.
It's astounding, Hormaz. Look at the market and look at how it's changed, right? We've all lived through that time where if the secondary market was lackluster, there's no way. I mean, IPO Street would be absolutely thanda and khali, as they say. But, things have changed, and how, I guess, so much money, just a sign of the times, right? When a country of over 1 billion people starts to invest, and when you have these family offices and promoters exiting in the secondary market or PE exiting, that money has to find a new home, and it's
and
going to this paper.
The slightly different context. Exactly the opposite is happening in the US and Western markets. Companies are going private. It's reverse. And I think we just over the weekend there was I don't remember the name of the company, but very large transaction with this $50 billion company going private. So here it's coming to the market, but it's the opposite. But
But
Rima, of course, has been
Tata Capital. Actually, what did you pick out from the management, and what is your sense that you got from what they're saying about growth, about the business outlook ahead?
So, I got a sense that it's a big company, right? Third largest NBFC. Their gross loans are 2.33. But the way they've grown up until now has been a very safe lender. So their yield on advances is at 12.6%, while a Bajaj is at 16-17%, a Shriram Chola also 16-18%. So they've been very conservative. Even their unsecured book, which is the highest in retail typically, their unsecured is just 12% of retail. So they've been very safe, which is why even their credit cost used to be sub 1%. Their asset quality was pristine. But then what happened is the company merged with Tata Motors Finance Limited. Right? This because Tata Group didn't want two separate entities doing the same business. So TMFL got merged with Tata Capital, and this happened very soon, recently. And because of that, while it did give them exposure to the CV market, which up until now they didn't have, it also added to their NPAs. So the gross NPAs of TMFL, the Tata Motors Finance, was 5%. While for Tata Capital, it used to be, what, 1% roughly, thereabouts? So it spiked up their gross NPAs. And now the endeavor is that improve the asset quality and go back. So it's a very safe player. And also, unlike, say, the other NBFCs, because I asked him, I said, you don't have a hero product. Like Bajaj Finance is great in consumer. Muthoot is great in gold. Chola, Shriram are great in the CV market. You don't have that star one product. And when you have that one star product, what it does is, because you've aced it, you get very high yields and you still keep your asset quality in check. But but the answer to that is that, we're very diversified. We have multiple engines of growth. They're very good in home loan. They used to cater more to the prime segment, which is again where the yields are on the lower side. But now they're getting into affordable. Now CV market has opened up. So multiple engines of growth. So, it's a good company. I think the management is balancing, very disciplined, balancing growth as well as, keeping the asset quality and profitability in check. That was at least my sense that I got from
competitive
the
market. Competitive market, but of course they have the pedigree. So
they've got the pedigree. So because they're Tata Group, their cost of borrowing is also on the lower side. Yeah.
In fact, let's see if we can play out some of the sound bites from Reema's conversation with the Tata Capital management.
Our book is pretty diversified. We are present in all segments of the business, and that helps us provide multiple engines for growth and keeps the book fairly diversified and good on the risk side too. We have chosen a path of having a lower unsecured book, which we believe keeps the book more resilient in difficult times, and it also allows us, the mix of products allows us to have multiple engines of growth. We do believe that our credit cost, which is the lowest in the industry, allows us to still have healthy ROAs despite the yields being lower.
Okay, that's Tata Capital. We'll have Sudeep Bandyopadhyay with us in a bit. We'll ask him about what he thinks of this issue and overall NBFCs. But I think we've got Vivek standing by to run us through some of the key Nifty changes, which are in effect from tomorrow. Vivek, take it away.
That's right. So come tomorrow, come October series, we'll have a new look Nifty. Two key inclusions, two key exclusions. That's the one that we're tracking. And so what actually gets included into the Nifty? Max Healthcare. Today the stock saw flows of close to $360 million. Interglobe Aviation saw flows of almost $380 million on the back of getting included into the index. On the other hand, what actually exited the index? Hero MotoCorp. A little over $300 million of outflows is what this particular stock saw. And IndusInd Bank, over $220 million of outflow. So tomorrow onwards, there's the new look Nifty. Remember, most of the flows are anticipated well in advance. Most of the positioning is done well in advance. In fact, in today's trading session, a lot of the positioning is probably undone, especially in the last hour of the trading session.
Thank you very much for that. Now, as promised, let's get in. Okay, we'll slip into a break. On the other side, we'll come back with Sudeep.
Welcome back. So we're on the last leg, and as promised, we have Sudeep Bandopadhyay now joining in to give us a sense on the market. Sudeep, before you got in, we were just discussing Tata Capital. Rima had a conversation with the management. I don't know if you could hear that soundbite as well. But that's the thing, the IPO street is buzzing entirely. If you've had a look at this issue, the price that they're asking for, is it worth a look, or are you better off with a lot of the existing NBFCs? Plenty of options in the market already.
Well, I think, it's a good NBFC. The asset quality has been pristine, pretty much, barring the time when they just had merged with the Tata Motor Finance. But they also corrected that. They've been extremely conservative. And from a, investment point of view, if you have a long-term horizon in mind, you can definitely apply and look forward to getting allotment in Tata Capital. But remember that you should not expect immediate gains or listing gains or even short-term gains out of this NBFC. You're absolutely right. There are other options. If you want to trade, if you want to take short-term position, there are better options available. But from a long-term perspective, there's absolutely no problem. This is a company with a pedigree as well as a pretty much good book.
Yeah, and they're very conscious to get back to having credit costs sub 1%, improve the return ratios, which have been temporarily impacted on the back of the Tata Motors Finance Limited. HUL's update, Sudeep, what does it tell you about the kind of earnings season? Though they do say that, they anticipate a recovery starting November, the festive season, etc. But your thoughts on what lies ahead for FMCG?
Well, I think it's a bit of a disappointment, honestly, Rima, because there was some expectation to a great extent, I believe, unrealistic, which was being built around the GST relief, which pretty much all these companies and the customers got. But the staples and other FMCG companies, the benefit of GST, of course, is there, but it won't immediately get reflected in consumption. It will take time, and it's got more to do with the income levels and the prosperity and the feeling of having money in hand, which will lead to consumption over a period of time. So I think their commentary is pretty much in line. If at all there is a improvement, we'll probably get to see towards the end of October, Diwali, post-Diwali kind of time. So we have to wait. I don't think we should expect anything great in the Q2 numbers, which will come out much before that. So probably, if you have great expectation, a bit of disappointment is going to come.
Got that. Just wrapping up things, Sudeep, stay with us. We're going to come back to you post-close. So it's kind of a mixed bag, right? Nifty banks, small caps, mid caps, all of it. Neither here nor there. I'll just straight away. I mean, large caps, it's 1%, 1.5% kind of both gainers and losers. So maybe where there's more pronounced price action, it's in the broader markets. And here, I'll just start with some gainers maybe. Saman Capital, big one today. So biggest volume-led gainer. Walkhard ended up with 15% kind of gains, completely reversing and then some. Friday's 10% loss. The oil marketing stocks all did well. HP, of course, was the biggest one, for almost 5%. Godfrey Phillips was up sharply. Reddington was another one. Bandhan Bank ending the day with strong gains. There was Aether Energy, which looked very strong. MRPL looking strong. Chola Holdings, V2 Retail, even IIFL came back up about 4-5%, especially in the second half. So that's essentially the list of the big volume-led gainers. And there were a bunch which were down as well. Some of the shipbuilders would be names like Dixon, etc.
Yeah, so that's how it's played out. It's been a big day for a lot of the oil and gas stocks. No taking away from that. So your HPCL, Petronet, LNG, and many of them. And some names like IIFL Finance have had a good session. V2 Retail from the value retailing pack, 10% up on that stock. Subro. So you've had winners and losers, but it's been more up than down on the mid-cap market. The Nifty, courtesy some big names like Axis Bank, ICICI Bank, ends on a flat note. Even names like L&T dragging. Final check on HUL. Remember, we started the day with HUL being the big newsmaker, considering their subdued outlook for earnings in this quarter. 0.5% lower. It did manage to cut its losses from a decline of over 2.5%, is ending down 0.5%. Well, that's where we're going to take your leave. 20 lower on the Nifty today. Don't go anywhere. There's more action coming up. Up next is Markets Forward.
A volatile session sees the Nifty and Sensex end flat but falls for the 7th straight session. Nifty ends below 24,700. Midcaps outperform the blue chips.
The Indian Army floats a 30,000 crore rupee tender for the Anand Shastra surface-to-air missile. BEL, being the integrator of the missile system, could expect the win, pushing its order book to over 1 lakh crore rupees.
The Oil Ministry flags low valuation of enterprises under its wing, promises performance-linked pay for top executives and price stability, rules out levies like windfall tax and plans value unlocking through divestment.
You're with us here on Markets Forward, your go-to show where we aim to get you all the key data points for today and, of course, to set you up for the next day as well. I'm Hormas Patakia, and joining me today is Sonal Bhutra. Sonal, hi.
Hey, Hormas. What a day, right? And we have got a lot covered for our viewers as well for the next 20 minutes with all the big news and the key developments on Dalal Street, top corporate poises and events to track ahead as well. But let's kick off by the day's market action. It's been a volatile day, but of course, 7 consecutive days of losses on the markets. Nifty is below the 24,650 mark as well. And you know, when we started the trading session, we thought that maybe it could continue to be above 24,700. But look at the volatility today. And that has been, of course, the trend that we've seen today. Midcaps, yes, they outperformed, but they ended lower from the highs of the day. At a point in time, midcaps were up 0.7%. Then around 11, we saw that dip. That got bought into. There was a closing spike as well we saw, but that got sold into as well. We saw good gains coming in from PSUs. Nifty PSU Banking Index, Nifty Oil and Gas, both these indices did really well. We also had Nifty Realty which contributed, but a lot of pressure coming in from autos. And of course, the big numbers in terms of auto sales, what happens, because it was a very interesting month. Shraddh plus GST cuts. So what is the final outcome is something we'll be looking forward to.
We look forward to the auto sales numbers, but you know, two things that the bulls will not like. The promise that the GIFT Nifty had shown earlier in the morning, that flattered to deceive, and instead of being what should have been a snap of the 6-day losing streak, has turned out to be a 7th day of losses. More so, the streak of lower highs and lower lows continues as well on the Nifty. At one point, the index had even broken below Friday's intraday low, which made a new low today of 24,600, and it recovered ever so slightly from those levels, but nonetheless, negative close, 7th day of losses, and that is something that the bulls will not be very pleased with going into the FNO expiry session that is tomorrow. But here's a lineup of what we have in store for you today. We start off with the top movers and shakers of the day with Vivek. Bharat Electronics was the one that surged in today's session after the Indian Army approved a 30,000 crore rupee tender for its air defense missile systems. Walkhard was an outperformer today as Donald Trump provided clarity on pharma tariffs, and Vascon was another outperformer today after it signed an MOU with Adani Infra. And last but not the least, we delve into the key market events to watch out for ahead of tomorrow's trading session. To our first segment of the day, as always, Vivek is standing by on the wall to tell you through every mover and shaker of today's session. Vivek.
Well, that's right. Very choppy session, like you mentioned. Not managing to end in the green, but a very volatile trading session in line with the fact that generally during expiry sessions like today, you do see quite a bit of volatility that does creep in. In terms of individual stocks, individual sectors that did quite well, have a look at the entire pharma pack. Quite a bit of a rebound across most of the names. A little bit of a sell-off towards the end of the session, but names like Wockhardt, Cites Life managed to hold on in the positive territory throughout the trading session. Samman Capital, this particular name from the broad end of the markets, almost 13.5% higher amongst the top FNO gainers in the session today. The entire PSU basket saw buying activity, significant buying. In fact, look at names like MRPL, HPCL, IOC, all of these stocks higher anywhere between 2.5% to 5%. Bandhan Bank, this particular stock, especially in the last hour of the session, saw a significant up move, higher by almost 4%. And Westlife Food, one of the top gainers as far as the NSE 500 was concerned, with a good volume spike as well seen as far as Westlife Food cooled off a little bit. But this particular name did see significant volume action, especially in the last half hour or so. On the other hand, quite a few laggards as well. Most of the EMS players, saw significant selling pressure. Have a look at Dixon Tech, Keynes Tech down anywhere between 3.5% to 5%. Have a look at shipbuilders. Most of these names cooled off quite significantly. Cochin Shipyard amongst the top laggards today. Jindal Stainless, one of the top laggards as far as the NSE NSE 500 was concerned. And Axis Bank, on a day where you actually saw the Bank Nifty doing reasonably well, especially PSU stocks, Axis Bank, one of the top laggards today.
All right, some interesting names there, big movers in the markets. Thank you so much, Vivek, for joining us with all those details. But the first plate that Vivek spoke about, of course, what happened in the PSU space. The Ministry of Petroleum and Natural Gas has argued for higher valuations for PSU oil and gas companies, flagging their low valuations. And this is something that came in from the oil minister itself, where he spoke about how there should be higher valuations for all these companies and said that things like higher capex, more focus on profitability, value unlocking, all of these things will be important to watch out for as far as we focus on these particular names. In terms of less intervention coming in from policies, because that continues to be the reason why there is lower confidence coming in from investors as well. Petroleum Ministry has also told the analysts that they will be seeing stable energy pricing policy, no future windfall taxes under the new law, irrespective of any oil prices. They also said 15% linked to shareholder returns besides profitability for the management, which will, of course, mean more focus on shareholder wealth creation as well. Valuations, of course, was the big talking point. Let's look at the valuations then. This is where the sector trades at currently, but if we compare it with 5-year average, we will see that there has been an improvement in some of them, but ONGC at the same line, Indian Oil has seen an improvement. BPCL, however, saw a decline because the last 5 years saw better average. GAIL was higher. HPCL is also higher on a 5-year average basis. But if we look at the market capitalization, 30 lakh crore is where the 15 stocks in the Nifty oil and gas space stand at. PE is at 11.8 and the 10-year CAGR has come in at 15.3%. In terms of brokerage commentary, JP Morgan has said that investor confidence may take time. Diesel crack gains lower excise duty risk. In terms of Jefferies, they say government's preference for sticky pump prices implies volatile market margins. And MK says that government is cognizant of the cross holdings, holdco discount as well. And dilution is not feasible and full divestment is off the cards, but they will be mindful of that and look at asset monetization whenever possible. And on the back of these comments, look at the way these PSUs surge in trade today, and that has been the big story.
Stepping up on the gas, these oil and gas companies, the oil marketing companies as well. Sonal, thank you for that. We take that point forward with our guests for the day, Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital, and Jay Thakkar from ICICI Securities. Jay, before we get to you with your levels on the index, Sudeep, to Sonal's point that she was making on these oil and gas companies, with the ministry arguing for higher valuations, where do your preferences lie? With your upstream oil explorers or the downstream OMCs or the city gas distributors as well?
Well, I think, it's at least good that government is talking about the shareholder value creation, because I think this is one segment of the PSU basket which has been laggard, and rightly so. I think, policy non-stability or instability of policies, continuous intervention has eroded the investor confidence in this segment. And, even now, I think it'll take time before the investor confidence comes back. Yes, the government doesn't want the pump prices to increase. And because of that, there is this entire subsidy burden sharing and subsidy burden timing of that sharing. And this creates a whole lot of uncertainty as far as oil marketing companies are concerned. And it's extremely difficult to play in these stocks because there are variables which are beyond everybody's control. So I think, even now, as you are asking me, I would not like to get into the oil marketing companies. Believe me, these companies are good companies. They have significant potential, but the volatility and uncertainty around them is too much. So if I have to really participate in this, I would rather go to upstream. There is also volatility because oil prices globally keeps moving up and down, and there are multiple factors. But I'd rather live with one uncertainty than multiple uncertainties.
It's Sudeep. Jay, your take? Fundamentally, as Sudeep mentioned, he would prefer upstream companies because so much volatility in downstream. What's your take? Which are some of the segments you could look at or stocks in this particular space?
Good afternoon to you, Sonal and Hormas. Well, I think that oil marketing companies, especially, all three of them, I mean, whether it is HPCL, BPCL or IOC, all three of them have seen a good long, liquidation, in the previous fall. And Sonal, now there have been a good, open interest addition. So from the derivatives point of view, or technically if we see, then I think the correction seems to have got over, and with this kind of momentum build up with an increase in open interest clearly indicates the long build up from current levels. HP has been the outperformer definitely, but then IOC and BPCL has seen a significant reduction in the open interest, and now from here on if we see the continuous build up, then I think they can outperform or they can catch up the rally as well along with the HPCL. So I think these two companies can be looked into from the risk reward point of view, particularly BPCL and IOC. And from the other non-oil marketing companies, I would say that oil and gas, ONGC, one of the major, I would say, has seen a good long build-up as well. So this is one stock, Sonal, which I think from a medium to long-term perspective, from the derivative perspective, looks positive. One can look for the targets of more than 300 out here as well. So BPCL, IOC, followed by ONGC. That would be the sequence.
All right, thank you, gentlemen, for that. But let's go across to our next segment, next stock of the day, BEL, the top Nifty gainer, gaining nearly 2%. This after Indian Army floated a 30,000 crore rupee tender for defense missiles. Riya Bhatia is joining us with the details. Riya, take us through the details of the tender.
Well, yes, the Indian Army has floated a tender for rupees 30,000 crores to BEL for the procurement of the QRSAM. Now, the Indian Army is going to procure 5 to 6 regiments of the indigenously developed Anant Shastra, as they're calling it, the surface-to-air missile weapon systems. Now, BEL will be the lead integrator for this project, and they are expecting execution to commence from FY27 onwards. And this order is going to enhance BEL's total order book to over rupees 1 lakh crores. Now, let's also look at some other companies that are going to be contributing to this project. The first one is Bharat Dynamics, which will manufacture missiles for this project. The order value for them is expected to be between 10,500 to 12,000 crores. For Apollo Micro, they are going to onboard the computer and complete navigation systems for QRSAM. They're also going to work on power distribution units and also for one of the critical actuation systems for this project. And the expected order value for them will be between 800 to 1,000 crores. And this is important because for Apollo Micro, the current order book is roughly around 735 crores. So this will be a big order for them. For Astra Micro as well, they are going to work on subsystems like TR modules as well as subsystems for the missile programs. The order value for them out of QRSAM will be around 1,800 to 2,000 crores, and the current order book of the company stands at around rupees 1,891 crores. Even Axis Cades is expected to contribute to this project, although the nature of the contribution is not known yet, but the order value is expected to be between 100 to 200 crores, and the current order book of the company is around rupees 1,260 crores. Two other companies, Data Patterns as well as Paris Defense, are also expected to contribute to this project.
Interesting, Riya. Thank you for that update. Sudeep, another very broad space is defense, and BEL, despite whatever the Nifty being done, Nifty having done what it has this year so far, BEL has been an outperformer. What's your call here? You stick to BEL or leaders like BEL, HAL and the likes, or you go into other smaller names that Riya was highlighting, or maybe even look at shipbuilders?
Well, Hormuz, a couple of things. One is, I will definitely avoid the smaller names. There's fundamentally nothing wrong with them. The fact that the valuation at which they are quoting is really rich, I will like to avoid them. And they have a less number of levers for future growth. They are one track, one product, one segment company. BEL I like and have been liking for last more than a year. I've been recommending on your channel as well. I think this deserved a re-rating to an extent. That has happened. But I think if you're a long-term investor, I think BEL still looks good. And we have seen every week, every month they are getting massive new orders, and this order flow will continue. Remember, BEL is one company which caters to all three segments of Indian Armed Forces, Air Force, Army, Navy. And electronic warfare is the new in thing, and the demand for their services is felt everywhere. So BEL definitely. As far as shipbuilding is concerned, it's a long-term game, and the government of India rightly has come out with a package for the entire shipping sector, which will definitely benefit the shipbuilders. But again, this is long-term, and remember, none of the companies are quoting at a cheap valuation. So if you are, wanting to participate in defense, buy into the shipyards, whether you are buying Mazagaon or Cochin or even Garden Rich or even BEL, I think it's a good purchase, but 2 to 3 years should be your minimum time horizon.
Got it. Thank you for that. But let's go across to the next stock in our stocks and news segment. President Trump's clarity on news tariffs on branded pharma imports helped Wockhardt soar, while an MOU with Adani Infra helped Vascon gain in trade. Winnie is here with us. Details. Winnie, take us through what helped these stocks surge in trade today.
Right, so keeping an eye out today on Wockhardt as well as Vascon Engineering. These two stocks were in focus today. Now, Wockhardt, firstly, why was that in focus? Now, clarification came in from the White House that countries with existing trade deals with the United States are exempt from the pharma tariff on branded and patented products of that 100% tariff that we spoke about last week. So, yes, because of that, we have seen a positive sentiment that come in for pharma stocks. Now, obviously, those EU-made drug exports to the US could attract now only 15% tariff. And that also is what Morgan Stanley is highlighting itself as well. And that turns out to be positive for Wockhardt, Sun Pharma. All these stocks were something that were buzzing in trade. Now, apart from that, what Wockhardt management had spoken to us last week, they had said that Xenic drug, which is an important one for the company, was unlikely to be impacted by these US tariffs. And they don't think that 100% tariff would impact the company in terms of their plans as well as a launch for Xenic product, because most of them were sold from EU, would be exported from EU to the United States. And that is why a positive for Wockhardt Hospitals. Other than that, we have Vascon Engineering. That's the one that is in focus as well. They've signed a 5-year MOU with Adani Infra Limited. Vascon will be acting as an execution partner under this early engagement model. And obviously, what Vascon is highlighting that they were engaged from the design. They will be engaged from the design stage and will go on for selected projects for this MOU as well. Now, 3 projects in Mumbai that they will be looking at and have identified so far. So, important partnership that comes in there that is expected to be contributing additional 30% to Vascon's overall annual turnover. 30% additional is what they're talking about, and that is a positive for Vascon Engineering. That's why both these stocks were in focus.
Strong moves on both of them. Vinny, thank you for that. Jay, can't not ask you about your call on the index though. Another day of lower highs and lower lows, and we are back at that 24,600 mark. Where does the Nifty go from here?
Well, Hormuz, I would say, Nifty has fallen quite sharply, as you mentioned rightly, for 7 consecutive days from 25,400 now, again below 24,800, which was a crucial support level, and it's getting very closer to his previous swing low of 24,400. Almost what has happened is the previous rally which had come in the index was clearly on account of the short covering. We didn't see much of short covering happening in the index, wherein the FI's net shorts were around 93%, 93 to 92%, which reduced up to 85%, and now the shorts are getting built up again. We clearly saw the sectoral rotation happening earlier. We saw auto moving up, and thereafter followed by FMCG going up, and then some short covering happening in the defense name, realty pack, the PSU banking pack, all of them one by one. But Nifty IT and Nifty Bank, I mean, those 2 sectors which are holding around 50% kind of weightage in the index, that is clearly not participating in the up move, and that is what is clearly weighing pressure on the index. And with this kind of a reversal, Homos, I think that going forward, if at all there is a bounce, of course there can be a bounce, because after 7 days of losing streak, and one more day, it could be. In last 1 year is what I've checked is that Nifty can remain negative for 8 consecutive days, and thereafter it can bounce. So for all there is a bounce, will be utilized as a selling opportunity only unless we see a Nifty moving beyond 25,200. So that's the reversal on the upside, 25,200. Till we don't see Nifty closing above those levels, almost I would say that the bounce should be taken as a dead cat bounce, sell on rise bounce, because I think the probability of 24,400 going forward getting broken is quite high.
All right, Jay and Sudeep, thank you so much for joining us with your thoughts on different stocks today. With that, it's time for a short break. We'll get to the top corporate voices along with the key market events to watch out for on the other side. Welcome back. You're still tuned into Markets Forward. And before we wrap on the show, we bring you some key market events to watch out for. Ria Bhatia is standing by with the key events to focus for tomorrow. Ria, what do you have for us?
Well, yes, let's take a look at the key events to watch out for tomorrow. First up, we have the GDP data coming from the UK. In the US, we have the consumer confidence as well as the JOLTS job openings data to watch out for. Back home in India, watch out for AGI Grainpack as they hold a board meeting to consider a fundraise. The NSE index changes will also become effective from tomorrow. The stocks that enter the Nifty index are Max Healthcare as well as Interglobe Aviation. And the ones exiting the index are Hero Motorcorp as well as IndusInd Bank. Also watch out for some new listings tomorrow. These include Anand Rathi, Stacia Sai Technologies as well as Solar World Energy Solutions Limited. The IPO of Advanced AgroLife also opens tomorrow, so watch out for that as well. Three other events to keep your eye out on. The RBI MPC meet continues with its second day tomorrow. The US Congress faces a deadline to fund the government or trigger a partial shutdown. And lastly, the US Trade Representative Jameson Greer speaks at an event at the Economic Club of New York tomorrow.
And the monthly expiry as well. Ria, thank you for that. With that, we call time on this edition of Markets Forward from Sonal and me. Thank you for watching. More news and updates continue on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty declined for the 7th day after a volatile trading session. Midcaps and banking stocks outperformed the indices. Gold and silver at new record highs as the demand for safe haven buying remains strong. Silver continues to outpace gold in 2025. Brent crude prices ease after touching the $70 mark. The oil ministry flags low valuation of enterprises under its wing, promises performance-linked pay for top executives and price stability, rules out levies like windfall tax, and plans value unlocking through disinvestment. Tata Capital and Vivek announce IPO pricing as the rush to go public intensifies. More than 73 companies have listed on Dalal Street so far this year, raising more than 1 lakh crore rupees cumulatively. President Trump is set to hold last-ditch negotiations to avoid a government shutdown. He will meet top congressional leaders later today with 72 hours to go for the deadline. Stock markets tread with caution across Europe and the US. Jaguar and Land Rover gets the British government's guarantee on loans worth £1.5 billion to protect its supply chain. The automaker's factories have been forced to shut down for nearly a month after a cyber attack. The death toll after a stampede at actor-turned-politician Vijay's rally in Tamil Nadu rises to 41. Vijay's party moves the High Court alleging sabotage. Chief Minister Stalin says new rules will be framed for holding public events. The Union Finance Minister Nirmala Sitharaman meets the families of victims. Elon Musk's social media platform X will challenge the Karnataka High Court verdict upholding the government's power to order removal of content. The company says it will move the Supreme Court to defend the freedom of expression. Well, let's start with the day's market action. A volatile day saw the Sensex and the Nifty closing flat, but with a slight negative bias. Both markets closing lower for the 7th straight session. The Nifty closed below the 24,700 mark, but absolutely flat, just about in the red. The Sensex down by about 60 points, but bucking the trend was the Nifty Midcap, up by 150 odd points, and the Nifty Bank up by 70 points. So really nothing kind of closed there for our markets, but we did see at least the Nifty Midcap and the Nifty Bank closing in positive territory. Well, let's now move to gold prices hitting a record high yet again. This as safe haven demand was boosted by concerns over a potential US government shutdown this week. President Trump will meet top Republican and Democratic leaders in Congress in an attempt to hold negotiations to avoid a government shutdown. The government will face a partial shutdown unless lawmakers can agree on a federal spending bill. A weaker dollar and increased hopes of a further rate cut by the Fed after inline US inflation data also supported the bullion. Meanwhile, silver outpacing gold, soaring to more than 10-year highs. So the rally there continues for both gold and silver. To the IPO market, Tata Capital has set a price band of 310 to 326 rupees a share for its 15,000 crore rupee IPO. The date of subscription has been scheduled for the 6th of October, the largest IPO of 2025 so far. It will comprise of a fresh issue and an offer for sale component. And co-working giant WeWork has also set a price range of 615 to 648 rupees a share for its upcoming IPO. The subscription will open on the 3rd of October. The company is looking to raise around 3,000 crore rupees purely via the offer for sale route. And more than 70 companies have gone public so far in 2025, raising more than 1 lakh crore rupees. But a majority of the large offers are now trading below the IPO price. Hormuz is here with the IPO report card. Hormuz, 2025 record year in terms of the number of IPOs and fund collection so far. But what's the IPO performance post-listing?
It almost seems like somebody has opened the floodgates when it comes to the IPO market, and we've had 73 IPOs so far. But if you take a look at that, a third of them have just come in the month of September. And this, I'm not counting the one that opens tomorrow, which is the final day of the month. So that will take the total tally to 25 IPOs that have opened in the month of September already. Now, it's not as if the markets are doing really great, and hence there is a rush to go public to capitalize on the healthy market sentiment. You take a look at the calendar year quarter, which is the January to March period when the Nifty struggled. We had 9 IPOs. Now, in fact, in the month of March, we did not have a single IPO. Now, in the second quarter, after making the tariff lows, the market saw some bit of recovery. The primary activity picked up. And in the third quarter, which is the July to September period, when the markets are actually down 3%, the number of IPOs is almost half a century, which is 50 IPOs, which includes the one that will open tomorrow. So that will like 50 IPOs in the third quarter itself. Now, you take a look at the size as well. Now, a majority of these IPOs that have opened so far, around 73, 74 odd, majority, that is 35 of them, are priced below 500 crore rupees. The mega ones, of course, one is HDB Financial and the Tata Capital IPO which opens, that is one of them. And the 1,000 to 5,000 crore bit has around 18 names, then the 500 to 1,000 crore bit has more than 20 names. Now, the bigger takeaway is the fact that bigger the IPO size does not guarantee you big returns. Now, 3 out of the 5 IPOs, the largest ones this year so far, are trading below their IPO price. In fact, HDB Financial, the largest of the year, had even slipped below its IPO price in intraday trading before a brief recovery from the lows. And NSDL is the only standout here, 49% above its IPO price and also significantly below its post-listing high. Now, there is a flurry of IPOs that are still upcoming. You spoke of WeWork, you spoke of Tata Capital. We heard from the management of Prestige Estates recently. They said that if all goes to plan, the Prestige Hospitality IPO comes up pretty soon. There is a PhysicsWallah IPO lined up, there is a LG Electronics lined up, and a Hero FinCorp lined up as well. So it's not as if the IPO rush is over anytime soon. We still have major ones lined up in the future as well.
Yes, we do, Hormuz. Many thanks for joining us. That's IPO Street for you. Now, the big global story. The Trump administration is considering the imposition of tariffs on foreign electronic devices based on the number of chips in each device. Reuters reports that the Commerce Department would impose a tariff equal to a percentage of the estimated value of the product's chip content. If implemented, the plan will impact a wide range of consumer products from electric toothbrushes to laptops. So this is the latest tariff threat. U.S. Commerce Secretary Howard Lutnick is hit out at India once again. Lutnick included India's name in a list of countries he claimed the U.S. needs to fix. In an interview, Lutnick said countries like India, Switzerland and Brazil need to react correctly to America, open their markets and stop taking actions that harm America. He added that India needs to play ball with President Trump if they want to be able to sell to the American consumer. His comments comes just days after Commerce Minister Piyush Goyal visited the U.S. to hold talks on bilateral trade and investment agreement. The British government has stepped in to provide financial support for Jaguar Land Rover after a cyber attack that stopped production for nearly a month. The government will underwrite a £1.5 billion loan guarantee to support the company's cash reserves and help pay suppliers. The loan, which is from a commercial bank, will be repaid over 5 years. JLR has promised to resume operations, quote-unquote, in the coming days without any specific details. As things stand, the factories will remain shut at least till the 1st of October. Shares of Bharat Electronics surging in trade after reports indicated that the army has issued a tender worth 30,000 crore rupees to the company. This tender will entail the procurement of the quick reaction surface-to-air missiles, air defense missile systems. The report further highlights that the army plans to procure 5 to 6 regiments of the indigenously developed Anant Shastra weapon system. Remember, the Defense Acquisition Council had cleared the procurement proposal for this project shortly after Operation Sindoor in May. Well, we'll head into a break, but up next, Elon Musk's social media platform X will challenge the Karnataka High Court verdict, upholding the government's power to order the removal of content. That and more when we return. Well, the big national story, the death toll from the stampede in Tamil Nadu's Karur during actor-turned-politician Vijay's rally has risen now to 41. The victims include 13 women, 9 children. Vijay's party has moved the High Court alleging sabotage and demanded a CBI investigation. Chief Minister Stalin has said new rules will be framed for holding public events. Finance Minister Nirmala Sitharaman visited the site and met with the injured and the families of the victims. The Kerala Assembly has unanimously passed a resolution opposing the Election Commission of India's move to conduct a special intensive revision of the electoral rolls in the state. The resolution expressed concern that the exercise could become a backdoor attempt to implement the National Population Register. It highlighted that the SIR requires long-term preparation, and rushing through the process casts a shadow of doubt over the Election Commission's intentions. The resolution was moved by Chief Minister Pinarayi Vijayan. Elon Musk's social media platform X will challenge the Karnataka High Court's verdict upholding the government's power to order the removal of content. The company said it will move the Supreme Court to defend the freedom of expression, arguing that the government's Sayog portal will allow police to issue arbitrary takedown orders without due process or a hearing. Well, in news coming in, global tax service provider Ryan has announced a strategic investment in Dhruva Advisors to create a joint venture in India. As part of this partnership, Ryan will acquire a majority stake and its senior leadership will join the board of Dhruva. The partners of Dhruva will acquire equity in Ryan. And Dinesh Kanabar, the CEO of Dhruva Advisors, will become a vice chairman of Ryan. The move is expected to help expand Dhruva's presence in Asia and the Middle East. Joining us now to discuss this deal is Dinesh Kanabar and Brint Ryan, chairman and CEO at Ryan. Gentlemen, congratulations and many thanks for joining us here on CNBC-TV18. Mr. Kanabar, let me start with you. The decision to actually get Ryan on board as a majority partner, this decision for a joint venture, what was the rationale driving this decision, Mr. Kanabar?
Shirin, we have grown into becoming probably the foremost tax firm both in India and the UAE. We just recently expanded into Saudi Arabia. We are there in Singapore. And the question was that how do we provide our Indian clients with a global footprint? And how do we, so we continue to aspire to be a regional firm. At the same time, we found Ryan to be a global leader in tax services. It is probably the world's largest tax-only firm, and Brint has been growing that firm for the last 34 years. Significant presence in USA, Canada, UK, and going forward into Europe, with little or no presence in India, Middle East, and Singapore. They have a back office in India, a delivery center with about 1,600 people. And they were looking at somebody who could service their clients in India, Middle East, and Singapore. So we thought it was a natural fit. We give them a majority only so that they can consolidate the results in India. But in effect, this is a partnership. We look upon this as a partnership where we benefit from the Ryan network, are able to provide global services to our Indian clients, opportunity to our people to train globally and get access to global technologies in tax, and in turn provide services to the Ryan clients, global clients in India and in GCC.
Well, let me get Brint Ryan to comment on that. Mr. Ryan, many thanks for joining us. So what drew you to Dinesh Kanabar and Dhruva?
Well, thank you so much for having us this afternoon. We believe that the Dhruva team has built a phenomenal business across India and the Middle East. And frankly, we could not have found a better partner to help us on our ambition to have a tax services firm that can serve our clients wherever around the globe they may need us. The cultural alignment, the go-to-market alignment, and the cultural alignment of the companies are just dramatic, and we're very excited to be part of it. India has been an important market for us from a delivery standpoint for many years. And we're very proud that our firm was ranked number 45 on India's Great Place to Work list this year. And we're really looking forward to bringing frontline service delivery capability through Dhruva to India and the Middle East.
Well, that's good to hear. But Mr. Kanabar, you know, given the volatile environment that we live in, I would imagine that there's going to be a lot of demand for your services, particularly for your Indian clients looking at the US market specifically. And they're probably going to lean on Brint and his team. But, you know, the timing is interesting. And do you believe that this actually works to your advantage?
Yes, indeed. As you look at Shireen today, everybody is rejigging the supply chain. Everybody is looking at trade policies. That's something which Ryan is hugely invested in, both in USA and in Europe. And so are we here in India. And the point really is that how do we provide that service to our clients? And the question is, how do we provide that service to our clients globally? People are going to increasingly relook at the supply chain. People are going to relook and ensure that the trade and tariff barriers which have been set are something which can be addressed appropriately. So yes, it's a, and again, Shireen, none of these happens overnight. Our discussions have been with Ryan, have been going on for the last couple of years, where we sought to align our culture, our values, our processes, our systems. It just happens that this is a time when we reach a fruition. But to your point, is this a point of time where we see benefiting from the current environment? Absolutely, yes, we do.
So, Brint, what is the aspiration now that you do have this joint venture with Dhruva? Of course, expanding the current universe of clients that you have, but also looking at new markets together. What is the aspiration on that front?
That's one of the key elements of this partnership is that we plan to grow both of our organizations and into new markets. We've already identified several new markets and new opportunities that we will pursue together. And, you know, frankly, there's no better time to have done this transaction. I mean, if you look at the business that we're in, tax is the quintessential growth industry. It grows globally 5 to 7% every year. And as you well know, it becomes more and more complex. So now more than ever, the world needs a scaled specialist to help them solve problems, no matter where in the world they might find themselves.
Well, not just recession-proof, but perhaps also tariff-proof in many ways. So that is the environment that we are currently living in. But Mr. Kanabar, you talked about some of the contours of this deal, but is there likely to be a name change as well? I mean, take us through what we can now expect as you enter this new future.
No, not really. We continue to operate as Dhruva. The Ryan team recognizes that Dhruva is a great brand in this part of the world. And whether it is India, whether it is Middle East, whether it is Southeast Asia, we'll continue to operate as Dhruva. Of course, we'll be an affiliate of Ryan. We speak about many of these things, and obviously these are the things which come into when one speaks about a transaction. But we have been talking, Shireen, you and I, a number of times, for example, that globally, tax is becoming one. So we are looking at pillar 1, pillar 2, the challenges in and around that. Your ability to provide a seamless tax service around the world is becoming very, very critical. And it is this where the partnership between Ryan and Dhruva becomes very, very more important. The name continues as it is, our organization ethos continues as it is. My interaction with you, Shireen, whether it is during budget time or otherwise, continues as it is. I don't think any of that is changing. I continue to be the chairman and CEO of Dhruva Advisors and just take on an additional responsibility of maybe contributing to the growth of Ryan globally and providing my strategic inputs as a vice chairman of the firm.
Well, we continue to hope to have you joining us on our shows, Mr. Kanabar, as you've done over the past 2 decades of CNBC-TV18's existence. But Brint, coming back to what you're hearing from your clients at this point in time, there is a fair degree of flux, volatility, uncertainty. But what does that mean then? Your transaction is done with Dhruva, but what does it mean in terms of both inbound FDI, outbound FDI? What are you hearing from your clients in terms of the appetite to get business done in these uncertain times?
Well, we remain very busy around the world trying to help our clients, solve complex tax problems, as they continue to make investments in a more dynamic and ever more complex environment. They need expert help, and they need expert help from a team that can go to market as one team, which is one of the unique attributes of what we've built at Ryan and what we have partnered with Daruva. So we're still seeing, robust opportunities, across the world to help our clients pay what they owe, but no more.
Well, Brint and Mr. Kanabar, we wish you the very best of luck. Congratulations once again on this new partnership, and we look forward to hearing from both of you in future as well. Thanks very much for your time today. With that, it is time for us to wrap up this edition of Business 360 from all of us here on the team for now. Many thanks for watching. Stay tuned. The news will continue on CNBC TV 18. We're back in a moment.
Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
Whether you're a daily commuter, a weekend road tripper, or a first-time car owner, having the right motor insurance isn't just about following the law. It's about ensuring financial security in case of accidents, damages, or any unforeseen events. But with so many policies, add-ons, and claim procedures, how do you know what's best for you? In this episode of the Policy Bazaar Insurance Show, we decode steering through motor insurance, what every vehicle owner must know. So buckle up as we are joined by a battery of experts. To start with, Mr. Tapan Singhal, the Managing Director and CEO at Bajaj Allianz General Insurance, Mr. Rakesh Jain, the MD and CEO at Reliance General Insurance, Shanai Ghosh, MD and CEO at Zuno General Insurance, and of course, Mr. Saravir Singh, the Joint Group CEO at PB Fintech. And these experts today will help you navigate through the ins and outs of motor insurance and help you drive with confidence. To start with you, Tapan sir, in terms of motor insurance, people always tend to look at it as just one particular element. But what people need to know, and it is very important to be aware of, is there are different parts to have under a motor insurance policy also. A motor own damage cover, a motor third party cover, a personal accident cover. Can you break down these three important elements for us? What do they mean? What do they come in use for? And what is mandatory by law as far as these three covers are concerned?
I'm very happy with the show first and foremost to, I think, Yashish, Sarveer, and you putting this together because this awareness is required. Now let me answer the question you asked for. See, the mandatory part by law is the motor third party.
Yes.
There also, if I look at the penetration in India, I think people broadly agree about 40% Indians would be uninsured. Now, if that be the case, what we don't realize is that what we think is, ki kya hoga? Let's say I have a two-wheeler. If a damage happens also, one, I'm a safe driver, 1,000, 2,000 rupees, I'll pay for it. Why pay insurance premium, no?
Correct.
And the police, I don't know if it catches, doesn't catch. I'm perfectly fine. I go through areas where the police is not catching.
Correct.
But you will be surprised. I have a motor two-wheeler claim of 15 crores, no? A two-wheeler claim of 15 crores. And the two-wheeler value would be what? Not more than 50, 60,000 rupees.
Correct.
That is where third party is. Third party is unlimited liability. No, if an accident happens, somebody dies, on their earning capacity and the number of family members, you have a calculation made by the court and an order comes. If you're not insured, you have to pay that money.
Correct.
The insurance company only takes over your liabilities. That is what third party liability means. No? So fundamentally, if somebody thinks that what can happen, and even if it happens, I can afford 10, 20,000 rupees, but the liability can go up to 15, 20 crores because if an accident happens, somebody dies through your two-wheeler, it can be that bad. Second part is the own damage part. The own damage part, to break it down, is when the vehicle meets an accident, the vehicle that you have, then obviously the reimbursement of the repair of the vehicle is taken care by the own damage part.
Correct.
And third is the personal accident cover of the driver himself. Then the question happens, if you're paying for bodily injury, if you're paying for death, why should the driver take that cover? See, first party, second party and third party. The bodily injury cover by TP liability is third party. Third party means not related with the car.
Correct.
Not related to the insurance company.
Correct.
That's the third party, first and second.
Correct.
So the PA is because you are the first party, That's why you have to have the PA cover for yourself, which has to be there. So broadly, if you have these three things on a very broad parameters, there are a lot of add-ons and also which are very beneficial, which you look at, then you are more or less reasonably protected.
To come to you, Mr. Jain, what has come in the way of people not having an insurance cover which is compulsory in the first case? What are those couple of things which immediately should be done by the industry, by the affiliated sectors to ensure that the third party coverage goes up?
We must appreciate the need for third party, as we all realize now. The number of vehicles growing, the road infrastructure going, and obviously people moving on the roads. This is an ecosystem. It's the law which provides the ecosystem for the third party to be mandatorily taken. And this is not just about India, it's across the world, it is like that. I think this awareness significantly lacks in people. And sometimes the affordability takes the priority over this awareness. And people don't indulge into renewals also. Many times with the new car, it's mandatory for you to take, but then on renewals, people fall off insurance. So that is quite common in this country. Often I have come across people who fall off not because they can't afford, but just that they missed it. And they never thought that their cars are going to have an accident or something like that, which the liability of a third party can come to them. So I think somewhere, we have not created enough awareness about it. I must also say, there exists now a lot of digital means to really achieve this. In the past, obviously, the physical, challenges of implementing this were huge. But now, with Vahan data being there, the insurance repository, IIB being there, all the data, even PUC data, if you see vehicle registration, RTO data, all are digitized.
Correct.
We simply need to put a mechanism of connecting them. And wherever we have gap, we need to prompt the customer.
To come to you, Shanai, the whole bundling of long-term motor insurance policies. Now, what that does is that also puts some additional cost when it comes to the policy holder when he goes to buy a 3-year TP, 5-year TP, along with, let's say, a 1-year OD, whichever way he wants to look at it. Has that impacted penetration? Was the earlier process of insisting on a 1-year TP, 1-year OD better because that did not put a lot of cost burden on the policy holder, or do you think this has helped for a long-term commitment straight away coming in at least on the mandatory part of it for 3 years?
I think it has helped. Okay. I think at least now from a TP standpoint, all new vehicles, 2-wheelers or 4-wheelers, have a 5 or a 3-year, insurance. So to that extent, it's helped. But what it's done is it's created some confusion. People don't really understand the nuance of OD and TP. So once they've bought it, they think in their head it's 3-year, 5-year. And only when they are educated that they, they really realize that OD is not 3-year, 5-year. But there is a steep drop-off that happens after 5 years or after 3 years. In 4-wheelers, that drop-off is much lower. So I would say that in 4-wheelers, the average frequency or the rate of claiming is anywhere between, maybe between 10% to even 35% depending on how old your car is. So a large proportion of people actually experience the claim. So I think in motor your penetration would be around 4-wheeler about 85%. The personal accident people don't appreciate the importance of that. If you look at the road deaths that have happened on the road, I think the statistics were 1.78 lakhs, which were one of the highest in recent years. 70% of that is 2-wheeler, right? Now if that 2-wheeler owner had a CPA, then they would have at least got that one immediately, right? Absolutely. While they go through the entire process. But so I think it has helped, but a lot of education is still required to tell people that you can't drop off. And another segment that has a huge under-insurance is commercial vehicle. There this 3-year thing is not there. So their under-insurance continues to remain.
To you, Saravir, now I understand third party, what we've understood well is compulsory by law, own damage is optional. Now what we tend to see is that for 2-wheelers, people do not, of course when the 2-wheeler is bought, there's an own damage policy which comes with it. But once that ends after the first year, people don't tend to renew the own damage policy for 2-wheelers. For 4-wheelers also, once the car attains a specific age, then people start thinking that I will take care of the expenses on my own. Do you think people are entirely aware of the benefits that they miss out on, even for 2-wheelers, if there is no own damage policy? Do you think people are well aware of it?
So I think, Yash, the way I would say it is that when we talk to consumers, it's awareness is a kind of very first level thing, right? The problem is, are you aware of what will happen if you don't have insurance? That is, I think, the real question. So people say, okay, like we've been discussing that I can look after the few thousand rupees cost to repair a 2-wheeler. But I think they don't realize that it's not a few thousand rupees. It can, as Tapan sir explained, third party liability can go into crores.
Correct.
But even otherwise, we've seen that now as the complexity of 2-wheelers is increasing, actually claim sizes are there. And when people want to claim, that's when they are shocked to find that they only have third-party cover and they don't have own damage cover. So I think awareness of what will you do if you don't have cover is very, very important. See, insurance, the biggest challenge is that you have to pay first and you may get a benefit if something happens. But I think that the awareness that it is really, really powerful, because just to give you a sense, OD premium in two-wheelers are really, really low, right? In like sub 100 rupees in many cases. So actually there is no affordability, etc. is a challenge. I just think that, the human mind is not wired to understand that incidents do happen, and when they happen, then the value is very high. So we tend to underestimate them upfront. So all I would say to your viewers is that it's really not worth it. If you ask me, even for four-wheelers and definitely for two-wheelers, it's just not worth taking that chance. And, it's just a peace of mind thing. I mean, don't have that extra cup of coffee or that ice cream, right? And instead, renew your insurance.
Policy as well.
So honestly, it's just that straightforward. And
I mean, what you say makes absolute sense. It gives you a lot of peace of mind. Whatever has to go wrong is covered. It at least gives you that satisfaction. But on that note, let's take a very short break. When we return, we talk about different trends in the motor insurance industry. What are the different add-ons that you can look at? What are those few things that you do not understand in your motor insurance policy? Also, how technology is making motor insurance a lot more, economical, a lot more customer friendly for all of you policyholders. We discuss all of that on the other side of this short break.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. We've been discussing one side of insurance which comes your way day in and day out, the motor insurance segment. And as promised, in this part of the discussion, we discuss about technology, we discuss about notable trends in the motor insurance segment. To start the segment with you, Mr. Jain, what are the most advisable add-ons that one should get as far as their motor insurance policy is concerned? And, when they opt for voluntary deductibles also, does it somewhere end up affecting the claim payout for any motor insurance policy holder?
So, very good question. I think, Yash, what we need to realize that the older policies were just a basic policy, accidental policies. Over the last few years, most of the insurance companies have started to innovate around the way a customer would like to customize his policy. So, zero depreciation predominantly pays the whole amount for the spare parts out of any accident.
Correct.
Now, any accident, generally the car is old, but if you depreciate the car on the spare parts, it leads to an economic loss for a customer. So, zero dep actually replaces with a new, I think, a product almost to the customer free of charge with a very nominal increase in premium. Similarly, we see floodings, we see Bangalore, we saw, now monsoons are here. Now we see engine protect covers. Engine protect because it's a consequential loss. It's
Correct.
not an accidental loss. It generally occurs because of certain customer behaviors, also the way, the environment is shaping up, and this is the most expensive part of the car. Now, over a period of time, more new covers, interesting ones are coming. People are also coming towards EMI protection. If your car is lying in the garage for more than a number of days, your monthly EMI, 70% of the cars are financed today, your monthly EMI can be paid off. People are talking about assistance covers. This is not just about getting your car towed. It's also about, look, if you get sick, you can be taken to a hospital. If you really are on an overseas trip and all, you can be given a hotel. There are various ways of concierge services which are getting built
Correct.
along with lifestyle and travel. So I think motor insurance is frankly becoming like a pizza. Most of the companies are now innovating through various kind of toppings. I would strongly urge a customer to really look at the risk and the real difficulties they face in and around driving their car. Not just look about getting paid in case there is an accident. Coming to your question of voluntary deductibles, I would say it's a good cover. It obviously reduces the premium for a customer by 20-30%. However, I must say that the base policies in the market today are coming with 70-80% discount.
Correct.
So there isn't much left beyond that in terms of a further discount, which is so tangible. And obviously, when a claim comes in, to that extent, the deductibles will be reduced from the claim amount. My sense is the customer should weigh the pros and cons of the premium versus the claim thing and make up his mind.
To come to you, Tapan sir, it's been about 2 years, 2.5 years that the offtake of electric vehicles have taken up very strongly. Initially, of course, we heard a lot of incidents about fire breaking out as far as electric two-wheelers is concerned. The technology as far as four-wheelers is not entirely tested with respect to the battery in terms of its last decimal. How does how does one look at motor insurance policy for their electric vehicles? Is there any different cover that one should look at? Is the industry assessing risks differently for electric vehicles? And are the premiums generally higher for a motor insurance policy when it comes to an electric vehicle as compared to an ICE?
For any risk, as an individual and look at it, think of whatever you've read in the newspapers, what is going wrong and what can go wrong, and see that are you covered for that or not. If you look at electric vehicles, there are 2-3 things which we talk about. The battery, the battery theft was happening, that's the most expensive part. Second is the fire which it catches, because of overheating, flood areas, and those places which happen. Third is you also have charging stations, which was not there in the ICE vehicles. So, that also would be a risk which would be there. Fourth would be concierge services, which Rakesh was mentioning about for the ICE thing. You would require at times, if your battery, conks out in the middle of the road, may require somebody to come help you change or swap the battery which would be there. So these are the covers that you should be looking for when looking for a vehicle. And that is a basic principle of risk. I think whenever you're looking at any risk, think about what can go wrong and check that are you covered for that or not. So I don't think it's a question of affordability like, I think Savir also mentioned. The question is that are we aware of the risk? Or are we falling for the trap? Somebody says this is the cheapest And it's just a tigger lelo. That means you don't really want to buy insurance.
Correct.
When you go to buy anything, you go to buy a shoe, I've seen people figure out which is the lightest shoe, which is more comfortable. They do so much research.
Correct.
For something which is so critical for you, which protects you, lakhs of rupees, spend 5 seconds asking this question. What can go wrong? Relevant? Am I covered for that? And I promise you, I think the insurance companies are amazing covers. They would be covering you for it.
To come to you, Shania, with respect to the new trends in the motor insurance side as well, what we are seeing is the use of telematics, the use of data in understanding the quality of the driver, the amount that the vehicle is driven for, and all those things, data coming in. Insurance industry, of course, looking to leverage this and giving benefits to the policyholder out of the translation of these two elements. Explain to us these two concepts: pay as you drive, pay how much you drive, and why is it important for policyholders to look at these things to get the best benefits for their behavior and make their insurance policy more economical?
Both these fall under the concept of usage-based insurance, and internationally there are two kinds of usage-based insurance. It's based on how much you drive and how well you drive. So there are these two concepts, and both these present very different risks for you as a driver and for the insurer. So let's take how much you drive. How much you drive is very simple, based on the distance, how long you drive. It's very simple, it's the opportunity. If you drive more, the chances of accident are more. If you drive less, the chances of accident are less. So that is why insurance companies in India have come up with covers that are talking about distance-based insurance. So if you expect that you will drive for a very short distance annually or monthly, you will have a lower insurance. And the second one is pay how well you drive. So it's not just about distance, it's about how well you drive. Driving behavior is what is the most accurate predictor of the probability of an accident, and this is a case study. And this gives the power to customers to say that if you drive well, you can reduce your premium. Internationally, how this works is driving behavior based policy, where either they attach a device onto the car, or it's a beacon onto the windscreen, or it's mobile telematics. So based on either of these three technologies, they monitor the driving behavior of the customer and they give discounts to the person for that. So what this is doing is, while it is encouraging you to drive well, it's incentivizing you to drive well, and at the same time you're being kind of nudged to drive safely and make roads safer in the country. So both these, I think, are very good ways for you to control your pricing, gives you more power, transparent pricing, and for us to also make roads safer, at least through good driving based policies.
Saravi, to conclude this wonderful discussion that we've had today with you, if you buy your car from, let's say, a particular dealer, the dealer tends to have partnerships with insurance companies, 3, 4, 5 insurance companies, and the quotes at the time of renewal, let's say at the time of buying it, maybe you don't pay so much attention to which insurer, but at the time of renewal, when you're actually separately paying the premium, you tend to compare the cost. At that time, if you find the cost of A insurer cheaper than B insurer, but the B insurer does not have a tie-up with the dealer, he tends to suggest to you that, sir, if there is any problem while getting the claim, I won't be responsible, and there are problems. This is what was told to me as well. Eventually, because of the fear, you tend to buy your policy from the insurer which has a tie-up. Does it actually become a problem sometimes if there is no partnership and you want to get the claims? And what can the industry do to stop this practice? Because we speak about mis-selling, and this is, on the motor side, the biggest form of mis-selling that one can come across.
Yeah, I think Yash, you asked a very important question from a consumer perspective. Now, I think let's be very clear. From a regulatory perspective, there is absolutely no regulation which suggests that there is any tie-up between the dealer and the insurance company, or I mean the insurance policy that you buy. So customers are well advised to look at what is best for them. And here I think there are 2, 3 things. I would not say that just because the dealer is selling it, the policy is bad either. I think you have to say what are the, as has been discussed on this panel, what kind of features are you looking for? Is the policy that you are buying giving you that comfort, is covering the risks that you want to cover? and then make a choice whether you want to buy from the dealer or from a online platform or from a physical agent or whatever, or directly from the companies. See, because the truth of the matter is that claims are paid by the insurance company, right? Neither by the dealer nor by the person who's selling the policy. So I think I would say, the industry does a phenomenal job of paying claims, and I think that is true for new cars as well. So there is no truth to this point. As you can imagine, it is in the interest of the dealer at that point to talk about it that way, but that is not the reality. The reality is that there are people who buy, brand new policies from insurers and from platforms directly, and they have a very good experience. The second thing I would say is that in the end, it is, what really ends up happening is that you are so interested in the car buying process, right? You are looking at the shiny new piece of metal that you are really not that focused on the insurance, and that you tend to get to know about this later. So many times people figure this out later, and then of course there's remorse and you feel that I overspent. So I think the best thing to do is to just separate the two things. Insurance is separate, buying a car is separate, and largely there is absolutely no problem. So I would again urge your viewers to exercise their choice, buy what they feel is right, and buy the best policy for them. Whoever is selling it, I would say that there's no problem in buying from the dealer, there's no problem in buying from someone else.
Thank you so much, ladies and gentlemen, for the discussion today. With that, it's a wrap on today's discussion, but we promise to come back soon with another new episode, another set of guests with the same insightful discussion. Till then, stay safe, stay insured.
CNBC-TV18, the Policy Bazaar Insurance Show.
Hello and welcome to News Center. I'm Parikshit Luthra. It's been a week since the new GST regime took effect. From kitchen staples to medicines to electronics, the tax imposed on several items has been reduced. Car makers like Maruti and Hyundai reported a big jump in inquiries and bookings. But are all companies really passing on the GST cuts to consumers? Well, the National Consumer Helpline has received nearly 3,000 complaints since the new regime came into effect on the 22nd of November. That is the first day of Navratri. Joining me now to discuss the rollout of GST 2.0 and the number of consumer complaints that have come to the government is Nidhi Khare, the Union Secretary for Consumer Affairs. Ms. Khare, thank you very much for joining us on the program. What's been the progress with the implementation of the GST rate cuts, GST 2.0, since the 22nd of September?
So first of all, it was important to understand that the reduction in GST should have benefited the consumers fully. And therefore, we held several rounds of discussion with the industry associations, manufacturers, and so on, state governments. And basically, we tried to make them aware that they have to get their systems adapted to the new GST. We also told them that in case they are charging the original GST, the higher GST, they may face consequences, and therefore it would be in their interest to inform the consumers to what the reduction in GST has been, and to an extent that they can use all possible means. So they can also have, comparative charts which can show, what the article was priced at before 22nd September, and later on what was its price and what was the GST which is now payable on them. So we tried to make sure that industry association also joins proactively in making sure that full benefits of the reduced GST are passed on to the consumers.
Ms. Khare, also, what is the extent of complaints that you've received so far?
So we have received somewhere, like more than 3,000 complaints. Some of them is also, part of inquiry, where people want to know what is, on particular commodity, what is the GST payable, and such other things. But some of them also incorporate, complaints with regards to the prices being the same, and therefore the reduced GST benefits are not being passed over to the consumer. Some of the complaints also are that there are discounts on the e-commerce which do not fully reflect, the reduced GST position, and some also how the products have been marked up and so on. So some of these complaints belong to CBIC, and we have directed it to CBIC for their resolution. Others, we are also watchful. So we are watching their such complaints, and we are also taking them up for class action under the unfair trade practices.
Where are most of the complaints coming from, as in which states?
There are different sectors which are very, very common. So e-commerce is one. Then some of the important brands which have mass following. So I think those brands also need to, proactively engage with consumer complaints. So we are escalating their consumer complaints, for their resolution.
Ms. Khare, if we were to ask you about the top 2-3 sectors where you're seeing the highest number of complaints from, what would those be?
As I said, e-commerce is one. The second is processed food. That is also a very common complaint. And then some of the consumer durables.
Also, if we were to ask you about what the Consumer Affairs Department is doing in order to monitor the implementation of the GST reform all across the country, and how are you increasing the capacity to deal with complaints?
First of all, we strengthened a National Consumer Helpline 1915 by also adding up, more people, more manpower, because we understood that after 22nd September, there would be a deluge of people's complaint, reaching out to us for inquiry or for registering their complaints. We have also given them intensive training about what GST issues are all about. And we have also made them acquainted with the FAQs which were released by Ministry of. So we are also adding on, as I said, and we are now basically also working on the back end as to make sure from where we are going to have class action, initiations.
If you could also detail this out for us, what action could these businesses face who are not passing on GST benefits to consumers?
So they could face action against, as it will be treated like trade practice under the Consumer Protection Act. And they can, notices can be issued to them. They can be asked to discontinue it. They can be asked to recall. They can be also asked to reimburse, whatever was due to the consumer. So that much money they will have to pass on to the consumer.
You're working in close coordination with the Ministry of Finance. Could you give us a sense how the inter-ministerial groups are monitoring the GST implementation and this Bachat Mahotsav on a day-to-day basis?
Absolutely. So all the ministries concerned, we have been engaged with them virtually on a day-to-day basis, and trying to also get inputs from different sectors. For example, there may be concerns with regards to pharmaceuticals, medicines and so on. So we are also keeping in touch with all the concerned ministries.
Ma'am, if we were to ask you that, what is the kind of expectation the government has, or the quantum of benefits that will be passed on to the consumer as a result of these GST reductions during Navratri?
Although, Department of Consumer Affairs does not have, an understanding of that, I think Ministry of Revenue would be able to do that better. And they would be actually assessing it for, during the Navratri.
What kind of questions customers should be asking when they are especially going on e-commerce platforms or going to retail outlets? How should they defend themselves? And what are some of the things that they should look out for in terms of pricing of products?
So consumers should actually be aware about the MRP which has been printed on the package, so as to understand, okay, this is the maximum retail price, which also includes the GST. So they should be aware what is the GST charge, especially when they have purchased it, and on their invoice they should be sure about the the GST which will be charged. And if they find any say discrepancy on that, they should save the receipt and they should then register their complaints on the National Consumer Helpline 1915.
All right. And ma'am, out of the 3,000 complaints that you've received so far, have there been certain complaints that you've already resolved or addressed by either penalizing or taking action?
So what happens is when a consumer, registers a complaint, immediately it is escalated to the concerned brand owner or the manufacturer or, wherever, the e-commerce. So, and then we give them some time to respond to it. Now, in cases of e-commerce, they are very, very quick. So we get a solution in about a week's time or 10 days' time. But essentially, we take, on an average, about 18 days to resolve these complaints. As of now, we have been able to segregate these complaints. So those complaints which were related to profiteering, they have been sent to CBIC. In cases where the GST has been wrongly put and the consumer is asking for, benefits, full benefits of the GST reduction, those cases have been sent to the concerned brand owners.
All right, Ms. Nanthi, thank you very much for joining us on the program, giving us your view on the implementation of the GST cuts all across the country and what the Ministry of Consumer Affairs is doing for uniform implementation and making sure that consumers are getting the right price and the benefits are being passed on. Also detailing that over 3,000 complaints have already come in. We're taking a short break here on News Center, but coming up, Elon Musk's social media platform X will challenge the Karnataka High Court's verdict, upholding government's power to order removal of content. Details when we are back. Welcome back. You're watching News Center. Let's start the day with all the market action. We saw volatility and we saw volatility in the Sensex, the Nifty, end the day flat, but with a slight negative bias. Both indices ended lower for the 7th straight session. Nifty closed below the 24,700 mark. However, the broader markets outperformed the blue chips to end higher. Prashant Nair is here with the day's trading action. Prashant.
Well, a better day as compared to what we had last week. But then, I mean, last week the market was down 3% Friday to Friday. It's relative. Market today, of course, intraday could not hold on to gains. At one point, there was about 100 point plus gain. And we finally ended neither here nor there. So, and there were multiple attempts to try and come back and be up a little bit, but all of them kind of sort of sold into by the end of it. So under 25, around 24, 600, 650 is basically where we finally left off at. The Nifty Bank, I think, did a little better. That index ending absolutely in the middle of the day's trading range, about 0.18% higher. You look at the Midcap index, about 0.25% higher. And you had a small cap index, which was unchanged as well. Market breadth was, negative, but not by much. Some 300 stocks separated losers and gainers, and more losers than gainers in terms of trade. I'll just look at the Nifty stocks to kind of look at individual names. So, and maybe, what was down, Maruti was down 2%, Axis was down about 2%, Adani Enterprises and Dr. Reddy's were the other, 1.5% kind of losers. Titan, SBI, Wipro, Bajaj Finance, I mean, no really method to the, no real big grouping which did well or poorly today as we had last week. Last week, of course, one big theme was IT, real estate, metals. But today, of course, to start the week, there was not very much in that sense. I'll just start with what was down on volumes today. So Dixon was the biggest volume-led loser, 5% cut. Shipbuilders were lower. Cochin Shipyard was down almost 6%. Tanla Solutions down 5%. Sundaram Finance was down about 5%. DCX India was down 7%. Camlin Fine 5% lower. Raymond was down about 6%. Suprajit, Vandala Holidays, Nazara Tech were some of the other 5% cuts that you had in terms of the broader market today. Lots of gainers coming through in the form of Saman Capital, 12% pop, number one volume-led gainer. Of course, Saman Capital has a new deputy CEO in the form of Himanshu Modi, who's sort of come on recently. Wockhardt Pharma went from strength to strength, 15% higher roundabout by close. Godfrey Phillip was up 7%. The oil marketing, maybe if there was one pack, it was IOC, HP, BP, which did well. HP was up 5%. Paradeep was up 6-7%. Reddington was up 12%. Vascon from the day, word go in the morning, 20% by close, limit up. Bandhan Bank about 4.5% gains, and a bunch more. So even as more down than up, it was, volumes were on the side of what went up in terms of broader market. So that was perhaps one consolation. Otherwise, I mean, once again, a bit of a lackluster sideways session is what you had this Monday to start the week. Back to you.
All right. Thank you very much, Prashant, for joining us. Now, shares of oil marketing companies rose in trade after Petroleum Minister Hardeep Singh Puri pitched for higher valuations. Puri said India's largest OMCs accounted for over 3% of corporate profits last year, but their market value is less than 1%. The minister also announced plans to undertake a series of reforms to make the companies more attractive. Sonal Bhutra has all the details.
Well, yes, some interesting comments coming in from the oil minister when it comes to the entire oil and gas space. There's a valuation pitch where the minister says that they are looking at higher valuations for PSU oil and gas companies. And for that, they're looking at less policy interventions, high capex focus and improve profitability as well. They reaffirm stable energy prices and policy going forward. In fact, they say there'll be no future windfall taxes on any of the sector in terms of upstream and downstream, even if oil prices are volatile going forward. In terms of management remuneration, there is a performance-linked incentive, not performance by the management, but by the stock. So they say there will be a 15% pay linked to shareholder returns besides profitability of the company. And on crude sourcing, that's been the big question mark always. They say it has to be efficient and economical for the entire economy. Now let's take the valuation point forward, because there has been a pitch for higher valuations. How are the valuations trending right now versus the 5-year average? For ONGC, it is largely in line at 6.8 times, but for Indian Oil, there has been an uptick, 9.6 times now versus 7.5 earlier. For BPCL, it's 8.9 times versus 11.9 times earlier. Now do remember, it's higher as per the 5-year average because there was a bid to privatize BPCL, where that's when we saw sharp surge in stock price as well. So it has cooled off from those levels. For GAIL, it is at 11.3 times versus 9.9 times because now there is a possibility of tariff hikes coming in, which could be positive for the stock. HPCL is also higher at 7.5 times because of upcoming capex and capacity increases that the company is undertaking as well. Now remember, Nifty oil and gas market capitalization is at 30 lakh crore rupees. The PE it is trading at is 11.8 times. This is for 15 stocks together, which also has some of the private companies, and the CAGR for 10 years has been at 15.3%. What are brokerages making of this? Now, JP Morgan says that investor confidence will still take some time for this particular sector, and diesel cracks gains will lower the excise duty risk going forward. They prefer BPCL over IOCL and then HPCL. Jeffrey says that government has a preference for sticky pump prices. They don't want it to move too much. But this is a scenario which could lead to either abnormal marketing gains or abnormal marketing losses for the companies going forward. MK says that the ministry is cognizant of cross-holdings, holding company discount, which is happening across the sector, and dilution, of course, is not feasible and full divestment is not currently envisaged, but they are looking for some value unlocking, and this will be the trigger for the sector going forward.
All right, let's move on. The British government has stepped in to provide financial support for Jaguar Land Rover after a cyber attack that has stopped production for nearly a month. The government will underwrite a £1.5 billion loan guarantee to support the company's cash reserves and help it pay suppliers. The loan, which is from a commercial bank, will be repaid over 5 years. JLR has promised to resume operations in the coming days without any specific details. As things stand, the factories will remain shut at least till the 1st of October. From JLR to Tesla, Elon Musk's car company has begun deliveries of the Model Y in India. The owners will be provided with a complimentary wall connector. In a statement, Tesla says 70 new features have been released to new customers already in 2025. Deliveries of the long-range Model Y are also expected to begin soon. And speaking of Elon Musk, his social media platform X will challenge. Yes, they will be challenging the Karnataka High Court's verdict upholding government's power to order removal of content. The company said it will move the Supreme Court to defend the freedom of expression. Ashmit Kumar has more. Ashmit.
Well, it was just last week that the Karnataka High Court had struck down a petition filed by X-Corp, Elon Musk-backed X-Corp, challenging the central government, Indian government's takedown powers. The Karnataka High Court had upheld the government's powers and in doing so set aside X-Corp's application. Now we understand that X is saying it will go ahead and challenge the Karnataka High Court order. It's given a detailed post on the platform itself. X goes on to say that it is deeply concerned. It's concerned because what X is arguing is that the takedown powers that the government currently has is violative of constitutional laws. It's violative of constitutional rights, especially for free speech and expression, and also going on to say that it violates various multiple Supreme Court rulings. The fear that X-Corp has expressed is that such an order by the Karnataka High Court, such powers of the Indian central government, will allow millions of police officers to issue takedown requests, takedown orders to social media platforms, that this will be hugely damaging to free speech, and also going on to say that as far as the current provisions are concerned, the powers which enable such police officers to pass orders, they can pass orders without even, simply on the basis of allegations, without a hearing, without due process, and all of this is something that has left X-Corp deeply concerned. And on the back of that, X-Corp confirming that they'll be challenging the Karnataka High Court verdict.
In international news now, Israeli forces continue to bombard Gaza, killing at least 23 Palestinians since dawn. Reports have suggested that there was heavy gunfire at the Al-Shifa hospital in Gaza City. However, no casualties have been reported so far. Israeli Prime Minister Benjamin Netanyahu is set to meet US President Donald Trump in the Oval Office. This follows US's proposal to stop the war in Gaza. Russia attacked cities across Ukraine with nearly 600 drones and dozens of missiles. 4 people were killed in Kyiv alone during the assault that lasted 12 hours. Ukraine officials have said that the number of dead and injured was likely to rise as 1,500 across the country. Russia claimed that forces targeted the military-industrial complex of Ukraine. Moscow also said that it shot down 230 Ukrainian drones in the last 24 hours. At least 4 people were killed after a gunman drove a vehicle into a Michigan church, opened fire and set the building ablaze. The gunman, identified as 40-year-old Thomas Jacob Sanford, and he was later shot dead by police in the building's car park. Authorities are investigating the incident as an act of targeted violence, but have said the motive remains unclear. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. Well, India's growth story has many engines, but none more powerful or more enduring than consumption. With a young demography, Rising incomes, rapid urbanization, and formalization of the economy. India is steadily becoming one of the world's largest consumption markets. But the story is not linear, right? From policy shifts like GST 2.0 and the budget-led income tax cuts to cyclical factors like the RBI rate actions and the rural recovery. Multiple forces are at play that will shape how and where Indians spend. Well, staples could be reaching maturity, but discretionary categories could be showing signs of strong momentum. Against this backdrop, we're in conversation with the one and only Gautam Dugat, Head of Research Institutional Equities at Motilal Oswal Financial Services, to understand how they view India's consumption story, the opportunities investors should focus on, and the risk to watch out for. Well, Gautam, thanks a lot for coming down to the studio, and we're looking forward to the next 30 minutes or so. But before we get to you, and we've got plenty of queries, first up, let's listen in to some of the key measures that have been announced in this year, 2025.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. In the new tax regime, I propose to revise tax rate structures as follows. 0 to 4 lakh rupees nil, 4.8 lakh rupees to 4 to 8 lakh rupees 5%, 8 to 12 lakh rupees 10%, 12 to 16 lakh rupees 15%, 16 to 20 lakh rupees 20%, 20 to 24 lakh rupees 25%, and above 24 lakh rupees 30%.
The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%.
रिफॉर्म एक अनवरत चलने वाली प्रक्रिया होती है। जब समय बदलता है, देश की जरूरत बदलती है, तो नेक्स्ट जनरेशन रिफॉर्म भी उतने ही आवश्यक होते हैं। इसलिए देश की वर्तमान जरूरतों और भविष्य के सपनों को देखते हुए जीएसटी के ये नए रिफॉर्म्स लागू हो रहे हैं। नए स्वरूप में मुख्य रूप से अब सिर्फ 5% और 18% के ही टैक्स स्लैब रहेंगे। इसका मतलब है रोजमर्रा के इस्तेमाल की ज्यादातर चीजें और सस्ती हो जाएगी।
Well, we got a bit of a booster shot in budget 2025. Then you have the rate cuts and now GST 2.0, Gautam. So how do you see GST 2.0 shaping the consumer behavior here in India? And what could the implications be for the listed universe? Give us your initial take.
Sure. Thanks for having me here. See, consumption is a very large part of the economy. I think 58 to 60% of India's GDP is PFC, which is private final consumption expenditure.
Right.
It's very heartening to see that the government has shifted focus towards consumption after a very long time. You know, in the regime of this government, in the first 2 terms, their entire focus was on building capacity, infrastructure, manufacturing. You heard a whole host of things, you know, PLI schemes.
Yes.
The government's capacity expenditure budget, capex budget as we call it, went up from close to 2 lakh crores in FY19 to almost 11 lakh crores now.
Yes.
So almost 5.5 times jump in 6 years. Consumption got a short shrift.
Yes.
And you would all, have seen in the last 10 years, the growth of low-ticket consumer staple companies has been in single digit on a compounded basis. In fact, not a single consumer staple company in India, in the listed universe, has managed to post a 10% top-line compounding for last 10 years, 2015 to 25. Therefore, starting with this budget, with the announcement of income tax cuts, then RBI joining the party with a repo rate cut, now government cutting GST, RBI infusing liquidity, all of this cumulatively, I think, augurs very well. While the attention of the media is disproportionately focused on GST cuts right now, and rightly so, because after 7 years of GST, this is a very big seminal change that the government has done.
Yeah.
I think in the short term, obviously, you will see a pent-up demand getting unleashed. We all are reading in the newspapers over the last few days how auto demand has perked up, how e-payments have gone up. And now today also, I've heard somewhere that the rest of the festive season sales are also picking up across categories, be it durables or anything. I think there are 2 or 3 ways to look at it. One is the short-term push that it provides to the consumption demand, especially at the lower end of this consumption pyramid.
Correct.
Because staples is something which perhaps may not seem much of a big boost. If you're, say, consuming one soap, just because the price is down 10%, you're not going to buy 2 bars of soap.
Yeah.
But what it does is, it increases the disposable income of a consumer.
Indeed.
Which he or she can then spend on other items.
Correct.
Perhaps more on discretionary goods.
Correct.
Something which a consumer has been deferring.
Correct.
Because the income wallets have not grown. Let's be very clear. If you look at the data of BSE 500 company on wage growth for last 5-6 years, the wage growth has compounded, or the employee cost as we call it, has compounded at hardly mid-single digits.
Right.
So the income growth of a consumer wallet has not been very healthy, I would say. Second, last few years, the inflation has also eaten into those savings. Leverage has gone up.
Yeah.
We all know the household, leverage has gone up. Savings has come down. So therefore, from a multiple perspective, this tape augurs very well. Now, whether the benefits are visible just this quarter, next quarter, it's a matter of details. But there is no doubt in my mind that it has a potential to unleash at least a mini wave of consumption recovery.
Got it.
Be it urban, be it rural.
Okay, all right. So a couple of points you're making out here, that in fact we will see higher amount of spends on the discretionary space. Staples could continue to struggle. And the other point I'm making, so far urban consumption has been pretty strong. Rural has been lagging. Do you see that trend to continue, or do you think a bit of a catch-up now?
On the contrary, urban has been lagging for last 2 years.
Okay.
Because the income growth was not strong. Inflation was higher.
Yes.
Especially items of urban consumption. Your education cost, transportation cost, communication cost, all of those expenses which traditionally do not get captured in your release CPI, WPI data,
Correct.
they were eating into the consumer incomes.
Correct.
Right? Now, urban should also join the party. Rural has been doing well. If you go by the commentaries of consumer companies for last 3-4 quarters, rural has been outperforming urban. And now with a very good, bountiful monsoon, plus, the harvest season should also be good. And I'm hopeful that even the Rabi should not disappoint. So, you have a very rare situation in last 7-8 years where both urban and rural are looking good. Because when urban was not doing well, that time rural was carrying the mantle. And prior to that, when urban was doing well, rural was suffering right after the COVID.
But now you have both the engines.
Now you have, after a very long time, touchwood, that both urban and rural are coalescing together.
Got it. Let's focus a little on the discretionary spend that you were talking about. Which sub-segments do you see the most under-penetrated as of now, and offering the strongest growth from here on, since you're more bullish on the discretionary theme?
Absolutely. Let me elaborate on that a bit. See, discretionary consumption has expanded like anything in the last 10-15 years.
Yeah.
So many new categories have emerged, subcategories have emerged and have become very relevant of late. 10-15 years back, when you talked about discretionary consumption from a listed universe point of view, it hardly meant 4 or 5 stocks. You had an Asian Paint here or a Titan there or an United Spirits there.
Correct.
Today, you have 10 hotel stocks, 10 jewelry stocks, so many apparel stocks, so many footwear stocks. The definition of discretionary consumption itself has expanded. In a lighter vein, we used to have 1 consumer analyst in our team a decade back. Today, we have 3 consumption analysts, and we are looking to add 4th. So, because the listings also that are going to happen between today and next 12-18 months, plus new age consumer tech companies are also coming to the secondary market. So the point I am making is, when we went from $1,000 to $2,000 per capita, in fact, we had our founder had released a wealth creation report called as Next $1 Trillion Opportunity. The argument we had made that point of time was very simple, that when income goes from $1,000 to $2,000, out of the incremental $1,000 that accrues to a consumer wallet, only $100 will be spent on necessities, while the rest $900 will go towards discretionary consumption.
Correct.
Today we are at $2,800. And in next 5-6 years, I think we should move towards $4,000. Now, those incremental $1,200, where are they going to be spent? Because today, aspirations have been unleashed post-COVID. There are so many new categories which have emerged. In 2010, you didn't have quick commerce,
Yeah.
food delivery.
Yeah.
You didn't have so many hotels.
Yeah.
Plus, even if hotels were there, the desire to spend, the propensity to spend was not there,
Okay.
which has come back post-COVID.
Correct.
So if you look at our model portfolio, the Motilal Oswal model portfolio that we release every quarter, today we have zero weight on consumer staples. We were running underweight for 5 years. In July, we made it zero. So all the stocks in our model portfolio are discretionary consumption stocks.
Right.
So we have a huge weight on jewelry. Titan has been our long-standing favorite stock.
Yeah.
We also like some of the other stocks in that segment which got listed recently, something like a PN Gadgil there or a Kalyan. We like hotels. We have been holding Indian hotels since 100 rupees.
Right. So
we like liquor. So we replace Hindustan Lever with Radico Khaitan.
Okay, all right. So the few stocks you like, you're talking about the jewelry theme, right? Titan, PN Gadgil, and Kalyan Jewelers. So those are the top stocks that will play from that particular theme. Just a quick query. With regard to these gold prices have spurted up so much, will it hit demand?
I think it has already hit the demand.
Okay.
But the good thing is Indians already hold 25,000 tons of gold
Right.
as per a study. Now that amounts to almost 250 lakh crores of gold holdings,
Right.
which amounts to 2/3 of India's GDP at current exchange rates.
Right.
Because the rupee has fallen, otherwise it would have been much higher.
Right.
Now, what is happening on the ground is because the gold prices have seen a huge spurt in the last 2 years, prices have doubled from roughly 55, 60,000 to I think we are right now at 1.2 lakh per 10 grams.
Yeah.
So what is happening is the exchange of old gold jewelry, the gold which is kept in lockers,
Yeah.
the bars, the coins, they're coming out of the lockers.
Yeah.
And people are using that to purchase new jewelry.
Correct.
So contribution of old gold jewelry exchange to the total jewelry sales has gone up in the last 6 to 9 months.
Yeah.
Second, the lower weight jewelry is also making its presence felt. So which is 18 carat, 14 carat, new carats are getting invented.
Yeah.
But the point is 650 tons is the annual gold demand in India. And it is very stable because of the demographics. We have a young demography and we have roughly 70 lakhs to 80 lakhs wedding, if my estimate is correct,
Yeah.
which happens every year in India.
Yeah.
Now in every wedding, the gold is always there. Now, depending on, the estimate that you make, 55 to 60% of the annual gold consumption demand is owing to weddings.
Got it.
So that demand is pretty stable.
Right.
So someone who was looking to buy, say, a 50 gram may buy 40 gram or 30 gram. But because the value has gone up,
Yeah.
the realization has gone up, the top line has not gotten impacted much.
Yes.
Right? So, and even from a medium to long term perspective, I think the demography is going to remain very favorable.
Right.
And at the margin for the last 15 years, we have seen a shift from unbranded to branded.
Right.
Despite 15 years of shift, today also 60% of the market is unbranded.
So
we have a very long runway of growth for some of these listed branded jewelers.
So there's an industry tailwind, there's a demographics as well that's working in favor. And I think when you have gold that goes up in this manner, for an Indian particularly, you have that feel-good factor,
Of
right?
course, the wealth effect comes into
Wealth
play.
effect comes into play. Let's focus on another theme, that quick commerce theme that you were talking about. Could you tell us what's the investment case out here? And if you had to choose between the two, we have two listed entities over there. We have Eternal, that's done very, very well. And then you have a peer that's trading at a relatively lower valuation.
Absolutely.
So between the two, what is the preference over there? And tell us the investment theme out there. I don't know whether you call for your lunch this afternoon from there, but we'll talk about that later. But tell us.
No, so investment theme is very simple, Nigel, without complicating things. So there is a preference for convenience.
Yeah.
Today, everyone wants convenience.
Yeah.
People don't want to spend time in traffic, right? People are hard-pressed for time.
Yeah.
And quick commerce, food delivery, all of them come there to satisfy that need of consumption. Second, the penetration opportunity is huge. Despite very strong growth of last 4 to 5 years,
Yeah.
quick commerce, food delivery is still primarily a metro and a tier 1 phenomena.
Yeah.
So we have a long way to go on that front. Third, the cost convenience, right? This industry for last 3-4 years was burning a lot of cash.
Correct.
Now, incrementally, we are seeing player after player raising platform fee, becoming very rational in terms of competition. The number of dark store expansion, they're moderating. We had a very prominent company in our conference, which just concluded less than a month back,
Yeah.
where he spoke about how they're going to look at unit economics, profitability. So there's no doubt in my mind that this industry is going to become very big in the next 5 to 10 years.
Correct.
Now, will all of them be a winner? We don't know. Right? But one of those players, today there are 3 that we are talking about, which has got size, scale, and also profitability.
Yeah.
Right? Now, one of them will become very big in our view. So today we are of the view that you have to bet on many players in that industry and then hope that one of those will become very big and you will compound your capital multiple times while you will lose very little in the one which doesn't become bigger.
Correct.
Today, incidentally, we have a buy rating on both Zomato and Swiggy. And we also like unlisted players in this segment.
Right.
So this is a huge opportunity in terms of consumption, both from a consumer tech as well as from a discretionary consumption viewpoint.
All right, very quickly, tech has been under the weather. Do you think that these platform companies could get a larger chunk because, anyway, those guys are not going to, so maybe flows could get a little bit diverted?
I think so. It is already happening. Nigel, if you look at the data, 4 years back, December 21, the weight of IT in index was 20%.
Right.
Today it is 10%.
Right.
And the large cap tech companies, the 5-6 big ones, they are growing they're finding it difficult to grow even at 5-6%.
Correct.
Midcaps is still growing at 15-20%, but they're trading at 40-50 times.
Got it.
Incrementally, the sense that I'm getting from both domestic and global investors is that the new age large platform companies are what are going to see more allocation away from the traditional old school legacy tech companies.
Absolutely.
Unless we see a very different macro situation evolving after a few months.
Right.
That's a very different ball game altogether, which we cannot conceive today.
Okay.
But as of now, 5-6% growth is getting 23-25 P multiples, which I think at some point of time market will question.
Correct. All right, Gautam, you've given us a few ideas from the jewelry, from the quick commerce theme, as well as that interesting one, replacing HUL with Radico in your model portfolio. We'll talk more about a lot more stocks. For the time being, we'll take that snappy break, come back, write to us. We'll push some of those queries to Gautam. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha. You're on CNBC-TV18. And as promised, we're going to take some of your queries. The first query that we have is coming in from Ramesh Jain, who writes to us from New Delhi. He says that the last 1 year has been very good for gold while equities have slumped. He's asking what should be the fresh allocation between gold, equities and fixed assets. Gautam, your answer to him.
So Nigel, this allocation of assets toward different asset classes is a function of two things. Your risk appetite and your age, of course. That ultimately decides the risk appetite. I mean, I'm a believer that one should have allocation across asset classes. I'm not a 100% equities guy. I was a few years back. But now you have 70-80% to equities, around 10-15% to gold, and remaining to debt, which includes your EPF, NPS, bond, and sundry other debt products. Though I'm not the wealth manager, but this is broadly what I feel it should be.
70-80% to equities, 15% approximately 10 to 15% to gold, and remain to fixed assets.
Again, they need to consult their wealth manager based on their risk appetite.
Absolutely, absolutely. We take that on board. Let's focus on a couple of other sectors then. Cables and wires. You know, the demand has been quite strong. Momentum is expected to continue. Increasing competition was a bit of a concern with the Birlas as well as Adani's coming in there. What do you believe out here? Risk reward is in favor, keeping in mind that there could be large players that are coming in there, and multiples still, I think, at more than 30 times. You know, even if you're assuming good growth, you believe risk reward is favorable, and what do you like from the cables and wire space?
So risk reward was more favorable 6 months back when they made those big announcements. Stocks had corrected 20-25%.
Right.
So look, this is a big industry. This is almost a 96,000 crores industry as of FY25 and growing at 13-14% for next 4 to 5 years.
Right.
So the opportunity is big. And there are credible players there who have gained market share in the last 7-8 years from unorganized guys. But there is still a lot of room for them to gain market share. Right, because this is an industry which is basically a derivative play on many other sectors.
Yes.
So we like this industry. In fact, recently we just upgraded KEI, which is again a player which has been very consistently growing at 18-20% for more than a decade now.
Yeah.
And save 1 year of COVID. Polycab is a name which we've been liking for some time. So Polycab and KEI are these two names which are our preferred bets in cables and wires. But industry is looking good.
Okay.
Just that the risk reward was more attractive 6 months back than it is today.
Okay, all right. And, you know, Polycab, what a story, right? It listed at $1 billion of market cap, 8,000 crores approximately. Today, it's 1.1 lakh crore. And the promoter sold close to around 5% and recovered, I think, close to around 4,000 crores. The entire market cap, which was 8,000 crores 6-7 years ago. Phenomenal numbers out there. Promoter taking some part of the pie that he's baked. Let's get another query where Himanshu is writing to us from Pune. He wants to invest in United Breweries and ask at what level should he enter. I think, Gautam, you're a teetotaler, but you're tracking these companies closely. So tell us, what is the view on the alcohol space?
So we are very positive on Radico Khaitan. In fact, that's one of our model portfolio stocks. The stock has done really well. In fact, earnings have compounded at more than 30% for last 2 years.
Okay.
Our in-house view is that, and in fact, that's our estimate, that in our next 2-year basis, the earnings should compound at more than 35%.
Okay.
So we are very positive there, and that's our sole allocation in the liquor sector.
Okay, Radico Khaitan is a stock that you like. Well, the next query is interesting. Rahul Singh is writing to us from Patna. He is holding 20 shares of Trent at a price when Gautam was doing some very, very serious research. I think he was the lone voice on the street who was quite positive. He's got 20 shares at 1,200 rupees. He asked if you can buy more. Now, this is a stock that was 8,500 rupees. It's come down to 4,700, but he's still well in the money. What would your advice be to him?
No, so clearly the price is corrected. The reason for the price correction is twofold. One, you've seen a drop in growth from 40-odd% to 30% and then 30 to 20.
Yeah.
On an absolute basis, even 20% looks very strong because the rest of the players in that category or in that industry are struggling to grow at 10-15%, right? But at 40%, when the P was 115, growth was 40%. Moment 40% dropped down to 20% in 2 quarters, the P is also corrected.
Correct.
Now, this is a stock which is tailor-made for long-term investors.
Yeah.
You know, in the short term, it's very difficult to predict what can happen to a company which is trading at 80-90p. There can always be some quarterly disappointments in a very long journey.
Yeah.
I mean, this is a stock we've been tracking since 100 rupees in 2012 when market cap was 2,000 crores.
Right.
To now it being a part of Nifty. I still feel that they will outgrow their competitors by a margin of minimum 2 to 3x. Now, whether the market likes it or not is a very different ballgame because valuations are totally different.
Yeah.
But from a 3 to 5 year perspective, I think this company should still create wealth from where we are right now.
Okay.
There can be some more downside left, which we can't forecast because it's a very short-term thing. What if third quarter is bad or second quarter is bad? Those are things which we cannot predict.
Yeah.
But from a slightly longer-term framework, 3 year to 5 year, this is a stock where I will allocate money.
Okay, all right, Gautam. Thanks a lot for joining in. You have helped us out with some good ideas that you all, at Motilal Oswal are positive on. Interesting conversation as always, and we appreciate you coming down on Finding Alpha.
Thank you.
Well, that's a wrap on this edition of Finding Alpha. Thanks a lot for watching. Gautam gave us all the insights with regard to the consumption boom that's expected from the Indian economy itself. Thanks a lot for watching.
Hello and welcome to another episode of IPO KYC, where we decode the pros and cons of an upcoming IPO before you invest your precious money into it. Today, we have with us the management of Tata Capital. They are India's third largest diversified NBFC in terms of size, gross loans at 2.33 lakh crore, and they're hitting the Lal Street with a whopping 15,000 crore issue. Joining me is Rajiv Sabharwal, MD and CEO of Tata Capital. Rajiv, great to see you. So while you are India's third largest NBFC by size, not by profits, between FY23 and FY25, your NII doubled. 5,300 became 10,600, but profit growth was only 20%. NIMs at 5.2% lower than peers. I mean, what do the next 2 to 3 years hold for Tata Capital?
See, if you look at our past, we've been growing over the last 3 years at 28% on our books, and our profits have grown at a faster pace. There was an impact which happened because of the merger, but if you look at our growth rate in the future, we do believe that there is a potential for us to follow the similar path. Our book is pretty diversified. We are present in all segments of the business, and that helps us provide multiple engines for growth and keeps the book fairly diversified and good on the risk side too.
Let me ask you on your yield and advances. At 12.6%, it's lower than peers. Bajaj Finance is at 16.7, Shriram 17.8. Why is your yield and advances the lowest in the sector, or amongst the lowest?
I think you have to look at it from the context of mix of assets and the credit costs. Both of these things are extremely important. We have chosen a path of having a lower unsecured book, which we believe keeps the book more resilient in difficult times, and it also allows us, the mix of products allows us to have multiple engines of growth. We do believe that our credit cost, which is the lowest in the industry, allows us to still have healthy ROAs despite the yields being lower. Another thing, sorry.
Yeah, so is this a conscious choice to keep yield and advances at these levels? I mean, are you a risk averse or a conservative lender?
I think we are more balanced towards growth and risk. That is how I would put it. While, as I mentioned to you, while the growth rate has been amongst the best in the industry, the credit costs have also been the least in the industry. If you look at Tata Capital before the merger, our credit costs have always been below 1%.
Okay.
And that we do believe makes a right combination of growth and risk.
I mean, what is the outlook on your yield and advances and your credit cost going forward?
So if you look at NIMs and fee, as we talk about, because that's the ultimate parameter of what your earnings are on the top line, they are a function of yield as well as cost of funds. I do believe that in some of the new products which we have launched, for example, we got into affordable housing, and we are already among the top 2 or 3 players in affordable housing. Because of this, the yield is moving up on the housing business. Similarly, on the retail side, we've come up with some new products which are giving us better yield. So we expect the yield to look on the positive side. Cost of funds, I would give credit to RBI to make the repo rate lower, to make more liquidity available in the market, which is bringing down cost of fund. I think a combination of better yield and a lower cost of fund will make the NIM expand. The other thing which is very important in this business is also fee. That is another area which is positive for us, because we have certain products on the fee side which will and are giving us better fee income.
So what's the target NIM in mind? You're currently at 5.2%.
I think when we look at the past, we have seen a steady growth in NIM happening. We do expect for us the future to be similar to what's been there in the past, the trajectory to look similar.
But do you think you can get to where, say, a Bajaj Finance is or a Shriram is, which is at above 9%?
I think it is not about NIMs alone. It's a combination, as I mentioned to you, NIMs, the cost of doing business, the operating costs, as well as credit margins. So I would say when you look at all three, they finally lead you to return on assets and then return on equity. And we clearly will be competitive and at an attractive ROA and ROE in the future.
Okay. There's one criticism, if I may call it that, is the absence of a hero product. For instance, Bajaj Finance is great in consumer loans. Shriram Chola in the CV market used, were Muthoot Finance and gold. You know, this helped the companies grow very fast, get good yields, and still keep their NIMs in check. The asset quality in check. I mean, what is Tata Capital's strategy going to be?
So we follow a strategy of not having a single hero, but having multiple heroes. If you look at our housing finance business, it is large and has, the housing finance company has a book size of about 71,000 crores and also has the highest ROA and ROE in the industry. If you look at the past, the ROA has been over 2.5% and ROEs in the
housing finance
in the housing finance company, ROEs of about 18 to 19%. If you look at our clean energy business, that business has one of the best quality books in the whole industry. We have very low NPAs and the returns are very good, besides contributing towards a green energy environment. Similarly,
actually, if you could just break up the book for us. 2.33 lakh crore is the book. Break it up for us in the various segments.
So if you, on a broad basis, if you look at the overall book, 63% of our book is retail, and that would be almost equally split between the housing business and the rest of the retail business.
Which is?
Which includes products like loan against property, personal loans, business loan, two-wheeler loans, education loans, used car loans, new car loans, commercial vehicle loans. So we are present in the whole spectrum of the retail business. Besides housing and consumer business, which I mentioned to be about 63%, about 26% of our business is SME. So about 89% of our total business is retail and SME. Within SME also we have multiple products, whether it is channel finance, term loans, leasing, equipment finance. We are present across the spectrum. And the balance, about 11 to 12%, is the corporate business.
Okay. And which of these three is growing faster? What will drive growth for you?
So when we look at growth, the businesses which are growing at a much faster pace are housing, which is the fastest growing business for us. The consumer business, which is also growing when we look at the past at rates of over 25%, as well as SME, which is also showing a growth rate of about 25%.
This is for you or for the industry?
This is for us.
Okay, so SME is growing at 25%.
Consumer is growing at 25% plus, and housing is growing at 30% plus.
So let's talk about this merger with Tata Motors Finance Limited. It just got concluded in May this year. So when you took it on, what did it bring in terms of the size of the loan book and even in terms of the asset quality? Because what we understand is that the asset quality of TMFL was actually quite poor.
For us, before the merger, we were not present in the commercial vehicle space. And that's a pretty large market.
Yeah.
It's a market with a size of 10 lakh crores plus, with a yearly disbursements of about 1.5 lakh crores plus. We do believe that this new segment will give us another engine for growth in the future. This book, when we took over, was about 28 to 29,000 crores and formed about 11% of Tata Capital's total book.
Okay. And in terms of NPAs, what were the NPAs?
So their NPAs were slightly higher, in the region of about 5% or so. In terms of our approach, as I mentioned to you, we've always been very conservative and have had the NPAs as well as credit costs amongst the lowest in the industry. And that is what we will look to replicate, even in the commercial vehicle business.
So do you think it's possible to bring the consolidated credit cost to sub 1%? And how long will this turnaround effort take for you?
So as again, we've always been below 1. Our endeavor is clearly to remain in that region itself.
And how long will it take for you to get there, to your mind?
The shorter the better.
Of course.
And I think we should be looking at that happening over the next 12 to 24 months.
Okay. There's a fresh issue of about 6,800 crore rupees. What will that do in terms of your capital adequacy ratios and the leverage?
So definitely, this will help us improve our capital adequacy and bring down
What
leverage.
are the numbers?
So our capital adequacy post the issue should be closer to about 21.5 to 22%, and our leverage should come down below 5%, below 5.
And what will the shareholding look like post the offer for sale and the entire IPO?
So post the IPO, Tata Group will hold about 85.4% of Tata Capital.
Got that. Just talking about the near term, in Q1, your loan growth was, I think, only about 17%. I mean, is there some sort of a slowdown? And what's been the extent of transmission of interest rates?
So if you look at Q1 and you break it up into two parts, the motor vehicle business and the erstwhile Tata Capital business. Tata Capital's business grew at about 23%. Since the merger got an okay from all regulatory authorities in only May, we were not focusing on growth on that. But if you exclude the motor finance business, Tata Capital grew at about 23% plus.
How's Q2 right now?
In fact, the current GST cut has been a big boost to the economy. We have seen the impact of that in the last 10 days. And I do believe with the festive season coming up in Q3, we should have an excellent H2 as far as credit growth is concerned.
Okay, got that. You've priced the issue at 310 to 326. Now, this is lower than the rights issue price of 343, at which Tata Sons and the other shareholders put in money. Why is that? Did you think 310, 326 is fair value? Why is the discount?
I think we did a rights issue just now in July, which is very recent. From our perspective in this issue always is to get a very large retail participation. As Tata Group, we've always followed the philosophy of remaining attractive to retail buyers. And our effort to follow the same process, and that is the reason the board met and decided that we will bring this offer at a price of 310 to 326 and try to get a much larger retail participation.
And final question, Tata Sons will be left with 85% even post the IPO. What are their plans? Will they do an offer for sale again in the next 3 years? Will there be a need for a QIP as you look to expand?
So I think what Tata Sons will do is a decision which they will take. From our perspective, we do believe that this current raise is good enough for us for the next 2.5 to 3 years of growth, post which we will be there in the market to raise money.
Thank you very much, Rajiv, for joining in. It was a pleasure speaking with you. Thank you very much.
Thank you so much.
Thank you. WeWork India is coming to the market with a 3,000 crore issue. No fresh issue, an offer for sale by the promoter Embassy Buildcon and WeWork International. Now, this is India's largest flexible co-working space, present in 68 centers, 8 cities, with operational desks of more than 1 lakh. Joining me today in our show, IPO KYC, is Karan Virvani, CEO and MD. Thank you very much, Karan, for joining in. Big moment.
Yes, good morning and thanks for having me.
Okay. So there's no growth issue, no fresh issue, just an offer for sale. Why is that?
So, you know, over the last 8 years, Rima, we've been through a huge journey of growing this industry, investing into it, and today gone to become the largest operator from, you know, definitely a financial standpoint, from a revenue and now profitability standpoint. So in the last 3 years, especially since COVID, the business has become self-sustaining. We're actually generating positive free cash and a high EBITDA that is much more than we need for our capex expansion.
So what are your operational cash flows?
So as of last year, we ended at close to about a 22% EBITDA margin. This is a fully adjusted EBITDA. At a reported level, we're almost at about 63% EBITDA margins, and roughly about 420 crores of EBITDA on a revenue of close to about 2,000 crores is what we generated, which is, I think, the highest in the industry by far, and also enough for us to sustain a very consistent growth where we're able to deliver both bottom line growth as well as capacity growth.
Okay. So what are your expansion plans right now? You're present, you've got 68 centers, 1.14 lakh desks, 8 cities. What are the growth plans?
So if you look at the commercial real estate market in India itself, you know, has been growing at roughly a clip of almost like 8%. Last year was the peak expansion for commercial real estate, almost 77 million square foot of commercial expansion. In the last 8 years, the flexible industry itself has become from zero close to about 10%, and for incremental expansion it's nearly 25%, which is now matching ITES. So the industry itself is growing at roughly about 18-20%. We are market leaders in the industry, so our endeavor is always going to be to grow slightly over and above that from a capacity and growth standpoint. We will continue to grow faster than the industry itself, at this scale, we think that, you know, that's roughly in the range of like 20,000 desks year over year. And if demand increases, like last year, we actually added almost 27,000 desks. So if demand continues to show that there is, the requirement, we'll even accelerate that growth.
Got that. So over the last 2-3 years, you've grown at an average of 20%.
Yeah.
Will that sustain? And is there scope to expand margins above 22%?
Yeah, we are operating at already 22% EBITDA as of FY25. FY24 was closer to 20.4%. So you already see a margin expansion, even in a year of extremely high growth. And we see that there is enough potential from the existing ramp-up centers maturing, which will lead to more margin expansion. We've also unlocked few revenue streams that are extremely high margin. Our digital products business, which is growing faster than our workspace business. Over and above that, our services business, which is higher. No, this is services that we sell over and above the workspace business. So it could be anything from F&B to parking to dedicated internet to customizing your workspace even further. This is at about 11 to 12% of our business, where the industry is roughly about 8%. So all this incremental revenue plus the mature buildings continuing to ramp up and the existing ramp-up centers, we think that there's at least 4 to 5 points of margin expansion still available in the business while growing.
Got that. So we'll come to the services business and how you can scale that up further from the current 11-12%. But you're also a premium offering. So on a like-to-like basis, how much higher would your rents be, say, in a grade A office space in Mumbai or Bangalore versus peers?
Our pricing is really a factor of where we take space more than anything else. You see that we have a huge building in the center of BKC. We're in the middle of Cyber City. We're in CBD Bangalore, in some of the best business parks like Embassy, Golf Links, etc., which are always in high demand. So today our pricing averages close to about 20,000 odd rupees per desk. It's almost or slightly higher than 2 times that of the competition.
The India growth stories in Bharat.
Yeah.
The tier 2, tier 3 cities, and you're present only in 8, and you were just telling us the strategy is to go deeper in the micro markets.
Yeah.
So is that 8 cities, or are you planning to expand, and what would be the, say, 2 years, 3 years down the line?
Yeah.
How many cities would you be present in?
So we are evaluating all cities. I don't think we look at anything as tier 1, tier 2, tier 3 in that sense. We actually are looking at where is there sustained demand that allows us to grow fast and have multiple centers, and where is there quality real estate.
As of now, in your plans, there is no expansion beyond 8 cities.
No city has given us that indication yet. If you just look at, Chennai, I'll take Chennai as an example. We only entered last year after 7 years, even though it is a top tier city. And that's really because Chennai's absorption went from 2-3 million square foot a year now to almost 9 million square foot. And in the last year itself, we've opened 3 locations. We've done an extremely large deal for, global tech business also over there. So we're seeing that the market is now ready for us. So yeah, I hope that WeWork is in all cities in India soon, and that's just how much runway we have left from now.
So tell us about WeWork Global.
Yeah.
They're not classified as a promoter. What is their stake, and how much will it come down post offer for sale?
So WeWork India started off as a first ever franchise location for WeWork in the world. At the start, Embassy owned about 100% of the business, and we invested all of our own capital in actually growing the business, for the first 5-6 years. It was only in 2020 that WeWork Global came in and actually, at a time where the company really required money, took that leap of faith and actually gave us about $100 million at that point in time, which allowed us to get through COVID and, get through all of those tough times. They are not a promoter. Embassy continues to be the clear promoter, and it will be for the sustainable future. So they own currently about 22%. Post the IPO, they'll be somewhere in the mid-teens, so roughly a 30% dilution on both sides of the business. And, for the brand, for the IP, we pay about a 2.5% management fee. That gives us exclusive rights to the brand in perpetuity in India.
So this management fee of 2.5%, which is paid annually, when does that come up for renewal?
It doesn't. It's a set fee that we have now in perpetuity.
Okay. Do you have any sort of an agreement with WeWork Global to buy their mid-teens kind of a stake? Is there any agreement between you two?
No, not at all.
Karan, so one of the profitability drivers is your services and digital business. Services is 11-12%, digital is 4%. Can you scale that up higher to say 20-25%? If yes, by how much?
Yeah. So our core business, which is our workspace business, right, has evolved over the last few years from being a product just for startups and freelancers now, where we do really large scale spaces for some of the best global corporates. So these large managed office spaces where we do fully bespoke design, build and operate, source, design, build and operate. Over and above that is the services business, which is roughly about 11% right now. We see that growing extremely fast. It grows along with the workspace business. But as we will bring in other services that basically help you as a company eliminate all other inconveniences. So today we take care of things like your internet, to food, to doing events. When you do a town hall or an investor meet, we're able to actually do that entire curated for you. But over and above that, we feel like there are other potential services, transport, things that GCCs require in terms of services when they're actually growing in the country, or what startups actually require, when they're actually building out their businesses as well. So our endeavor will be to go deeper and try to move that incrementally upwards from a contribution standpoint. And then our digital business, which is roughly about 4% of the business today, 4% of revenue, but actually driving almost 20% of EBITDA. It's a highly profitable business. It's growing faster than the workspace business is. And so that contribution will slightly move up from 3 to 4%, where it is now, maybe closer to 5-6%.
As reading the RHP, there are 500 flexible co-working spaces.
Yeah.
Are you planning to buy any?
Look, I don't, I won't say no, but it's a very long tail of operators. In the last 8 years since we started, 450, 500 operators have come about, which really shows you that the industry is now, evolved. There is value to customers. That's why people are willing to get into it, and people are making money as well. I think if we ever do look at that, being the largest scaled operator, we would need a few things to actually match, which is quality of product, quality of assets and tenants, something that we wouldn't be able to build ourselves.
Perfect. Thank you very much, Karan, for joining in. Great conversation. All the best.
Thank you so much. Thank you.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Tata Capital and WeWork announce IPO pricing as the rush to go public intensifies. More than 73 companies have listed on Dalal Street so far this year, raising more than 1 lakh crore rupees cumulatively.
Wrecker Club bags $50 million to scale autopilot debt financing. The fundraise includes $8 million in equity led by InfoEdge Ventures, LC Nuva and Physis Capital. The remaining $42 million was debt funding from Incred, Ugro and others.
Vani AI Research raises $400,000 in pre-seed funding from Venture Catalyst, raises funds to scale its voice stack, deepen models and IP. The startup has been selected for the Google for Startups AI Accelerator 2025 cohort, also an active part of NASSCOM Gen AI Foundry.
A top management shakeup sees EdTech unicorn Lead Group appoint Moez Saif as Chief Financial Officer, promotes Deepak Hariharan to Chief Business Officer. Other leadership changes include Anuj Kashyap as CTO and Prasad Narsimha as Head of HR. Move aims to support the firm's goal of reaching 10 million students and going public by 2030.
Elon Musk's social media platform X will challenge the Karnataka High Court verdict upholding government's power to order removal of content. The company says it will move the Supreme Court to defend freedom of expression.
Those were the headlines that we're tracking for you this evening on What's Brewing Today. Finbox is making big moves in the world of digital lending. The Bengaluru-based fintech has raised $40 million in a Series B funding led by Westbridge with participation from Aditya Birla Ventures and A91 Partners. Already powering credit infrastructure for over 130 lenders, Finbox now plans to scale globally, deepen its AI-driven product stack, and build the rails for the next generation of lending. Joining me now to discuss this further is Raja Deshpande, the co-founder and CEO of Finbox. Raja, thank you so much for taking time out and being here with us on Startup Street. You know, you are a B2B credit infra firm, right? If you could sort of take us through the kind of solutions you have on offer and the gap that you're trying to address.
First of all, thank you for having me on the show. Finbox is a vertical SaaS in the B2B space, and our infrastructure starts from the distribution layer, which is the embedded finance piece, which is an API piece that enables a bunch of, LSPs, as RBI calls it, digital platforms to offer credit seamlessly. And as we go down the value chain, we have data products like a bank statement analyzer plus account aggregator piece. We have platforms like Sentinel AI, which is a decisioning system and a rules engine. And then we have the entire loan origination system stack that supports personal loans, business loans, loan against property, as well as housing loans now. So basically, there are multiple gaps that we are looking at. One is all of the lenders are always looking to build omni-channel experiences for credit, which is be it building out channels between digital sourcing pieces as well as pieces in the offline mode. And digital transformation is also a big need where they are trying to unify a bunch of the software that they've bought in the past, which is legacy. So we solve all of this in one shot.
All right. And, you've got over 130 large clients already on board, right? So what kind of demand are you seeing, from banks, NBFCs and fintechs now?
So as everybody knows, lending saw like a weak last year's festive season, but then there was a huge bounce back, that started off sort of mid this year on the personal loan space, and then the MSME credit unsecured piece has followed. And as the government has eased, sort of reduced GST, the consumer credit piece we are seeing, take off fairly spectacularly. And we are seeing innovation in the kind of, credit products people are creating. For example, one interesting credit product that has, over the last year done really well for us is the equal daily installments piece. where all of these customers, all of the platforms like BharatPe, PhonePe, Paytm, they embed credit into their merchant apps and then through our pipes offer credit to their merchant base. And we are doing upwards of 400, 500 crores per month on this within sort of a year and a half. Right. So what we are seeing is that innovation on credit products, experiences, etc., increases in the upcycle, and this is what we are seeing now. We are also seeing banks participating more and more in digital lending starting last year. A lot of post-COVID, sort of digitization focused on the liability side, but then the asset side, which is the loans pieces, have come together fairly well, and we are seeing a lot of demand, because of the innovation piece as well as the consolidation and digital transformation pieces from banks.
You know, we're running out of time, so if you could quickly tell us, you've raised this $40 million at this point. How do you plan to utilize these funds? What's on top of the agenda?
So 2-3 things. One is to expand our product portfolio. This is a large value chain, and we are as I said, vertical SaaS player. Second, we are expanding into multiple geographies, including Southeast Asia, Middle East, and the developed markets as well. And third is a little bit of inorganic activity going forward in places where we find high quality assets that can add to our product portfolio.
Sure, and you've been growing 100% year on year across your product verticals, right? If you could share where your revenues stand today and how your solutions are helping lenders manage NPAs more effectively?
So we are at shy of, near the 15 to 16 million sort of mark. I think this month, hopefully, we cross that. But as I said, right, NPAs are managed at various points. One is, of course, the entire underwriting. How do you adjust underwriting while onboarding the customer? And then the second piece is on the collections management side, where we have products such as CollectX, which gives early warning signals to customers so the lenders on their portfolio. So both on the underwriting side, where we enable lenders to iterate on their credit policy and then sort of create more effective credit policies, but then also on the portfolio management side, where we give them early warning signals on how to manage their portfolios better.
Right, and you've also spoken about international ambitions, right? So when it comes to expansion, what kind of geographies are you eyeing globally?
So we are starting out in the emerging markets. So we are starting out in Southeast Asia. So we are already doing work in Vietnam and Philippines, and a little bit in Indonesia also has started. So those are geographies that we will double down on, this year, and then we will start working in the Middle East markets, and then potentially in the US in sort of 3 or 4 quarters.
Sure, and you also spoke about inorganic growth plans where you see, something that could be important for the company. So where do you stand on that front? What kind of companies are you looking at? Are you in talks with anybody at this point?
So we've, we look at this opportunistically. We have, we've evaluated certain opportunities in the past, 3 or 4, but there are 3 or 4 things that we look at. One is, the quality of the technology stack and the product. So basically the integratability of that product into our existing technology stack. Second is the maturity of the founders and sort of the, the matching of the vision, so as to we want to be working with them at least for 3 or 4 years. Third is, maturity of the GTM stack and the quality of revenue. So basically that matters, because in B2B, a lot of companies have services revenues which are not recurring, which obscure the true sort of quality of the business. We want recurring revenues for the business to be able to acquire. Yeah.
Still looking out for opportunities there. All right, Rahul, thank you so much for taking time out and being here with us on Startup Street. Thank you.
Thank you.
All right, moving on. Sustainable home essentials brand EcoSoul Home has raised $20 million in equity and debt led by Axel and marquee strategic investors. Founded in 2020, the company today has a global footprint across the US, UK, Europe, GCC, and India, with retail partnerships that include Walmart, Costco, and Waitrose. With over 1,000 certified compostable products and 12,000 plus retail touchpoints globally, EcoSoul Home is on a mission to become one of the world's largest fully compostable home essentials brand. To discuss the Series B fundraise and the road ahead, I'm now joined by co-founder and CEO Rahul Singh. Rahul, welcome back to Startup Street. This Series B round is a mix of equity and debt, and you claim to have entered the Soonicorn Club. What is the current valuation of the company, Rahul, and how do you plan to deploy this capital across manufacturing, technology, and expansion?
So, Shruti, first of all, thank you so much for having me on the show and be able to share our story. We are right now in the process of flipping the structure from US to India and making India our headquarters. So there are court documents that are filed on both the sides. So we are not publicly discussing the valuations at this point in time. But let's just say we are very firmly within the Soonicorn Club, trying to get to the Unicorn Club within the next couple of years.
All right. And what about the fund deployment plans?
So basically, we have raised $20 million, and this is more of a bridge funding to the structure flip, right? We are already profitable, very solidly profitable, in fact, right? And that's a very proud moment for the company. But there are three major areas we are trying to deploy the funds. First is we are doubling down on Made in India strategy. So about 2 years back, we had only 35% of production come from India. Today is close to 80%, and we are trying to get to 95% India-made products to be sold globally. So that's one of our plans. And the second major expansion plan is geographical expansion, where we are looking at more countries within the Europe and GCC area to expand into.
All right. Like I mentioned earlier, EcoSoul today has over 12,000 retail touchpoints and partnerships with Walmart, Costco, and Waitrose. Rahul, what is driving your global acceptance, and how do you plan to scale distribution from here?
Shruti, the only thing I would want to add on to that is our e-commerce business is as large as our retail business. Essentially, we are not only selling through all the major retailers of the world. In fact, the only Indian sustainable brand on the shelves of Walmarts and the Targets and the Costcos of the world, right? But a fairly large e-commerce and quick commerce business as well. What is driving our adoption worldwide is essentially three things, right? One is we are the probably the only certified food grade sustainable products company that comes out of India, right? That's number one. Number two, our product innovation. So for example, we are the only company in the world that does bagasse-based toilet paper, kitchen towel roll, facial tissues. So it's a product innovation. And obviously we have been able to really crack the price code. We are basically within 15% of plastic. So I think these are the three things that drives our adoption.
This brings me to my next question. The sustainable home products market, is projected to hit nearly $664 billion by 2034, but affordability has always been a barrier. You mentioned pricing, so tell me, how have you managed to crack the cost equation, pricing within just 5 to 15% of conventional plastics while maintaining quality and scale?
Shruti, I think the formula was very simple and it was hiding in the plain sight. Everybody thought that, hey, the way to get to better pricing is through scale. We actually went the other way around. We actually created micro factories in the areas where the raw material was there. So for example, we have factories in Tumkur and Shimoga and Muzaffarnagar and Sitarganj, right? So we went where the raw material was and we created a vertically integrated supply chain. There are very few manufacturers in India or very few brands in India which manufacture themselves. And our competitiveness comes from the entire vertical integration. We run our own supply chain. It's a very technologically run supply chain, some of the best working capital cycles. And more importantly, we are very close to the source raw material. So that keeps our cost very, very low. So we have micro factory strategy instead of a large manufacturing unit.
Like you mentioned, you've got over 1,000 SKUs spanning tableware, kitchenware, personal hygiene, and baby care. Rahul, which categories are seeing the strongest traction globally? If you could quickly tell us that.
So Shruti, all our categories are seeing triple-digit growth, by the way, right? But within that, right, we'll say the personal hygiene and the baby care segment, they are showing like really, really high growth, right? It's more than 250% year on year. So I think that's the categories that we are betting on heavily for the next couple of years.
But triple-digit growth across all your segments is what you're saying. And with this round, Rahul, you've signaled entry into new high-growth segments like chemical-free home cleaning and tree-free paper products. How large is that opportunity, and what's your strategy to win in these markets?
So I think the strategy to win is very, very clear, right? We are a customer-focused, brand first, right? So our firm belief is that nobody wants to consume single-use plastic. Nobody wants to consume chemicals. We just have to give them an affordable option to move away from chemical-based, cleaning agents and chemical-based, tree-based paper. So our goal is to really create those options at an affordable pricing and with a very strong quality consistency. So essentially, that's what we believe will help us win in the market.
Okay.
Not only in India, by the way, we are a very global first company. More than 80% of our revenue comes from outside of India.
Absolutely.
So we create products which are global.
Absolutely. 80% of your revenues come outside from India. But, speaking of competition in sustainable products, it is intensifying with both startups and FMCG giants in the mix. Rahul, what's EcoSol's moat as you scale globally?
So again, our biggest moat is our vertical integration and the product innovation that we are doing, right? Shruti, we are not afraid of the competition because our real competition is plastics, right? It's a 50-year-old industry with multi-billion-dollar brands that exist globally. And if we have been able to make our mark and get into all the stores, we have been competing with them for the last 5 years now. And we have been competing with them profitably. So what really worries me is our ability to scale faster and reach the customers who want our products and not really the competition.
All right. On that note, it's time for me to wrap up this conversation. Rahul, many thanks for joining us and wish you the very best in your mission of becoming one of the world's largest fully compostable home essentials brand. Thank you so much for your time.
That is made in India. Thank you so much, Shruti. Thanks for having me on the show.
On that note, it is time for us to head into a short break. But coming up next, fintech startup Rekha Club has just raised $50 million in a Series A funding round, one of the largest rounds in India's alternative debt space. That's a CNBC-TV18 exclusive. Details on the other side.
Welcome back to Startup Street. Fintech startup Reka Club has just raised $50 million in Series A funding, one of the largest rounds in India's alternative debt space. Now, the company, which claims to have already facilitated over 3,000 crore rupees across 2,000 companies, is betting on AI to make debt as simple as equity for India's startups. Aishwarya Anand is here with an exclusive.
Debt is usually the boring side of finance. Slow paperwork, endless approvals, and founders pulling their hair out. But what if I told you that now raising debt could be as easy as grabbing a cup of coffee? Well, that's exactly what fintech startup Reka Club is promising. Compressing 3-month cycle loans into 48 hours with AI doing the heavy lifting. And now, with $50 million Series A in their bank account, they say they're ready to supercharge India's startup credit story. So, let's go and meet the men behind it, Eklavya Gupta and Abhinav Sherwal. Break this round for us. $8 million in equity and $42 million in debt. What was the idea behind this kind of a structure, and what does it signal as, for your capital strategy?
Equity will be used primarily for spreading our marketplace to offer new products today, right? From a lending point of view, different kinds of debt products, and penetrating into different geographies pan-India. And the debt commitments on the marketplace will be actually, these are special curated programs with the debt lenders on the marketplace who will actually further on-lend via the platform to the different borrowers.
What's the growth rate year on year, and when do you expect to hit profitability? By when?
So I think we're growing 100% plus year on year, right? Like last year, we saw 120% for growth for ourselves. From the overall numbers, we have done 3,000 crores across 2,000 plus companies till date. Our business runs as a business model on a percentage fees that we charge from the borrowers typically, and times from lenders selectively. That number is around 2 to 2.5%, depending on the type of borrowers, etc. Let's say. So that is where we are. From a growth point of view, we're looking at around a 10,000 crore annual run rate within the next 2 years, right?
At the heart of Reka Club is ICA, which is your proprietary AI credit analyst, right? So how exactly does ICA compress debt cycles from 3 months to 48 hours for unsecured loans?
So what ICA does is it's actually connected to all the regulatory sources like your MCA, banking, GST, legal, as well as anything which is available on the web. So imagine it's almost like something on autopilot, right? Whenever a company comes, instantly we are able to create a 360-degree profile, be it risk, their compliances, their financials. So whenever our credit person wants to pick up every data point sits in front of them in one platform. So that is how we are reducing time to decisioning.
AI underwriting sounds attractive, right? But a lot of it also has to do with trust, context. So I want to understand that how do you ensure that your algorithm avoids bias and pricing of risk?
ICA is like a co-pilot to our credit analyst, where it does everything of the manual work, but in the end it just recommends and not forces the decision. So our underwriting policies are always created and vetted by human.
Eklavya, you guys have also launched a 150 crore fund for D2C startups in the quick commerce space. What does that mean? How many startups are we looking at in the quick commerce space that way?
The 150 crore average ticket size would be around 3 crores per company.
Okay.
It would be spread between 1 crore to 5 crore, depending on the size, scale, credit quality of the companies. So let's say 50 companies in that 150 crore fund is what we endeavor. The growths have been phenomenal. Like some of the brands that we speak to, right, have grown like 5x in 6 months just on quick commerce, or even more at times, right? So they need immense amount of inventory as a D2C brand to purchase, working capital management, right, receivable management, etc. So this is their bread and butter to grow.
Have you already started deploying capital from that fund? How many investments, if you have, then how many investments have you already made till now? And by when do you plan to completely exhaust that money? What's the target on that front?
So more than 75% of that fund has actually been deployed because of the demand that we see, right?
Correct.
Reka has funded more than 2,000 companies, out of which let's say 500 companies were D2C. The next funds are in pipeline that will come on soon.
Which sectors are you betting big on? I mean, D2C and SaaS are the obvious answers, but other than that, which other emerging sectors is sounding very enticing for you guys?
You know, in SME, we have picked manufacturing, solar, you know, or some amount of pharma and agriculture. I think these are the 4 next sectors that we have picked up.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching.
The Indian rupee has fallen to record lows this week. Interestingly, keeping the rupee company in terms of depreciation in 2025 are Argentina and Turkey, where inflation is more than 30%, but both have fared worse compared to the rupee. The rupee is also declining at a time when the dollar index is weakening. The dollar index is down nearly 10% so far this year, and the rupee is down over 3% in the same period. Now, one of the key reasons for the fall in the rupee is the rapid outflow of foreign funds from India. More than $21 billion have been pulled out in the last 12 months, making India the least favored emerging market for foreign flows. Indian stocks have underperformed global peers so far in 2025 with just 2% returns, but other asset classes are booming, with commodities like gold and silver in particular seeing a spectacular rally. Now, weak rupee is not necessarily all bad. It can help exporters offset some of the impact of the 50% US tariffs. It could also bolster remittances from abroad. So how low will the rupee go? The government does not seem overly concerned at this point in time. Before I bring in our team of editors, here's the Chief Economic Advisor, Anantha Nageshwaran, on the weakness in the rupee. As I pointed out, he doesn't see the current levels as a key risk. Take a look.
I'm not too concerned about the rupee's current sort of recent weakness or the current levels per se. It's all right. Obviously, we have ample foreign exchange reserves and we have very low external debt. So it's not that the rupee is vulnerable in any particular manner. It is just maybe the current demand for dollars or the reduction in the inflows on the portfolio side may have contributed to this weakness. So I'm not worried about the wider.
And does it actually also help offset some of the, at least as far as the exporters are concerned?
To a limited extent, it's actually a good thing because if the Indian rupee is depreciating on the back of a depreciating dollar, it does impart a certain competitiveness in the near term. But of course, anything that is overdone will be a challenge. But that is not something we are facing right now.
Well, that is the Chief Economic Advisor saying don't see the decline in the rupee as a key risk at this point in time. And we'll get to the competitiveness aspect in just a second as well. But let me welcome on the editor's playbook, Lata, Prashant, Nimesh, Surbhi and Sriram. But first up, our in-house governor. Lata, what's going on as far as the rupee is concerned? And the big question on the street, how low will the rupee go?
Well, if you only want a poll of what economists believe, most of them think that 89 is a good level. It's a round figure which the Reserve Bank will protect. And perhaps you will hear the odd 89.50. But most of them are telling you that the bad news is already in the price. There isn't much to go. Even those who speak about 89 or 89.50 will normally tell you that by March, that is fiscal year end, you may see it appreciate back to about 88. The broad range in the market is 87 to 89.
Yeah, and imagine this kind of... No, I was just saying, Shireen...
No, I was just going to say that at the CII town hall yesterday, and we had 80+ CEOs, that was pretty much the consensus there, even when I polled CEOs on where they expect the currency to be. In the current band is what the majority voted, even at that CII town hall that we did yesterday. But Lata, you know, we took our viewers and the audience through what the Chief Economic Advisor had to say. But really, what do you attribute the decline, one of the key reasons for the decline that we are seeing at this point in time. As I pointed out, it's Turkey and Argentina, but they're sitting on inflation at 30%. We don't have an inflation problem at this point in time. Okay, we've seen foreign outflows, but what really is weighing on the currency?
Well, first of all, there is the near flow problem. As you pointed out, record outflows in terms of, foreign capital. We have seen outflows of this, nature or even higher during the taper tantrum and before that during the Lehman crisis. So we should not forget that this is nothing like that as far as our macros are concerned. During the taper tantrum, our current account deficit was 5%. In fact, the last quarter, it was even more than that, the Jan-March quarter. We have now a current account deficit which is less than 1%, a historic low. So probably that is the point. It was too good to be true. For the last 30 years that I can remember, when the rupee became a marketable, a marketized currency, the current account deficit has been 2 to 2.5%. This 1 year, it was 0.5%. So clearly, all over the world, governments are worried that too much is being outsourced. So we should expect some kind of a mean reversion. I wouldn't worry till the current account deficit is 2%.
Shireen, I was just adding, what I was saying was that imagine we're talking about levels of 89 and some predicting 89.50, as Lata is saying, at a time when A, she's pointing out our macros have been solid, and B, look at the dollar index. I mean, it's not as if the dollar has skyrocketed and therefore currencies are falling and the rupee is falling. The dollar index, the DXY is down 10%.
Exactly.
I mean, from January, the DXY was at about 110 and today it's at 97. And, then we have this depreciation.
That's what most analysts will point out, that we are at bigger historic lows compared to the euro versus several other currencies. And by the way, we are at a historic low versus the renminbi. Until very recently, it used to be 10 rupees or 11 rupees to buy a renminbi. Today, it is 12 rupees 48 paise. So, some of this is, as the CEA pointed out, working to our advantage because, that makes Chinese imports expensive. Yeah. Forget about exports. We always tend to mistake that, it makes our exports attractive. That is the least of the problem. The advantage is that it's a natural tariff barrier for the domestic industry.
For example, the steel.
Steel, absolutely. Why did steel stocks go up yesterday, day before? Primarily because there is an advantage. But I don't think you'll catch the governor saying that he's okay with the rupee depreciation. You don't say that because it becomes self-fulfilling.
On that point, on what the governor may or may not say publicly, let me go across to Prashant because he's been putting this data together. And there seems to be a change in stance, in position, as far as the RBI's intervention in the rupee market is concerned. And we were just looking at that. Prashant, in the Shaktikanta Das era, the RBI was much more aggressive in its intervention, was it not?
It was, Shireen. And so I just looked at these two periods and forgive me if I'm picking out extremes of both periods just to kind of sort of contrast and make a point. But I think it still makes sense because I think the contrast is very much there. Although I think, the current governor is he's only taken charge in December 2024.
10 months old.
And Governor Das, was at the helm of things for 6 years, right? So, under Governor Das, the dollar index went from 96 to 106. Now, this is point to point. I think 2022, we also saw 113, 114 kind of levels. So, but this is just point to point. So, but you got to live through this point to point, right? And that's what we're doing right now. The policy was clear: maintain low volatility in the rupee. And of course, the RBI used to aggressively intervene to curb rupee fall during periods of dollar appreciation and vice versa as well, on both sides. Now, this policy of maintaining stability in the rupee actually reached its peak, if you remember, during October to December 2024. This is when US elections, etc. were taking place. The dollar index saw a 10% jump, October to December 2024. And that is the period when RBI intervened, sold dollars heavily, and the headline reserves at the RBI declined $110 billion during this period. And this is both spot and forward positions combined, $110 billion in this period, right? But as a consequence of that, money market rates moved about 200 basis points above policy rates. That essentially, it was like a follow-on effect. It tightened credit conditions, and all of us have sort of spoken to companies during that period. And of course, it led to the cyclical slowdown, which some would say we are kind of sort of still unwinding as of now. Now let's come to, Governor Malhotra. And I think right as Lata and we've spoken about this as well, as soon as he took over, there was this, one of the first things was, will he kind of sort of, is there going to be a change in policy with regards to the rupee, right? So far, if you look at point to point again, right? Governor Das left off at $106 index. All that has happened in the last 10 months, from 106, we've just come down to 98. In that 6-year period, we moved from 98 to 106. In 10 months, we've come off from 106 to 90, back to about 98 where we are right now. The philosophy seems to be that, I mean, India, you mentioned Turkey, etc., right? The philosophy is India attracts growth capital and it's not interest rate sensitive money, carry money which comes in. So it is, so the focus very much is growth. And looks like the philosophy is let's not sacrifice growth for the sake of forex stability. And maybe that makes sense, right? External debt here for India is less than 20% of GDP. 2/3 of GDP, our GDP is domestic consumption. So it kind of makes sense. It is local consumption, which is the majority of the economy. And of course, consequently, RBI has done a lot. 100 basis point in rate cuts, injected a lot of liquidity into the system. But they've also been very tactical with sort of forex intervention. So I picked out a couple of things that Lata can corroborate because I think she talks to more traders and dealers than I do in a year. In a day, she talks to more. But what I picked up is, they are, for example, in February, the RBI was in the market heavily, selling dollars. That is around the, I think, Liberation Day, etc., right? Then they went on the other side. So they've been very tactical. It's not as if they are not in the market. And even now they're there.
They were there yesterday, today.
Correct. They're there every day. And maybe large sums of money as well. But they're also coming in slightly at a wider level. Earlier it used to be, say, 10 paisa. Right? Now it's 40 paisa, 50 paisa. I mean, the threshold for them to allow the move in currency has also become larger in that sense. So I think it's interesting that is what they're doing. And I think sorry.
I want to do this thing. So one is that the dollar index that we keep talking about, and Lata ma'am, can you please correct me if I'm wrong? But in the last few years, the correlation between a dollar index and EM currencies, while directionally it's the same, but they have decoupled quite a bit. It doesn't, if dollar index falls 10%, doesn't mean that our currency will also fall 10%.
No, absolutely. No, absolutely. On the contrary, all Asian currencies are up 7-8%.
Correct, exactly.
Versus the dollar. Yeah. Just a little bit in terms of, trying to correlate regimes. The Shaktikanta regime held currency only for those 3 months, September, October, November types. Because in October, the Indian inflation was 6.8%, above the 6% mark. You don't want imports to become expensive at that time. So the same Shaktikanta regime 2 years ago in 22 had allowed 11% depreciation of the currency in a year. So, it's different. When inflation is very low, you don't mind the currency depreciating.
Also, and in October, we had $10 billion of FPI outflows along with...
They had to be a little different.
And Governor Malhotra
Short point is, I think, much will depend on the RBI's forecast. It's not today's flows. If they are okay with the rupee depreciation now because they believe that this is temporary, trade, even the CEA said he expects a trade resolution.
I think that's the only thing to try. I mean, for going forward, track the whereabouts of our Commerce Minister, Shireen. He's in the...
Still in the US. Still in the US. He's very much there.
And if there is a deal which comes, I think that is squarely what people are focusing on.
Check social media every day.
No, that's
every
she
hour.
said it.
Every hour, check social media.
Don't check anywhere, just check.
Just check social handles every...
I just want to make one more point about
handle.
the dollar index, right? Shriram, you made that point. 60% of the dollar index is the euro, right? Euro is appreciated. So actually, we're talking about the rupee against the dollar being down 3.5% year to date. I checked out numbers because the euro has gone up against the dollar. I checked out INR euro. You know how much it is? Rupees down against the euro? 17% this year. 1.7. So, against the GBP, British pound is down 11%. So it's actually the euro which has strengthened substantially, and that is the reason why you've got these.
Funnily, it is worse for euro that it has strengthened so much, and for Japan, than our weakness.
Don't take a holiday in Europe.
It's the hit. I mean, they folded too soon with Trump, and they will pay the price for it over a very long time. It was a deal with the devil.
But Shireen and everybody, the advantages of all this is up until 22, immediately after COVID, there was this burst of revenge travel. At that time, the amount of dollars we spent because Indians were holidaying abroad were huge because the euro and pound were not that expensive.
Yes.
So now there is another natural tariff barrier for Indians traveling abroad. Let's take a holiday in Sikkim.
I'm not so sure it's going to curb foreign travel. I'm not so sure it's going to curb foreign travel and get people to spend on travel.
On a more serious note, education outflows have definitely dwindled.
So how much is
because of other reasons.
I'll have to confirm this. UK, the outflow on education from Indian students is $20 billion. $20 billion a year. That's UK. US will be much higher, right? We'll have to look at the numbers. I've heard. So I think all of that, because of what's happening, I mean, people are going to stay here. People are going to, and there are opportunities here in India for students to do that. It's a huge bill, actually. So yeah, you're absolutely right, Lata.
I think the Reserve Bank's and the government's policy after the 1991 liberalization is markets find their level. They don't angst over the rupee that much because at a level, at 89 or 90, rupee will be attractive, and so will the stocks be.
Exactly.
Both will be cheaper. So I think we are not at all at the taper tantrum or any angsting level where we have to take a capital account, step of restricting.
As people have said, macro-wise, I mean, actually just sheer numbers, I mean, a pretty strong
Exactly. It doesn't actually get better as far as the macros are concerned.
Yes,
absolutely.
No, it does. It does.
Let's just move away from the rupee for just a second because I want to get Nimesh into the conversation and look at what's happening in the equity market versus other asset classes. I mean, we've all been looking at the mouth-watering, jaw-dropping rally in gold and silver as well, which continues. But Nimesh, let's look at what's happening as far as the equities versus other asset classes are concerned. How do we stack up?
So, Shireen, it's very clear. A good macro doesn't mean a good market, right? I mean, that's been the old proverb, and that's how it proved to be. Look at what happened
China as an example for 20 years, right?
Exactly. No, and that's the point for India as well. Look at this year. Y2D, Nifty and Sensex are both flat. If you look at the US indices, they are up between 14 to 16%. So, double-digit kind of gains for European indices, more than 20 to 30% gains for Asian indices. And even the European indices are up between 15 to 30%. So that's the kind of move we've seen across all the other emerging market, not only emerging market equities, but the global equities as well, as far as Indian performance is concerned. And this is even more shocking when you look at equity performance versus the commodities. The gold is up almost 42%, and this is Y2D dollar returns, right? 42%, 42% Y2D in dollar terms.
Yes.
Okay. If
this is, उसमें से 10% तो dollar का exchange rate है.
You know what?
No, that is in dollars.
That's what I'm saying.
Comex gold.
Okay, you're saying.
If that's the case, how much is silver up? 52%. Silver is a 52% Y2D in dollar terms. Forget that. Even copper, which is not a very tradable
This show was supposed to be about gold.
Still, even copper is up 17% Y2D in dollar terms. Yeah. So whether you look at commodities, whether you look at equities, global, local, Asia, India is relatively underperforming. That maybe explains the reason why it's not the favored destination as far as FI flows are concerned. It's very visible, right?
Shireen, with your permission, therefore, that question,
yes.
How will the earnings growth look like? Ultimately, people will come for earnings growth.
Absolutely.
And we have had 5 quarters of single-digit, at least if you look at the Nifty EPS growth. What's your sense about end of the year? People are predicting 13%.
14%. If
that looks legit?
That looks achievable, Lata. If FMCG and all contribute, it's achievable. And if that has to happen, maybe this is the last phase of massive FI selling, because the rupee will also, as you rightly pointed out, so that will help them. And plus, if macros improve, in terms of macro, I mean earnings improve, you're going to see a bit of FI money coming back. But at this point in time, they have enough opportunity globally, everywhere else to make money.
I just want to get Surabhi into this as well, because she's been looking at the FI flows also, and that's something that we've been talking about. In fact, it takes me back to the conversation that we had with the DPAM secretary, where he virtually thanked domestic institutions and retail investors for coming to the rescue of the Indian stock markets. And we've been talking about the Atmanirbhar angle playing out for the stock markets as well, driven by DII and retail investors. But Surabhi, what is going on really there as far as FI flows are concerned? And to Lata's point, the return, so to speak.
Yeah. Shireen, it's very simple. FII money is finding better homes, even if they're temporary homes elsewhere. Markets which are relatively cheaper, which are showing better earnings potential, and which have a AI/tech story. It's as simple as that. Now, those are the reasons, and then therefore, here are the numbers. And frankly, numbers as of now, last 2-3 months aren't even that bad. Let's just jog memory here. I'm first talking about the India depository data, and then we'll compare it with other emerging markets. When the year started, it was on a really bad note. I mean, we had $9 billion, $10 billion kind of outflows in January. February, it came down. Then it got a little better. Actually, when the tariffs hit us, those months were positive. If you look at April and May and June, those months were positive. Why? Because the hope was, India is a local-driven economy, and we have a great relationship with the US, and we'll be the first in the queue to get a deal. None of that played out, and as that became clear, the outflow started again. Because here earnings were not picking up, there was no deal happening, and the FBIs knew that they had to head back to other markets like Taiwan, South Korea, and of course mainland China. Now the outflows, July $2 billion, August $4 billion, September so far only $1.3 billion. But the fact is the market is absolutely range-bound, and that's where the point on domestic money comes in. Retail money, family offices, and all this money is absorbing so much supply. We've discussed this on the show earlier, but if it was not for the local flow, this market would have had a very different texture and nature. Now, let me just quickly contrast this with some data that Nimesh and I were discussing in terms of how do we stack up against other emerging markets. Really bad, actually. The next big EM, or one of the BRICS, which comes close is South Africa. South Africa has seen an outflow of about, this is 12 months data, about $12 billion. We've seen a $21 billion outflow. We've digested it. If you want the silver lining, thanks to domestic flows, we've digested these outflows really well.
Is minus 20.
And South Korea is also minus 20. Yes, South Korea and South Africa.
Guys, coming back to the rupee because we are out of time. Sriram, let's talk about the big C, competitiveness, and we alluded to that, but you put the data together on what this actually means or how it helps India's competitiveness in this challenging environment with that 50% tariff hit.
No, so yes, you already said it, right? I mean, the rupee weakness offsets some of the tariff blow. Even on competitive terms, so for example, let's take the example of South Africa. They had a 20% advantage over us in terms of tariff. Their tariff was 30%, ours is 50%. But their currency has appreciated 10%. So they have already lost half the advantage. And we have lost another 3-4%. So the net effect is much lesser.
Yeah, instead of 30% disadvantage, it's a 15%.
It's a much lesser. In fact, instead of 20, it's about 5 or 6.
Fair enough.
In the case of Brazil, both are at 50% tariff. Their currency is appreciated 16-17%, which means we are more competitive than Brazil in many product segments. Now, how much of that overlap will differ from one country to another? But the part of the correction was overdue. At the end of November last year, rupee was considered overvalued. And so a 4% correction from there, some would say that it was par for the course, right? That is one. Yes, at the current level, the 89.90 sounds scary. But, and it also helps us with the negotiations to a certain extent. I know Lata ma'am and I had this conversation yesterday about this. And I think that what happens is if Trump wants us to appreciate our currency, it's better to start at 89 or 90 than to start at 84 or 85. So by the time the appreciation, whatever we reach, we are still competitive in the market. But Lata ma'am thinks that,
all said and done, I really want to say that we shouldn't concentrate on exports. It's a very small part of our GDP. The real advantage of a weak rupee is that domestic industry gets a huge tariff wall. I expect growth with a weak rupee because of domestic industry, not because of our export industry. Because Indian exporters don't have that, rare earth advantage. If you will not bring down your garment price down, Vietnam will do. Contracts are set, prices are set ahead of the delivery. So we must not make too much of an export advantage for our currency because it is all contracted.
So
the real advantage clearly is for domestic industry. If domestic industry is gung-ho today, it is in areas where import competition is
there.
Lessened.
The point is that
Sriram, very quickly, we're totally out of time in exactly 5 seconds.
Yeah. The point is that the exports are the most vulnerable segment.
Yes.
So therefore they need the focus, not because exports growth is necessary. They need to be protected. Let the currency protect them.
Shirin, just 5 seconds for me. I'll just But I want to say that for new money, right, new foreign money which comes in, if the rupee goes down a little bit more, a foreign investor coming in now is starting with a 3.5-4% advantage. Cheaper. Because when you take the dollar out, right, you're starting with that.
Easily.
So I just want to give a slightly positive. आपके 5 seconds.
No. मेरा 5 seconds यही था. Because it's a show on rupee. A word from internal governor. What to expect, ma'am, on the next policy?
Actually, the street is split down the middle, and I think a rate cut
only because the rupee is.
Because of the rupee, you wonder. But as Prashant said from the start, we are not a country which attracts money for interest rate differential. Sure. Therefore, I would think that he will give the market a leg up and go ahead and cut. The market is equally divided.
This should be the.
I would tilt. I would tilt in favor of.
That's the consensus. That was the consensus in industry as well, that we will see the MPC deliver with another rate cut. Mere 5 seconds. I'm only ruining the fact that I possess no gold, and मेरी किस्मत में तो Paytm gold coin भी नहीं आया. That's my 5 seconds.
Go out and spend.
Gold is passé. Now it is silver.
Silver is the new gold. So,
and my 5 seconds are
new gold. Maybe I stand a chance with that. But guys, it's been fun talking rupee rates and relations. But thanks very, very much for joining us here on the Editor's Playbook. To all our viewers, we'd love to hear from you. Send us your feedback, suggestions, comments. Till next week, from all of us here, goodbye and many thanks for watching.
Since the RBI MPC's August meeting, so much has changed. 50% tariffs imposed by President Trump, a giant GST cut by Indian governments, a massive fee hike on H-1B visas by the US, and now a threatened 100% tariff on branded pharma. These steps are large enough to change the entire growth inflation dynamics since the August policy. This makes the deliberations of the CNBC-TV18's Citizens Monetary Policy Committee that much more important. Let me welcome Chairman Pranab Sen and our members, Dr. Soumya Kanti Ghosh, Dr. Sajid Chinoy, Samiran Chakrabarti, and Sonal Verma. Gentlemen and Sonal, good morning and thank you very much for joining me. Well, Soumya, as the Finance Commission member as well, I'm going to begin with you. Last policy was branded hawkish by the market because the Reserve Bank said that the 1 year ahead inflation that is second quarter FY27 will be 4.9%. So market thought no more cuts. What's your assessment of the inflation trajectory now after the GST cuts and the huge Asian deflation?
Yeah, thank you, Lata. No, I think you have asked a very pertinent question in terms of the inflation trajectory. Since the last time the policy, in August, the policy was announced, I think there has been a plethora of changes, as you correctly pointed out. There has been a lot of developments on the global front, but most importantly on the Indian front also, there has been this GST rate rationalization. And of course, there are reports that, as you said, there has been serious Asian disinflation. In fact, if you look into the all Asian countries, the inflation is lower than the band of which it is prevailing. If we extend the case to India, I think in India also, the impact of GST is going to be more pronounced. If you look into the trajectory last time when the GST was cut in 2019, I think there was a significant impact on the inflation trajectory on a one-time basis, and then it declined. In the current scenario, there are a couple of points to note. The first thing is that apart from the fact that food inflation has continued to surprise on the downside, the GST rate rationalization actually translates into around 16% weightage in the CPI commodity basket, if I just take a rough approximation. So even if that actually should translate into 114 basis point impact, but even if I assuming that the pass-through is only 50 to 60%, which is the most plausible and rational assumption, the overall CPI decline could be in the range of 60 to 70 basis points. I take it as 60 basis points. This apart, there is also the likely impact of a new CPI base which is coming into effect from February 2026, where in all probabilities the food weightage should be reduced. So if I take into account all these technicalities and also the fact that core inflation has been running significantly below par, if I take out the gold inflation, I think inflation for this year average will be close to 2.5% with a downward bias. And the most importantly, RBI has been citing this as a forward-looking central bank, that the next year inflation, when the policy is announced in June, it was 4.9%. Now it is tracking decisively below 4%. So my sense is that with an inflation rate which is going to be below 2% in September and October could be the lowest ever. And most importantly, 2.5% inflation average this year, less than 4% next year. I think there is enough arsenal in the room to suggest that the inflation trajectory will be significantly benign in the next couple of months and even in the next 1 year or so. So basically the projections of the central bank or anywise could have changed significantly, could possibly change significantly when the policy is announced.